Sure, with those beats for a moment there, I thought I was in a nightclub. But it's great. Good morning, everybody, and a very warm welcome to all of you here at the JSE this morning. Thank you for joining us at this annual ESG Investor Showcase event. Features a few changes, which I'll explain to you later, but because we're running slightly behind, I will go straight into introducing our Director for Capital Markets and Group Strategy, Donna Nima, who will share with you some of the fascinating insights, as some of you may remember from last year, relating to her travels and what she's seen. Donna, of course, a seasoned markets person who brings a different level of rigor and dynamism to this sort of debate to us. Donna, please can I hand over to you.
Thank you. Good morning, everyone. Good morning. I want to start by saying how pleased I am to see so many people here this morning. This is the best attended showcase we've ever had, and I think it just reinforces the importance of ESG, not just in the investment community, but also in all walks of life. I do want to pay a very special welcome to a very special person that South Africa can claim all its own, notwithstanding the fact that he has a double running around in the UK. We have the better looking one here in South Africa, and that is Mervyn King. So Professor, thank you so much, not just for being with us today, but for everything you have done over the years to make South Africa a showcase in terms of ESG, particularly around governance standards. And you've got codes of governance that are named for you and will outlive all of us, I think. So well done to you. I remember being in Nigeria several years ago, and there was a big debate happening between the Nigerian regulators and about 700 brokers that were sitting in the audience. And it was almost reaching thermonuclear status. And finally, one of the regulators on the stage, and they were making comparisons between Nigerian corporate governance and South African corporate governance. And finally, one of the regulators just stood up and said, "Look, South Africa's got Mervyn King." So, and we do. So thank you so much, Professor, for being here. And we've got some other organizations here. We've got members of the CFA Society, so thank you all for being here, and also the Actuarial Society of South Africa, and of course, SICA. So without further ado, I'm just going to show a few things that I hope will pique your interest. This is not going to be a long PowerPoint presentation. It's going to be a few drops of water that I hope will help build your wave, to use the words of Nancy Pelosi in the US elections that happened overnight. But I do want to share a few tidbits of information that I think you might find of interest in terms of what's happening in the world of impact investing and ESG investing. As Shamila said, I just came back recently from a roadshow in the United States. And for the first time in a long time, we were out on the West Coast. And it's such a grueling trip. It's not something you want to do often. But we went out to see some of the world's largest institutional investors on the West Coast. And the importance of ESG in terms of their portfolio management was really eye-opening. So you all here that are showcasing your companies, those of you that are here out of interest in terms of the portfolio you manage, are on the wave with a lot of the world's largest and greatest institutional investors. Before I get into any slides, I really want to recognize Shamila for all the work that she has done to really embed ESG into the lifestyle of the JSE. In our listing requirements, in our engagement with listed companies, in terms of our investment and our interest in the investment community. There's a lot more we want to do, but she has done already a great deal in lifting this very important topic to be a very important share of mind across the constituencies of the JSE. So Shamila, thank you very much for all that you do, but particularly for arranging today. And to the JSE events team, I also want to thank them. And to Nicola Caminos, Nicola, raise your hand back there. Nicola is also responsible for our buy-side relationships, and she'll be around to talk to some of you about some of the things that we're doing further on the buy side, not just around ESG. And I do apologize, those of you that were in a queue to register this morning. We did say just come on in and you can register later at the break or whatever. We had a lot more people sign up than we had anticipated, but I think that's a good thing. So just a few things to whet your appetite, and just to talk a little bit about what's happening in the world of ESG investing. At the top there, you can see the growth in the number of funds and assets under management that is focused on ESG. These are ETF AUMs and the number of exchange traded funds. And you can see it's almost reaching a vertical line. And that is because this theme has become so important. I'll just move along quickly. I will allow Shamila, if you want to circulate this to the attendees, I'm quite happy for you to do that. In terms of numbers, in terms of investment in global SRI, socially responsible investment, on the left hand at the top there, $22.8 trillion. And AUM, most of that is still focused on the bond market, green bonds and other kinds of sustainable bonds. 65% of it is in the bond market, and 11 billion of that is in global ESG ETFs, which we just saw on the previous page. So I'm going to walk and point to, let me walk on this side. Can everybody hear me if I just talk? So what I find very interesting is this, and this is how ESG stocks have outperformed the emerging market benchmark. And what you can see here is the blue line, the emerging markets benchmark, MSCI's index, and in the blue line. And then what you see in the pink line is the MSCI emerging markets ESG index. And look at how you've seen a divergence since 2009 of the performance of one index over, okay, sorry,
we got 50 people on the webinar.
Oh, wait, there's people on the webinar, I do beg your pardon. And welcome to the people on the webinar. So I'm not sure if you can see what I'm showing, but if you can, then you will see this divergence in terms of performance of the indices, one being emerging markets, MSCI on its own, and the other being ESG. This is really pronounced, very pronounced. And so therefore, what investors are finding is that not only is investing in ESG stocks a feel-good feeling, it's actually a differentiator and gives important alpha in terms of performance against just standard indices. So this is a very important trend. We are starting to track this on the JSE as well with regard to our top 40 performance and the top 30 that are in our index. There's so much overlap between the two that we haven't quite seen a divergence to this extent, but we're hoping that we will. Those of you, the companies that will be presenting and others that are doing a lot in this space, we expect that you will see an uplift in your share price. And therefore, we are hoping that we will see a similar divergence in South Africa in terms of the performance of a sustainable index versus just a, shall I call it, a plain vanilla or market cap index, which most of these are. And then you can see over here the flows into index tracking funds that are ESG benchmarked, and you can see how this has grown. And the blue are the funds that are listed in the EMEA region, Europe, Middle East, and Africa. And the pink that you can see here is USA. But you can see, again, significant increase in ESG and index tracking investments. So you're not alone, those of you that have a big interest in this. So there are a couple of things that the JSE has been doing already. I'm not going to go into a lot of detail on this slide. I just want to raise a couple of things again to pique your interest. We did launch a green bond segment in October of 2017. We have had successful issues in that green bond segment. The IFC has issued a green bond on the JSE. The City of Cape Town issued a green bond, 3 times oversubscribed. And Growth Point, a real estate investment trust, most recently listed a green bond, which is, I think, a very interesting issuer to have come to that segment of the market. And just a little bit more, that's a little case study on Growth Point. We'll leave that for you all to read at your leisure. But one of the things that we're looking at is what can we be doing more that will give you opportunities either as an issuer to issue product that will be linked to your performance around ESG. There are companies that have a lot to brag about and be proud of. And for investors, what can we be doing to give you investment alternatives that will perhaps mimic some of this performance that we've seen in other parts of the world? There are a couple of things that we're looking at. One is we're looking at new products, listed project bonds. There's a framework that has been put in place for infrastructure finance. We work together with National Treasury, with the World Bank. That does overlap a bit into the green bond segment because a lot of the infrastructure finance has a green element to it. Those listing requirements are already in place. And we are hoping that with President Ramaphosa's 400 billion Rand announcement on infrastructure funding that this product will be used. There's already some key showcase products and listings that are underway, extension of the HAL train, the refi of the renewable energy projects. Some of these things are already under discussion that might create some unique opportunities for those of you that are investors. The other thing I want to mention briefly is social impact bonds. This is something that we have taken on as a keen interest at the JSE. You may be familiar with these. There's lots of different kinds of examples of them. But we have new investors looking at our country, like the Bill Gates Foundation, the Dell Foundation, and some of these others that are these other global billionaires that have pledged to give back to society. One of the things that's important for them is that their investments themselves be sustainable. So they can't give all of it away just in grants because once they've given it away, it's gone. So what they're starting to look at are investments that they can make where they invest some money in a ring-fenced project and the return on that investment is adjusted downwards by the social impact that that instrument or that project provides. So for example, we have in South Africa many municipalities that are not creditworthy. They do not have the ability to access public markets. But they could access funds from the Gates Foundation or from some of these other private foundations by ring fencing projects such as a hospital or a school, where they can measure the benefit to the communities by building that project. And therefore, they can invest money at a cheaper rate, so a lower interest rate, than they would normally achieve if they were just placing money in public markets through exchanges and so forth. We've also seen versions of this where the projects are not linked to a lower interest rate, but they get linked to grant funding that goes alongside it. So a piece of the funding would be non-interest bearing and would be a grant as opposed to principal that would have to be repaid. Another version of this we've seen is that interest is payable or not, depending on what the impact of the project has been. So I think this kind of instrument may not be something that would be of interest to all of you because you are not social impact investors in the way they are with grant money and corporate social investment. But to the extent that we get that kind of investment in our country, and to the extent that other projects may come along alongside it, that may be normal bond market capital raisings, it does create an opportunity. So we would like to be working with you to develop other projects and products that can make this segment of our society investable. I think that's the issue we have right now is we are aware there's a huge awareness in South Africa, a lot to do with what Professor King has done. But there's a huge level of awareness and there are good stories. And they're not so good stories. Steinhoff was not a good experience for South Africa on the governance side. And the JSE has recently issued a white paper in terms of changes to our listing requirements on this. And you'll be hearing from my colleague, Andre Visser, on this in a little while. But one of the things that we're also looking at is that there's a futures contract, and I think it might be on this. Yeah, there's an ESG compliant futures contract that was just announced. It's weeks ago in the Nordic countries in terms of taking the Stockholm OMX. We have a top 30 as well with our index partnership with FTSE. They've taken that and created a futures contract on the back of that. So there are things like this that we can be doing, and we would like to be working together with you as issuers and investors to see what more the JSE can be doing to make this real in terms of cost of funding, reduced cost of funding for issuers, but also in terms of investment opportunities and differentiation and giving you some alpha that's related to ESG. So that's really what I had to share. As I said, it is a huge theme in the US, along with lots of other things that are very interesting, artificial intelligence and machine learning. It was palpable in San Francisco, the convergence between the investment industry and technology. Obviously, the proximity to Silicon Valley leads a lot to that. But just to give you a sense, we spent some time with people at the top of the house of BlackRock. They run a $5 trillion US equities book. They have 50 people in charge of that. And they do most of the analysis and stock picking through machine learning. I see my colleague John Burke from Issuer Reg has just joined us. I came back and told John, nobody reads your SENS announcements anymore because BlackRock says that human beings do not read those. They go straight into machines and into pricing models. They don't have human beings reading SENS announcements. So I was very intrigued and impressed with that. But again, in the midst of all of that, the machine learning, the 5 trillion, only 50 people around the world managing that massive portfolio that's orders of magnitude bigger than our own economy, they still had a lot of time to talk about the importance of ESG and what were we doing in South Africa and what are the showcase companies in South Africa that they can be looking at. So we did share the information about our index, about what our companies are doing. You're going to learn more about that with the companies that are going to be presenting today. But again, thank you all so much for being here. Please consider us your partner. We want to work with you to make this more of a mainstay in investment in our country. So we look forward to the ideas you have. Please don't be shy, speak up, shout up. This is a family discussion. This is not meant to be a series of presentations and whatever. We really want to engage. So thank you again, all of you, for being here. And I know you'll have a very interesting day. I think there's an investor panel that's going to be up here. So those of you that are on that panel, I encourage you to please give us some ideas. Put the challenge to the JSE in terms of what we can be doing to come up with some creative ideas on investable products for you. So thank you again. Shamila, I hand over back to you. Professor, again, thank you so much for being here.
Thank you, Donna. So I think, thank you so much, Donna. And it's always your experience and your passion for the markets shines through. And I think inspires us with a sense of hope and wanting to take greater action. But I think now, you know, a temperature change to where we were perhaps 10 years ago, this would have been a very different conversation. We have good experiences, we have good results that we can now look at and you know, refer to the world over. So the sustainability practitioners in the room, take note, take it to your CFO. And I think some key takeaways there about the potential for low cost of capital, if you have better ESG credentials, better share price performance that we're seeing coming through tangibly. And certainly, I think the other takeaway is a widening of the potential investor base, all of which are very, very key for any of us in the room today when we look at the markets the way they are, when we're looking for greater investment. And these are good things to be able to promote for our companies. So now, turning to today's proceedings, I had prepared a short presentation, but I think in the interest of time, we'll just move to that quite quickly. I wanted to share with you some of the broader trends, and please bear with me as I'm going to speak quite fast. And my son told me the other day when I said he was speaking too fast, he said it's because I listen too slowly. So I want to share with you some of the broader trends that we've observed over the last year or so, and it'll be interesting to see by the end of today if these surface in and in what form from the various presentations and talks that we will hear. Am I? Okay, thank you. Okay, so the few that I want to go through, and some of you may have seen this before, especially the companies who attended the ESG model roadshow that we had earlier in the year. But I think we're very interesting because from the perspective of what is happening broadly and the trends that we're seeing, these could be useful trends for you to pick up on. And I think to see how these impact you in your various roles and responsibilities in the various industries that you work in. The first one I think is a critical one. And this one, even if we only spoke about this, is perhaps the most interesting for me and the most critical in this debate. And that is the issue of the trust deficit. I don't know if any of you are familiar with the Edelman Trust Barometer, but effectively is a barometer that measures a few different countries around the world and looks at the trust that civil society has in four other players, and that being NGOs, business, the media, and the government. And the thing is that over the last few years, the barometer has been declining, which is a very worrying trend when you think that that means that civil society, on which most of us actually depend on to achieve our social license to operate, no longer trust us. But the other part of the coin, of course, is that we are the civil society. We are these people. So what does that say about us? We work in businesses, but there's a part of us that also doesn't necessarily trust business. And I think when you look at what's happened in the country and we reflect on the other element of trust, which is government, for us in South Africa, this is actually, something we've lived and seen. The media, NGOs even, and these are perhaps some of the surprising elements that we've seen. Fake news, I think, has a lot to play, particularly a role to play in relation to the mistrust in media. So when we look at this, and why is this relevant for us in this kind of conversation today? A lot of it has to do with how we position ourselves as companies, as different corporates, what we say and how we communicate. Some of that is through our sustainability stories and the way in which we articulate that and whether society can trust what we're saying and how we're actually conveying that information. ESG reporting in particular has a large role to play in this regard because it helps society at large to get a better understanding of how companies operate, how they impact on society, and how they see society impacting back on them. And this ability to engage and understand is critical to building that trust. It's about communicating that in a way that is credible and that people can rebuild their trust. And I think this is a very important dimension. To just reflect on that quickly, these are some slides from the Trust Barometer. Very quickly, all the green countries are effectively, in terms of the rating, at a level of distrust. So you can see there South Africa within that mix, not surprisingly, and just a few countries, in fact, that have scored high and actually fall within the trust category, literally a handful, and that's those in the blue column. If we look at the polarization of trust, this is a very interesting graph, and you will see South Africa over there, one of the countries actually with extreme trust losses. So this says a lot, but it's also an opportunity for us to rebuild. I highly recommend that you would actually, if you have a chance to go and read the trust barometer, it goes into a fair amount of details of the particular elements of mistrust that are coming through strongly, and I think a good opportunity for us to look at rebuilding some of this. The other trends very quickly. We're seeing investors starting to ask for ESG reporting and standard setters to unify the agenda. Particularly to the issuers in the room, this might perhaps not be that new to you because often we're hearing issuers say that there's this issue of fragmentation, there are too many standards, there are too many reporting models, it's become an alphabet soup. So this is actually perhaps a good development that we're starting to see that there's more conversation happening on how we can unify this agenda and actually be able to understand what it is we're trying to achieve when we put out the various reporting frameworks that exist at the moment so that people can be guided in the right direction of what it is that you actually want to achieve and not reporting for reporting's sake. And the other one, a big trend, and it will be picked up later on today, millennials and ethical investing, and definitely about millennials pricing doing good over doing well. And again, I've mentioned in previous talks that if they're poised to become the sort of dominant generational cohort, you actually can't ignore these preferences. These are the investors of the future, in some ways already the investors of today. And their preferences are changing, and they will be the ones to start driving the change in society. The plastic pollution disaster, when we look at particular themes within sustainability that are surfacing, I think everybody has seen the turtle and the plastic bag. And but the fact that this is becoming evident, the whole focus on single-use plastics tells us that it's reached that tipping point where a big change is needed. Circular economy becoming one of the emergent models that we're seeing for sustainable development. And this is the other part of the debate, of course, is that if everything is going wrong, how can we change it to make it right? What sort of economic models should we be looking at? And this is one of those that seems to be emerging as a model that people should potentially be looking at, and the concept of circularity. The TCFD, so this is the Task Force for Climate-Related Financial Disclosure. Many of you might already be familiar with this, but the actual task force was mandated by the G20 or by the Financial Stability Board, basically recognizing and acknowledging that climate change and climate change risks are actually systemic risks to the global financial system. And so the quantification and understanding of that is critical. This takes us to another level, moving purely from just reporting on carbon and carbon emissions profiles and things like that to actually understanding the embedded risk that this poses to business and business models, and has been taken up by many reporters already and has become a very growing and prominent framework. The other one is about ESG regulation and what we're seeing globally that has been increasing, and an absolute slew of regulation and codes in the last 4 years. This is from a PRI study talking about greater ESG disclosure. So both in the form of regulation and in the form of codes. So we're seeing definitely globally that this is becoming more and more important, and there's a need even at regulator level to start considering how to do this. I was very pleased to note 2 weeks ago at the World Investment Forum, there was a panel where IOSCO, which is the global regulator for security, or the global body for securities regulators, had said that they're starting to look at what they can do, how they need to consider this, and what IOSCO's role might be in looking at ESG disclosure more broadly globally. So that is a massive step for the markets, I think, when the global body for financial regulators actually starts looking at these issues. From an investment perspective, smart beta using ESG factors for performance differentiation. I don't need to tell you more about that. Donna's already alluded to some of that, including the last point on integration, and she's given you some of the facts and figures around that. So those are some of the key trends that we've seen coming through. I hope sharing this helps you also in your journey to try and understand and look more at what these mean for your company. And then just to quickly move on to today, well, this is the JSE's approach. I'm not going to go into this because of the interest of time, but today's proceedings very quickly. You will notice the program is slightly different to what you've had in previous years. We're maintaining the showcase aspect, of course, and that would be the session 1 today. All our companies showcasing today are constituents of the Responsible Investment Top 30 Index. That's the FTSE Russell JSE Responsible Investment Top 30 Index. And those companies are going to be Santam, Anglo American, and Nedbank. We're very pleased to have them today and very proud to have them as constituents of the Top 30 Index. The second session, which is the after lunch session, is going to be the investor perspective, and this is perhaps some of the new stuff that we're bringing through. Today is really a combination of a year of conversations and trying to understand what companies are feeling, what investors are feeling, what stakeholders at large are saying. And there is a need to bring both perspectives into the room. And that is what we're trying to achieve today by having the investor panel. We have really, really good speakers on the panel today. I'm hoping that this is going to serve two things. It's going to help some of the investor community to see what other investors, part of the community, is doing, but also for issuers to be able to understand how investors perceive these things, and therefore how the information you put out, the communications you put out, is actually being used by investors. So I urge you to please stay the day, see this through, and I'm hoping it's going to really help give you a different perspective and hopefully a very valuable one when you continue this journey. And once again, thank you very much to everybody for your efforts and for being here. So that's my little speech. But I'm now to turn to what we're really here for today, which is to hear the companies speak. So that gives me great pleasure to introduce our first showcasing company. And this is a company that was voted #1 business insurer in the 2017 Sunday Times Best Brand Survey. It's one of the founding signatories of the UNEP-FI Principles for Sustainable Insurance, so it has been a leader globally in this regard. It's done amazing work through its Partnerships for Risk and Resilience program and supports resilience in municipalities, and is on track to reach 5 million people in 53 municipalities through disaster management interventions. This is a key example of how companies work together to both understand and mitigate some of the risks we're facing from a sustainability perspective. The work that they've done has been possible with the partnerships with the Department of Cooperative Governance and Traditional Affairs and the South African Special Risks Insurance Association. Santam, if you haven't guessed already, celebrated its 100th year birthday this year and joins the two centennials we have in the room, with Anglo American being the other one, and is the largest short-term insurer in Africa whose footprint has been expanded through the recent acquisition of the Sanlam Saham deal. And for the first time, Santam this year became a constituent of the FTSE JSE Responsible Investment Top 30 Index. Please, may we welcome Mr. Mohedi Dilotsole, the Exco Lead for Brand and Partnerships for Risk and Resilience at Santam.
Sorry. Thank you for that lovely introduction. Good morning, everybody. It's great to be here. Okay, I see my presentation is on. I see that the other two companies on the showcase panel are also centenarians. Congratulations. Yeah, well, you had to sneak that in, isn't it? Great. Just need to find my bearings here, so it's probably better. Might be better to do this. Okay, so my name, can you all hear me? Audible? I'm Mohedi Dilotsole. I'm the Chief Marketing Officer at Santam. For my sins, I'm responsible for a number of things, including driving through our market development area, initiatives that we have with government, the corporate, the Department of Cooperative Governance and Traditional Affairs. I look after a whole host of, is it not audible enough? Okay, of course, great. Great. Right. What I want to talk to you about, where do I point this? Where do I point this? Any direction. Ah, okay. Right. It's not going anywhere. How's that going to work? So will it work now? Okay. So you'll drive for me. Okay, good. So can you go back to the first slide, please? Before this one, great. No, after this one. Okay, it's going to be fun, I see. So what I want to talk to you about is, first, I just want to give you a glance of what's about Santam, about us. Secondly, I want to talk about, because we insurers, I want to talk about the impact of insurance losses and the trends that we're seeing and the impact on, that is coming from an environmental perspective. And then I'm going to talk about the strategic role of insuring sustainably. And lastly, I want to talk about the kind of things that we're thinking about looking ahead of our involvement in ESG initiatives and what we need to do to embed certain things in the way we currently operate as a business. So those are the four things that I want to talk about. Next slide, please. Okay, Santam at a glance. Next one. Okay. Who are we? We're a 100-year-old business. We celebrated 100 years in May this year. We're extremely proud of it. We're the leading short-term insurer with a market share of about 22.5%, and we have been for a considerable amount of time. Our business is split into a number of portfolios, 5 to be exact. The first and the largest of our businesses is what we call the Santam Commercial and Personal Business, which is what probably most people know and understand. We insure motor vehicles, we insure commercial properties and so forth. That's the heartland of our business. It's sold through intermediated business, but we also do have a direct channel that sits in there. We also have what probably most people don't know much about, a specialist business. It's probably one of our hidden gems. It plays an extremely critical role in actually driving development in South Africa. We insure large infrastructure projects. We insure mines, we insure commercial properties, large commercial properties. We've got engineering insurance, we've got aviation insurance, we've got marine insurance, we have got agri insurance. So it's a specialist area that plays a critical role in driving development in South Africa. There is no major infrastructure project that actually takes place in South Africa with Santam actually not being asked largely to quote on it. So it's a critical part of our business. We also own 100% of a company called MyWay that I'm sure all you guys are familiar with. It's a direct selling company. We also have a business called Santam Re. It's a reinsurance business. Reinsurance is a critical part in our value chain. We negotiate deals with reinsurers to make sure that when extreme catastrophe losses hit us, we're able to lean on them as well. But this business also performs a role for other intergroup companies to make sure that the reinsurance cover is well entrenched and it's reasonable and we covered. Through our relationship with our majority, with our shareholder, Sanlam, we also participate and have got access to more than 33 countries in Asia and the rest of Africa through the emerging markets business that they have. We've recently increased our shareholding in a company called Saham, which is a Moroccan-based insurer, a very, very capable insurance company, to 10%, and that gives us access to the entire francophone part of the continent, coming all the way down to Angola and to some of the East Africa countries as well. So that's how we operate as a business. In terms of is it working now? Is it? Okay. Right. In terms of our lines of business, this is how our business is split. At the end of 2017, our gross written premiums were about just under 30 billion rand. The bulk of the business comes, as you can see, from our commercial business, followed by personal business, and the rest of the businesses make the rest. The comparative number, as at the end of June this year, half-year number, was about 16 billion rand. Okay. From a geographic diversification point of view, the bulk of the business, as you can see, continues to be in South Africa, 82%. The rest of Africa is about 12%, and then the Southeast Asia, Middle East, and so forth is about 5%. And then let's just turn on then to think about, the insurance penetration in the continent. If we look at that chart, you can see that insurance penetration as a percentage of GDP probably averages on the life side about 4%. On the non-life side of things, which is us, short-term insurers, it averages at about 2.8%. That's very, very low. For us, it presents a challenge and an opportunity as well. In most instances, actually, the GDP growth rates of these countries far exceed the penetration of insurance. What this does and what this tells us is that there is a risk protection gap. So when disasters hit, it means that the bulk of our people across all these countries, South Africa is actually is the highest of the lot. Across all these countries are actually left without cover. They're left destitute, and they often have to turn to what you may call the insurer of last resort, which is the government. So it's not a pretty situation, but what it tells us is that as insurers, as participants in this financial services industry, there's an opportunity for us to change that and to do so sustainably. Okay. What we have observed over the last couple of years is the severe impact of weather-related events on insurance claims and losses. So I'm going to show you a couple of slides. And last year in 2017, you'll recall that we had the most devastating fires in South African history. And globally, even 2017 was a record year for insurance losses. If we start just with Santam, the Knysna fires and the Western Cape storms that occurred in June 2017 cost us in gross claims 823 million rand. It's a massive number. In Gauteng, towards the end of the year, it was actually on the 30th or 31st of December, there were severe thunderstorms, and they cost us gross claims of 1.1 billion rand. That's another massive number. So if we add up those, it's 1.9 billion rand that we took as a knock in the whole of 2017 from disaster or severe weather-related events. Globally, insured catastrophe losses reached an all-time high of 135 billion rands. The total losses that both insured and uninsured, reached 330 billion rand globally. Second only to the 354 billion rand reached in 2011, and that was as a result of the tsunami in Japan. And 97% of all these losses were weather-related. It's a significant change. If you don't believe that climate change is happening, well, I don't know where you've been for the last couple of years. So it is happening. So as an insurer, we had to take a step back and think about what is it? How do we respond? What is it that we're going to do? And we'll talk about that a little bit later. Okay. If we look at the impact of these catastrophes over time, per category, broken down into earthquakes, hail, flood, and fire, you can see the ramping up of the graph to the far right with the passage of time, 27 being the worst year. And what you'll also see is that the incidence of hail in particular, although 2017 was not so much a hail year, but hail over time, floods, and fire has increased significantly. That's the reality that we're dealing with. I want to read you a little bit of a quote. There's a guy called Maurice Talloch, who's the chairman of the global insurance business at Aviva, and also the chair of ClimateWise. And ClimateWise, for those who don't know, is a network that is convened by the University of Cambridge, the Institute for Sustainability of that university. And he says, our insurance sector will struggle to reduce the severe impact of losses and the protection gap if our response is limited only to avoiding rather than managing society's exposure to climate risk. Us as insurers, as risk managers and risk carriers, we have a significant and yet untapped potential to lead others in reducing this protection gap. If we move on, I did allude earlier to the fact that the majority of the losses that we see are uninsured. What you'll see also is that the volumes are rising. So the uninsured bit is the yellow bit. What you see is the comparison of the overall losses versus the uninsured losses. And the gap is increasing. So we're sitting with a societal challenge. So what do we do? let's turn on to the role of insuring sustainably, the strategic role. We believe that as insurers, we're strategically placed to deal with this challenge that we have. But before we get into how we deal with it strategically, let's perhaps just go back to what we see as sustainable insurance. And sustainable insurance for us is a strategic approach where all activities in the insurance value chain, including interactions with stakeholders, are done in a responsible, forward-looking way by identifying, assessing, managing, and monitoring risks and opportunities associated with ESG initiatives. For me, the key operative words here are it's a strategic approach, which means that it's embedded in the way your company strategy is set. And secondly, it is about all activities of the insurance value chain. So whether you look at underwriting, whether you look at claims, whether you look at your engagement with suppliers and what you procure from them and how they operate as suppliers to your business and how you engage with clients. You look at the entire insurance value chain. You look at reinsurance as well. You look at, and I'll talk about others. So it's across the entire value chain. We are faced with an opportunity as insurers. It's a really key role in society that we play, and we call it the triple role of insuring sustainably. There are three parts to this triangle. At the center of it, of course, it's about achieving the sustainable development challenges and opportunities. But if we turn our eyes to the left-hand side, it's firstly, if you look at the arrow, it's about understanding, preventing, reducing, and transferring risks. That's what we do. That's the value chain in which we operate. The first triangle, the yellow triangle on the left-hand side, says we've got a role to play as risk manager. And what we do there is that we proactively help to identify and prevent risks. We do assessments, we do studies. We understand the risks better than anybody else. And I'll talk a little bit about some of the work we're doing in our flagship programs. We do research. We've got a role to play there in the prevention of risks from occurring. And some of the work is firmly entrenched in that space. And the role that is pretty obvious in the blue bar is us as a risk carrier. So we charge a premium and we take over the risk. We carry the risk as an underwriter. Okay, it's a critical role. And it's about financial risk management. In the event of losses occurring, we pay. But how do we embed through underwriting practices? So the first one is about understanding the risks, potentially preventing them before they work. The second bit is about through our underwriting processes, how do we embed ESG principles? I'll chat about that later. Okay. And the last bit, which is we do collect cash, we invest it, we use asset managers to invest the cash on our behalf. Some of it is invested in equities, some of it is invested in fixed interest. In the nature of our business is that the bulk of it is invested in fixed interest. And we have to play a role in giving the asset managers the mandate to make sure that in the way they invest their money, they adopt ESG principles and responsible investing principles. We are probably not in the greatest of positions in terms of the number of assets that we manage relative to probably what you'd see from the life companies. Life companies manage billions and billions of rands. The funds that we manage are slightly less, but we still have a role to play in ensuring that the people that we entrust to manage our funds follow ESG principles. As you can see, there are over 30 trillion US dollar assets in the investment space, in the asset management space. And in the risk area space, there's 5 trillion US dollars worth of premiums that are collected globally. Okay, let's talk about the principles that we have adopted. And this is in line with the PSI. So The first one is about our own business strategies and operations. What the first principle is that we are embedding ESG principles and sustainable insurance principle in all our decision-making, environmental, social, governance issues related to insurance business. It is there. The second principle is about how we relate and how we operate with regard to our clients and business partners. And what we're saying there is that we will work with our clients and business partners to raise awareness of ESG issues. The third principle is that we will work with governments and regulators in driving ESG. And lastly, we will demonstrate accountability to the public in transparency. And transparency is becoming even more important. I'll talk about it a little bit later towards the end. It's about financial disclosures. So those are the principles that we've adopted. I'm going to talk a little bit before I get to our two flagship initiatives as Santam about our journey so far. And we're very proud of this journey that we've traveled since 2009. In 2009, we became the first South African insurer to participate in the Carbon Disclosure Project. In 2010, we funded research together with the CSIR and UCT to understand the barriers to climate risk, how we adapt at municipal level, and creating sustainability at that level. And that's, if you think about it, this research space is that first triangle that I spoke about. It's about how do we help prevent potential losses. In 2011, we conducted a landmark study called the Eden study, which we co-financed. And the outcomes of this study were resounding, and it's been quoted extensively. It is about the environment and how coastal four dunes, so the dunes in the coastal areas, play a role in reducing extreme weather-related events. These dunes were being destroyed, and they actually had to be rehabilitated. We are a PSI founding member and contributed to the creation of the principles that I spoke about earlier on. In 2011, we launched a Black Broker Development Program. What we also did together with the municipalities that we engaged on, we sponsored an early warning disaster system to help municipalities to become aware, have an early warning system when floods and extreme weather conditions were imminent. In 2015, we participated in the PSI Global Resilience Project and signed a statement for disaster risk management. And from a corporate operation point of view, sustainability became so important that we actually moved it from where it was straight into the CEO's office. It reports directly into the CEO's office. And she plays an active role. And from there on, we started seeing a bit of an impetus on the strategy. The board level participation increased, and we invested in a number of initiatives that I'll talk about towards the end as one of our flagship initiatives. And this year in 2018, we hosted at our premises just down the road here, the UNEFP PSI market event in April. And there are a couple of outcomes three particular outcomes that came out of there. And it's about one of the outcomes, just to not to get into too much detail, was about how do we help build resilience in municipalities and vulnerable communities. Okay, I want to talk now about our two flagship initiatives. The first one is in sustainable agriculture. As Santam, we are very, very proud to have in Bloemfontein what we call an experiential farm. We're the only insurer that has got this. And why and what we do in that farm is that we manage the risks, existing and potential risks, in creating sustainability in farming and food production. It's critical that as a country, we continue to feed ourselves, but do sustainably so. We actually partner with a couple of other institutions, the University of Cape Town. We also partner with Yale University in the US, and some of our people, agri people, and our sustainability people regularly go on exchange programs to do lectures on the learnings from South Africa. Let me tell you a little bit about this. So this is, we're the only insurer with a scientific, this is based on SARS, a scientific experiential farm that conducts very accurate, in-depth hail simulation research on crops to ensure that there is accurate damage assessments. The research entails specific analysis of crop damage. So if the hail strikes, the damage at different growth stages of our crops. This is something that is unique to South Africa's climate. And we do so to the unique soil and cultivars of South Africa. The research results enable us to differentiate between the various plant varieties that need to be introduced or that have been introduced, and how they recover from extreme weather conditions following physical damage from weather events. It is an excellent piece of work that we do in this particular space, and we're taking a lead and taking that knowledge beyond our shores. We also have an emerging farmer training program. In 2017, we collaborated with Grain South Africa in supporting about 3,000 farmers with the aim of advancing farmers, disadvantaged farmers from subsistence level to commercial level by strengthening their ability to improve the yield of their maize crops, also based on the research from the scientific farm that we have. We also, on top of that, because you can't just move from subsistence farming to commercial farming, we bring in our role as a financial services operator and provide consumer financial education and guidelines how they need to run effective commercial farms and make sure that the risks are insured accordingly. In KZN, we've got a farmers project with a company called TechnoServe. It started in 2016. We've developed agri-hubs. We offer technical support, and we expose farmers to markets and negotiate offtake agreements on their behalf. TechnoServe as a partner also offers these farmers 0% loans, revolving loans, so that they can get going. And lastly, on the farming side, we have got what we call the silage competition. So in 2017, we sponsored the National Agriculture Silage Competition, and the intention is to contribute towards the promotion of good silage practices. For those who don't know, silage is the production of animal feed using compacted maize, forage, sorghum, and then oats, all those things. And the reason for doing this is that if you produce good silage, if you come up through periods that we've just gone through in 2016, 27, where there were extreme drought events, there was no rain, there was no grazing to feed animals. You use the compacted silage to feed the animals, and we do scientific. We run the competition, and those who are able to produce scientifically the best compacted feeds win the competition. So we encourage farming in that regard and create sustainability. So that's one of our flagship projects. We're very, very, very proud of it. The second one is disaster risk resilience. And from a protection point of view and prevention point of view, we actually participated in a study. It has just been concluded, where we actually went back to the Knysna disasters, the Southern Cape disasters, to actually understand what happened there. And the results were astounding. Some of you might have heard of it, that, the fire was not as man-made as people say. The results are that because of the dry conditions in that area, there was a fire that started to smolder months before that disaster. Okay, months before the disaster. And with the dry condition and the massive wind that started actually in Cape Town and went all the way down to the Southern Cape, it actually served as an ignition for the massive fire disaster to take off. And with the dry conditions, it provided massive fuel to make that disaster into a catastrophe that it became. So we went back to understand the conditions. We worked with other partners to survey aerially through GIS and GPS the land, and we actually were able to come to the core of what needs to be, what caused the fire, and in future, what are the things that we need to watch out for. We started a few years ago what we call a business adopt a municipality initiative, which is something that we're extremely proud of. So we're partnering here with about 53 municipalities to reduce fire and risk in municipalities. We call this the Partnership for Risk and Resilience. We've got a whole team that actually focuses on this. On a day-to-day basis, they engage with municipalities. Municipalities, as we all know, are very vulnerable. Their financial stability is very precarious at this stage. What they do is we identify potential disaster areas arising from flood or fire. And what we do is we put disaster risk management programs. We help put disaster risk management programs in place. We've got a signed agreement with the Department of Cooperative Governance and Traditional Affairs. We're on the ground with them on a daily basis. We identify the most vulnerable societies. Sometimes the low-lying areas, like in the Vaal, there's a municipality called Sidibeng, when there's flooding and the water comes down, it crushes all those informal settlements and the people are left destitute. Yeah. Okay, so it's one of our key initiatives. We've also partnered with SASRIA to assist, who help assist. SASRIA, for those who don't know, is the state insurer, South African Special Risk Insurance Association. And they also have got a vested interest in these disasters because they are the insurer of last choice. When things happen, the government turns to them and say, you have to settle the claims. They also have to think about how they help reduce the exposure. Okay, we're hoping to impact about 5 million people by 2020. Looking ahead, I'm told I've got 3 minutes. Okay. We're looking to, together with the UNPSI, to integrate, and there's a paper that is currently doing the rounds, ESG in underwriting. This is still a gap. It's about how we integrate ESG criteria into the underwriting process. There's a paper that's been doing the rounds and we've participated in that paper, and that logically has to be the next step. You know, it's beyond the research. It's about how do we think when we underwrite about ESG practices. There's a document that will probably come out early next year. And the second thing is about financial disclosures. It's about how we make climate-wise or the climate risks more transparent to investors, and working with internal and external experts to deepen our understanding on how climate risks will affect our business forwarding, including, I mean, it comes probably in the top 10, if not higher. Well, in the top 10, but I'm not too sure exactly where it is. We've just done a risk assessment exercise as an exco. But climate risk and severe weather impact is one of the high risks that we have, because from a balance sheet point of view, it's a significant risk. 1.9 billion rand is not to be frowned on, and the reinsurers themselves are taking pain because if we lean on them too hard and we don't collectively try to manage this, you know, the insurance industry is not sustainable. Okay. Lastly, from a board perspective, I did mention before that we have got a group social ethics and sustainability committee. It has got the explicit responsibility of recommending all beyond just the ethics bit, but the ESG issues that have a significant impact on the organization and the company, and the stakeholders to the board for noting, for awareness, and for approval on the actions, remedial actions that need to be taken. All the material issues, obviously, we've got a management team that deals with the ongoing day-to-day material issues, but the mandate of the committee is to assist the board also in setting direction or for stakeholder relationships and how we approach from a king governance point of view. So it's more holistic, but ESG is embedded in the charter of the Social Ethics and Sustainability Committee. I think I will end there. Lastly, we as Santam see ourselves as more than just a short-term insurer. Yes, we underwrite, but like I painted that picture in our triangle, our road extends just beyond pure underwriting. We need to look about how we embed ESG in underwriting, but we do much more than just underwriting. You know, we're very proud to be included in the JSE's Responsible Investment Top Index. We rated very highly with our clients. Our Risk for Resilience flagship initiative is something that is very, very dear to our hearts. And what we want to do is to build a sustainable insurance environment and support the initiatives that are being driven globally. Thank you very much.
Okay. We'd like to open it up to the floor for any questions. Some of the key insights and takeaways I think we picked up there was about really using the core competencies of a company like an insurance company, which really is risk management, and using that to actually consider how they can better promote both mitigation and adaptation activities. And the other thing I picked up, of course, was clearly the role of governance again, and Professor King, you mentioned once more. But please, can we open it up to questions? Mohidi, if you could take some. Okay, 1, 2, and 3.
The graph that you had with, I think it was claims due to floods, was that adjusted for
Yes,
percentage?
Oh, sorry, Paul?
So percentage of the book. So for example, in 2000, there was $1 billion in premiums. And then in 2018, there was $30 of premiums paid.
So we adjusted it on a constant currency base.
Okay, so that was percent
constant
of premiums paid.
Yeah.
Not just on the currency, on the size of your book. So what I'm getting at it is, as your book grows,
yes,
then obviously the amount you pay out will increase.
Yes, it will.
So did you adjust for that?
I'm not too sure why. So because the comparative there is over the passage of time.
Yes.
Okay. The number of claims per category, whether it is hail or whether it is floods or whether it is fire, is on a constant currency basis, is X. I'm not too sure why you want to adjust it for the percentage of the book.
So basically, if your book grows, then obviously the amount you pay out grows, even if the currency is weighted at the same year.
Yeah.
So the more that your book grows, the higher the losses that will be paid out, even on a currency basis when it's weighted.
Okay, I need to think about that. Think about that.
Okay.
I'll just go back to the source and check whether we adjusted it for that. Okay.
Thank you.
Hi there, it's John Duncan at the back.
Yes, John.
I appreciate your comments on this. You did mention, I mean, there's obviously two sides to the equation here. There's the risk you carry and the changing nature of that risk as a consequence of sustainability. And then, of course, there's the impact that your investments have on furthering the risk that you're actually trying to underwrite. And so you mentioned earlier the sort of desire to integrate ESG issues into the way you invest, the premiums you collect. But I'm curious to hear your reflections on what's happening in the reinsurance market. I've seen Swiss Re and some of the other reinsurers have recently announced that they are going to benchmark their performance for their investments against ESG indices. Is that something you see as having a big impact on the insurance industry, both locally and globally?
I think it's inevitable. I think it's inevitable. We have to. So most of our assets are managed by, as you can guess, Sanlam Investments. And our investment committee constantly engages with them in terms of how the money is invested. We're very glad that they are a signatory and they subscribe to the principles of responsible investing. And it's something that we continue to put pressure on. It's significant. You saw the number globally, what it is. So we need to continue to put pressure on investment management companies and asset managers to invest responsibly. Okay.
Yeah. Morning, hi. This is Tinyaka from Eon Investment Management. This is a question to you, and I guess to all the other companies that are going to be presenting. Is Santam a UNPRI signatory? And if they are, what is your current UNPRI rating?
Yes, we are. Jitin? Sanlam.
Our investment managers that are...
Oh, you're talking principle of responsible investing. Okay. Yeah.
Yes,
not sustainable insurance. Yes. Okay.
Yeah. So Sanlam, our investment manager that manages our funds, is PRI signatory. I'm not sure what the exact what the figure is, but yeah, they are subscribed.
Yeah. So there's constant engagement that we're having with Sanlam in this regard. The extent of our book that the assets that we have, that we invest, is about 17 billion rand. Most of that money is invested in fixed interest. And you can understand why it's invested in fixed interest, because, the nature of our business. And then the rest, which is a very small percentage, about 1.4 billion, is invested in equities. So really it's the 1.4 billion, I think, that needs to be the focus on what we engage on with Sanlam. We believe we've got a role to play, but when we look at, especially other insurers, if you think about different type of insurers like life insurance, they've got a significant role, even more. They carry hundreds of billions of rands on their books. And significant chunks of those money actually sit in equity markets. And that's really where, the pressure needs to be put.
Thank you. Any other questions? Audience up. Thank you.
So I think you've got a lot of people from financial services industries sitting here listening today, and we also have to do some of these incorporation of ESG into our processes in various shapes or forms. But one of the challenges that we face, and I'd like your view on that, please, is given the current economic environment in South Africa, there's massive cost pressure on all financial services companies. And all of these additional things that are introduced on the same workforce with the same resources that are available. There's nothing additional going around. How do you guys manage containing costs, managing your current workforce with their sort of limited amount of time to do all of these things, especially in the current economic environment?
I guess you need to take a long-term view to it. And that's what we've done. And the long-term view, and we debate this quite often, is that there will be periods like we have now when, we're all under pressure. Margins perhaps are not as high as we want them to be. Profitability is lower or muted at best. But you need to take a long-term view in terms of how you want your organization to play in sustaining society going forward. Somebody has to play a role. And what we try and do is engage a lot with government. in understanding their priorities and understanding perhaps where are the challenges there, where they need help, because it's not always about financial help. It's about sometimes providing the necessary skills, and we do that a lot. So we are frugal about our costs. From time to time we also lean on is we lean on some of our partners. We've got a trust within our base. And the trust has got a particular mandate. So those are some of the things that you need to look at. Some of the initiatives that are driven through the Partnership for Risk and Resilience is driven through the Mthunzini Trust, which was set up as part of the BEE deal. So they've got a mandate to help vulnerable communities as well. So from time to time, we lean on them and say, from a funding perspective, can you assist us with X, Y, and Z? But the skills base we have kept constant regardless of whether we are under pressure or not. Does it help?
Okay, thank you. I think that's all we have time for, but if anyone has a really pressing, urgent question, we can take it. Okay,
thanks.
Thank you very much, Mahedi. I think we can put our hands together, please. Thank you. Thank you. Thank you very much, everyone, for your engagement on that. And we're going to shift slightly to another sector altogether. And again, moving from the one centennial to the other, our next showcasing company is really a household name globally, and it's also a recipient of numerous awards related to sustainability and reporting, and they've been a consistent top performer in the JSE ESG indices pretty much since the indices were incepted back in 2004. Anglo American is a globally diversified mining company with a portfolio of world-class competitive mining operations and undeveloped resources. In their own words, Anglo American provides the raw materials on which the world's developed and maturing economies depend, and does so in a way that not only generates sustainable returns for its shareholders, but also strives to make a real and lasting contribution to society. Today, they will share with us how they do this. And as they look to hopefully the next 100 years of their existence, we welcome Hermine Boertes, the Head of Sustainability Engagement at Anglo American.
Thank you for the invitation. Thank you.
Are you mic'd up?
No. Is that all right? Yeah. So I was saying, thank you for the invitation, and thank you for taking one for the team. Statistically speaking, I reckon if you fall, I'm less likely to fall. No, that's why I'm not gonna walk around. I'm gonna stand right here. I want to extend an apology from our South African CEO, Andile, who wanted to speak today and can't anymore. And that means that you're stuck with me. The good thing is that I'm well in tune with our sustainability performance. The bad thing is that I'm less clear on the investor narrative. I spend most of my time talking to NGOs. Feel free to ask any questions. If I can't answer them, I'll just make sure you speak to the right people at Anglo American. I'm going to skim through a little bit about who we are. I'm guessing most people are fairly familiar with Anglo American and our loyal investors. But to recap, diamonds, copper, platinum, iron ore, coal, and nickel is our current portfolio and has been for some time. We, in entering our 101st year at Anglo American, have come to reimagine what we stand for as a company. And it sounds, so our purpose is to reimagine mining to improve people's lives. And that can sound a little bit trite. I have to say I cringe a little bit when I see it, because it seems so, it seems quite emotional. And actually it's not. We spent a huge amount of time coming up with this. And it's got its root in two very logical things. Number one, there was a massive employee engagement survey at Anglo American. And that was with all connected employees, as well as focus group with operational personnel.
And it was very clear that they want to work for a company that has a purpose beyond a profit motive. The second thing is that probably more so than most industries, our license to operate rests in the hands of communities. And I'll talk a little bit about that later on. Our strategy, 3 focus areas: portfolio, innovation, and people, world-class long life assets in a diversified portfolio with growth options and sustainable cash flow and returns. The innovation piece I'm going to talk about as well, we title it Future Smart. It's got a technical innovation component to sustainability strategy and the implementation of our operating model. There's also a component there that is an increased focus on our marketing business. And then the third is people inside the business and outside the business, an inclusive high performance culture. The other piece is the recognition that we need to work with all stakeholders to achieve our business objectives. This strategy is measured by the 7 pillars of value. And these are, as you see, a cross-section of different parts of the business, including SHE and community aspects. Our CEO gets a report on these every 2 months. He questions every little bit in absolute detail and uses it as his own scorecard to the board. A lot of indicators within the 7 pillars of value actually is included in remuneration. So my bonus, 25% of it depends on how we meet greenhouse gas targets, our safety objectives, and social political elements, as well as environmental incidents, reduction of environmental incidents. So it's taken incredibly seriously. A little bit on our global footprint. There's still a huge amount of activity in South Africa, which Anglo American has made it clear that we're proud of. Moving into the sustainability aspects, we say upfront, no matter what we do or where we speak, that safety is our #1 priority. We are proud of some of the progress that we've made over years. That said, we lost 5 colleagues this year. It's a reduction on last year where there were 9, and certainly a reduction on prior years where it was in the double digits. And we must also recognize that our injury frequency rates have gone down quite a bit. We've recently gone to 1 million hours reporting. So those of you who track our performance might not be familiar with these figures, but we are now well below what is considered international best practice in injury rates. That's not where we want to be. We want to be at absolutely 0. And our narrative on safety for quite some time has been 0 harm's a journey. And we got the very clear message this year, to an extent last year, that absolutely nothing other than 0 harm is acceptable. And it's not a journey, it has to happen right now. And as a consequence, we've launched a few new programs. So we're strengthening our risk management program, and we've got an elimination of fatalities task force that is really trying to get to the root of these issues. Because it's getting more complicated, we've dealt with a lot of the technical issues. We've got netting, we've got roof bolting, we've sorted out some of the transportation risks that we have. What we're seeing now are traditionally non-mining type incidents that are more difficult to predict. So we're trying to get our heads around that, and a lot of it's got to do with our organizational culture and with organizational behaviors. So I talked earlier on about our innovation program, and this is one of the key ways in which we're going to be reinventing Anglo American. Our innovation program started off with a series of open forums, and that was, they've been on water, on energy, on mining, on processing, and then the future of mining as well. What we did is we got together just a few Anglo American experts as well, together with experts from across many different fields. So you had some suppliers, you had Google, you have a whole bunch of people trying to get around solving various issues. From then, we have a rapid development approach. We want to fail or succeed very quickly. And this program essentially needs to deal with the problem of low ore grades. On top of that, the safety challenges that we have, the amount of energy and water we consume, and the amount of waste that we produce. So mining at the core of it is about breaking big rocks and turning them into small rocks, and then taking the precious resources from those small rocks. And just that process right over there is where we consume almost all of our energy and almost all of our water, and has almost all of the impact on how much waste we produce. So some of the technologies that we are working on are the more efficient breaking of rock, and the trials at the moment, we're seeing a 30% absolute saving in energy just from changing the way that we break rock. Optimizing particle sizes means that it's easier for us to extract the resources that we want to from those particles. It also means that we're able to store, we don't have to store as much waste, and we can recycle the water that comes from there. So your usual slimes dam is really like a lake of talcum powder with water in it. It's incredibly difficult to extract the water from there. If we have a larger size particle, we can extract the water from that and recycle up to 80% of it. So that is coarse particle flotation. We've got some stuff that's a little bit further out too, and our ambition is great. We want mines to look absolutely nothing like they look now. We want them to be barely noticeable, and we do that through precision mining. And one of the things that we're working on is called swarm robotic mining, which sounds quite fancy, but they're little robots that look like Wall-E from the cartoon. And what they can do is go into seams that people can't go into and shouldn't really from a safety point of view, and with precision extract the ore that we want to mine, and therefore leave all the stuff down there where we don't, if we don't have to bring it up. And this is just a little bit about the Innovation Development Program. And we've consolidated all the stuff that I've been talking about now into the modern mine, the waterless mine, the concentrated mine, and the intelligent mine. So I've skimmed over quite a bit, but a big part of this is actually just catch up. Mining has been way behind on digitization, and we're putting quite a bit of resources into getting our mines more modern. Not in the slides, but we've obviously come to the conclusion that with this type of innovation, we need licenses to operate. The one license is permitting, so we need to make sure that the governments and the regulators are comfortable with us doing this stuff, because we're trialing new things all the time on mines. And the other really difficult part of it is that this will change our value proposition to stakeholders. There's a wonderful investment case. Our investors clearly will love the productivity gains that come out of there, and the environmental community will love that we use so much less water and energy and emit fewer greenhouse gases. There's a different side of it too. So the more you automate, in the short term, the fewer people you employ. The fewer people you employ, the lower your tax bill is to the government. And those two things have been our value proposition to governments and to communities for a very long time: employment and taxes. And in particular in South Africa, where we employ a large number of people, or low-skilled people, who might not easily find employment elsewhere, and that's obviously a very attractive proposition to the government. And on top of that, some of the alternatives, especially in the rural areas that we operate in, are also automating. So the agricultural industry would be an obvious example. We also think there's huge opportunity in all of this, but we haven't got our heads around exactly what that looks like yet. And one of the biggest programs I'm working on is what we call the social license to innovate, to make sure that we understand our current value proposition for stakeholders, how that might change as we are currently automating right now, and what might come into the future, and how we can turn that all into a positive. We're already starting to talk to universities and technical colleges about the skills that we will need in 10 years' time, because we know they're going to look nothing like the skills that we need right now. We don't have the answers, though. If anyone's got any bright ideas, let me know. Right, onto our sustainability strategy. I'm going to stick on this slide because I'll talk a little bit about our performance as I talk about what our targets are here. We released this at the beginning of this year, and this was following consultation internally. We spoke to over 600 people inside the business, outside the business. And what we've come up with is something I think you quite intuitively would expect. At the bottom is the critical foundations. critical foundations are things that we absolutely have to do and we have to get 100% right. It doesn't mean that they're easy. There's leadership and culture, zero harm I've spoken about. It's not just safety, it's also occupational health and health within communities. So amazing work on HIV/AIDS fits into that. Let me pause quickly there to say that we've signed up to the UN's 1990 targets. For those who don't know what that means, it is 90% of people being tested, 90% of people being put on treatment immediately, and then 90% undetectable viral load. The rationale there is that the moment someone goes onto treatment and their viral load is suppressed, they cannot pass on the disease. So in theory, if we achieve the 90-90-90, we could halt the spread of HIV/AIDS. That coupled with our TV program has meant that the number of employees at Anglo American who die every year from HIV, or from AIDS rather, has gone down from the hundreds to something like 5 last year. And that's a major achievement, incredibly difficult to do. I must say that some of our figures are skewed by the divestment of the Rustenburg operations, but that does not account for even nearly the kind of impact that we've made. And you can imagine the productivity gain that we get out of that too when people are healthy. The second is on human rights. We're getting a huge amount of pressure on improving our human rights performance. So a lot of this is about legal compliance. That's not the issue over here. There are things over and above that. There is due diligence on human rights. There is making sure that we've got grievance mechanisms locally so that if something goes wrong, people can report it and we can sort it out. This is obviously massively in our interest because understanding issues before they get out of hand is incredibly helpful. Inclusion and diversity, we've got our group standards and then compliance with legal requirements. Now moving up to the slightly more interesting stuff. We have our global stretch goals, and I'll go into the details about that now. And those really are trying to get us into a step change space. It's not just less bad, we're trying to completely change the way people see mining. And then the next piece is collaborative regional development on your right-hand side. And on top of that, the overall objectives to become a trusted corporate leader, thriving communities, and healthy environment. So let me take a step back to that collaborative regional development, where we also have a partnership with Technoserve. The concerns in our communities are of the nature and extent that Anglo American alone could not possibly even attempt to deal with them. I was talking earlier on about, outside of this, about what we're dealing with in the platinum business right now. We've got protests at our doorstep every week by people who don't feel like they're getting not just the benefits from mining, that aren't getting the benefits at all from government, I guess. They don't have access to water, they don't have access to electricity. And since we are there, and since we are the beacons of money and employment in those regions where there's absolutely nothing else, we are the natural targets for people who are desperate and who aren't seeing those benefits from mining. This is, in my view, one of the biggest business risks that we have. It is a risk to operational continuity. It means that people don't want to work in those areas. You know, these are geologists and miners. They signed up for breaking rock. They didn't sign up for the really complex human issues that these are. And in fact, we're quite comfortable with all of you'll see the more technical targets that we have. When we consulted on it, our engineer said, you know, 30% reduction, that's a lot, but I reckon I could do it. The human stuff is incredibly difficult. So the reason I'm mentioning that is because we've got this collaborative regional development program. The first pilot was in Limpopo, where we looked at every data set that we could get, and we referenced it spatially. So we overlaid socioeconomic data, we looked at current rainfall, we looked at future rainfall, we looked at soil viability, we looked at education levels. If we could find the data, we put it all on, we layered all of it. On that basis, we tried to identify what were the big systemic issues or the big systemic opportunities that we could contribute to in the province. Once we'd established that, we went to government, we went to other companies, we went to a whole range of NGOs to get their input and their buy-in on collaborating with us on these matters. We now have a backbone organization in place, and a key stakeholder there, or one of the key leads, is the Premier's office in Limpopo. And we've been going at this now for 4 years. And the idea is to pool resources and pool efforts, because no single company can do this on their own, and we're all dealing with exactly the same issues. This model is going to be rolled out in Peru, in Brazil, Mpumalanga region, wherever it is that we have a footprint, and has the social challenges that we have in Limpopo. The stretch goals, I'm going to flick across quickly. This one sounds a bit random, this trusted corporate leader one, but the reason that it's here is because we need to change our relationship with local communities in particular, and more broadly. So I'm standing here now talking to you, and in some respects kind of easy. I think you understand us, you understand the issues that we face. I also spend most of my time talking to civil society, grassroots NGOs. It's a very different conversation. They don't trust us. And I often, I get why. Some of it's misinformation. It's often not felt. And partly because there's a legacy that we can't pretend isn't there, legacy in South Africa, legacy associated with mining. So we almost operate at a trust deficit, as you spoke about. We don't like saying so, it's true. Building trust has to be the foundation of everything that we do at Anglo American, because without that, all the positive impact that we might have doesn't get the kind of recognition or traction that it needs to. So these are split into policy advocacy, ethical value chains, and that's about making sure that we are ethical suppliers to our customers, and that we buy from ethical suppliers. The next ones that are a little bit more tangible, these are the visions, okay? So the vision is a little bit different to the actual targets. On livelihoods, our target is to create 5 jobs off-site for every job on-site, and not within mining value chains. We need to decouple dependency, local dependency, from mining, and that has the benefit of getting rid of some of the pressures that I was talking about just now. It also has the benefit of creating economies that can be sustained past mine closure. The second one is education, and ultimately by 2030, we want to make sure that schools in our mining communities, and we've chosen 100, that's a lot of the schools in our mining communities, operate within the top 20% of state schools in South Africa. Again, aside from huge moral imperative around this, the reasoning is that the more educated people are, the less they want to work in mining. No. The more educated people are, the less they're dependent on working in mining, the less people rush to mining regions, the more they can participate in other sectors of the economy. And ultimately, that's what we want. We also want locally people to, we also want to employ people locally. And knowing that we're going to need different skill sets, we won't be able to employ locally if people don't have the education to support it. So the rationale behind that over there. And then finally, health and well-being. In particular in South Africa, the areas that we operated in are very poorly served when it comes to public health. That has an impact on our workforce. It's got an impact on the well-being of the communities that people come from. The goal is kind of hectic. We want to make sure the SDGs for health are met, well, the ones that are relevant to the regions are met within the regions that we operate in. And this again will be a huge partnership initiative. What we're busy with right now is in studies with academics to understand what the baseline situation is with health in those regions. Our HIV/AIDS program, though, demonstrates that companies, in our case, Anglo American, can have a huge impact on things like HIV/AIDS. Again, in partnership, we won't foot the bill for this ourselves. The environmental ones, climate change, we want to reduce our absolute greenhouse gas emissions by 30% and improve energy efficiency by 30% by 2030. Biodiversity, delivering a net positive impact for new mines. So obviously there's we have to rehabilitate the mines that we've got currently. From this point onwards though, anything that we develop will have not a negative impact, will have a positive impact on biodiversity. And this sounds, again, quite ambitious, and it is, but I don't know if anyone saw the UN statement over the weekend. I think it came out on Friday on biodiversity loss globally. The issue is as pronounced as climate change is. If we don't act now, the biodiversity loss the extent of biodiversity loss is going to have exactly the same impact as climate change. Water, it's a 30% reduction in new water consumption, and ultimately we believe we can operate waterless mines in the future. By waterless, we actually mean you take water in once and then it sloshes around in operation for however long. There's a huge business incentive over here. We're seeing in Chile, some of our peers aren't getting their water licenses renewed. The government's saying desalinate or you simply don't use it. And in the context of climate change, if we prepare right now for operations that don't need water, we'll be well positioned in the future where this is clearly going to become an issue. Okay, I'm going to go a little bit into performance. I think this is quite an important picture. We've gotten a lot of criticism lately. You might be familiar with the Benchmarks Foundation talking about our value distribution to society. And the case they made is CSI makes up such a small proportion of our contribution. It's almost laughable in the context of what's given to shareholders. And that's not fair. Our contribution in terms of suppliers and employees, company taxes, is tremendous. I have to say at the same time that it's not like we don't get anything back for them, right? You know, we're getting people working, we're getting our license to operate. But we do those things in a way that adds maximum value, in this case to South Africa and to other countries. So our local procurement is a massive percentage of our supplier expenditure. There's local employment, there's preferential employment that changes that discussion a little bit. It's not just about hiring people, it's about hiring people, upskilling them, and empowering people locally. I'm not going to go into this in a great deal of detail because it talks about our approach to community development and engagement. So we've got the social way, and then we also have the socioeconomic assessment toolbox, which is global best practice in understanding the socioeconomic circumstances in which we operate and putting plans in place to address some of the risks attached to that and then maximize some of the positive impacts. I've spoken about our response to HIV and TB. What I didn't mention is that mining, which used to be known as a contributor to the TB epidemic, given the proximity of people, given migrant labor, our TB incident rate now is substantially lower, even in the platinum business, which has kind of got the highest risks attached to it than the national average because of the programs that we have in place at Anglo American. Zamele is a really good example and a long-standing example of Anglo American's commitment to supporting suppliers. And since 2008, we've managed to create 120,000 jobs in South Africa and support 65,000 SMEs. Our current climate change our current energy target is an 8% reduction off a business as usual projection, and climate change, greenhouse gas emissions is at 22%. We're hitting those targets, but as everyone likes to point out, they're not absolute targets at this stage. So we're making those reductions. We understand more of the technology now. It's going to be quite a a step change to get to that absolute 30% reduction that I was talking about earlier on. That's it, mostly through that technology program that I was talking about. We think we can do it. Water, I've got not much to add, and that's it. Thank you. I'm not even going to approach it.
Thank you so much for sharing.
My pleasure.
That. I think some of the key insights that we took from there, I certainly took away, was firstly definitely about the quantification and understanding of environmental and social goods directly related to business,
Sure.
and seeing how that translates into performance, as well as being able to manage those things in a better way. I think the flip side of that, of course, is innovation, because we're seeing a lot of, oh, sorry, Portia, thank you. The flip side, of course, is innovation, because it's then the opportunity to create new technologies, which of course then can be global in impact,
yeah,
and help across the spectrum in different industries as well. The other thing, of course, was about the linking of ESG performance to remuneration, which is something I think important, and it was interesting to see your example, and you spoke about your own bonus being linked directly to your performance targets in relation to ESG,
yeah,
which I think is fascinating, and of course the direct link between health and productivity. Because I think we know this intuitively, but actually that you're able to see that and quantify it is fascinating. Okay, so we can hand over to audience for questions, please. I'll leave this here.
Hermine, thank you for your presentation. I'm also work in the mining industry, part of the gold mining industry, and everything you say is very close to every mining company's heart, if I can say that.
Yeah.
I found your collaborative regional development program very interesting. I think we all sort of have something like that. But do you see mining companies coming together? I know we've got SLPs and we've got all of those sorts of things, and we almost decentralized, but we have got the same issues or the same objectives. Do you ever see that mining companies can come together? And I know it might be difficult because you've got different shareholders, different boards, different you've got bureaucratic sort of problems, but can you see a sort of South African mining solution for making mining better? Do you see that?
Yeah, I do. I think that's exactly what we want. There are policy issues that get in the way. SLPs and things like the mining charter actually incentivize us not to work together. So we're having those conversations with governments to explain that this is what we're trying to achieve, that we have to do it together, and they absolutely get it. Now we just need to think through on a practical level how they pull us together as opposed to incentivize us to work separately. So absolutely, I do see mining companies working together. We have these conversations all the time at the Minerals Council meeting. There's a step that needs to be taken now to get there. Although that said, again, in some of my conversations with NGOs, they said to me, whoa, Anglo-American, you don't have to do it on your own. It's not just you and the mining companies. In fact, that sounds a bit arrogant. So it's us as well as the NGOs, as well as government.
Hi, Herman. Over here.
Oh, sorry, I was waving at a friend.
Sorry, I just grabbed the mic from the lady next to me. I'm also in the mining industry as well, and obviously companies like Anglo-American and Kumba and so forth are at the forefront of modernization and automizing. And I want to find out from you, what's been the most difficult challenge that you guys have come across in terms of integrating all this new technology, especially with a sector like ours that's so reliant on, or that's got so many people that are largely unskilled labor. What sort of challenges have you had? And also, second part of it, we operate mostly, optimization is easier in open cast mines. Have you had any success in maybe implementing this into deep level underground mining?
So we've had plenty of challenges, and the challenges are the conversations with unions and government around job losses. What we have found is that they get it completely. They're not blind. They understand that for the sake of productivity and for continued investment in mining in South Africa, this has to happen. What they have said to us very clearly is make us part of that conversation. And let's plan together about how we can mitigate those impacts. In some cases, it has prevented us from implementing technology. There are mines where we could probably have automated more, but because that social contract isn't in place, we've not been able to go ahead quite yet. Not that we won't, but we need to do it in a way that's palatable for the government and for unions, because obviously they also give us a license to operate, and there's a moral component there too. Yeah, open cast far easier. We've done some retrofitting in the deep level mines. There's not a lot that you can do. You know, it doesn't make sense to put new technology down there. It was designed for something completely different. But for things like the Venetia underground projects and some of the new things that we've got under development, there's definitely going to be automation there, and automation that we can discuss with government and unions in advance while we go along, so that there isn't a mismatch in expectations.
Hi, this is Machiba from the PIC. I wanted to ask two questions. Thank you for telling us that your bonus is linked to the performance of your non-financial indicators, and I just wanted you to let us know if that applies to your senior management and your executives as well. And I'm assuming if there's no performance there, then it's not awarded. And then the second question is around the land issue. I don't think that we've heard from the mining sector much about the position on the land question. I don't want to call it the land crisis, the land question currently in South Africa. We tend to hear a lot from the banking sector, but what would Anglo-Americans' contribution to be to this debate? Thanks.
Thanks for the question. So yes, that applies to me and to my executives, the remuneration. The actual bonuses depend on, you know, some of them are positive incentive and some of them are negative incentive. But if we do not meet our targets, we do not get that bonus component. It's that simple. There's no room for maneuver. On the land issue, I think, yeah, it's got a lot of people a bit spooked. But we also think that we've got a positive contribution to make. So mining has a lot of land, and we only use something, I think it's something like 12% of it is actually being mined or there's infrastructure on it. Some of the other land is under conservation, and some that we need as a buffer zone. But there's a huge amount that we could be used more effectively, and we've actually done a land audit to understand what we have and what it might be used for in the future. So, you know, going a little bit beyond the conversation right now about you know, without compensation and all of that, we could proactively do things to make sure that land is used more equitably.
Thank you. My name is Achieng, for those who don't know me, from the Global Compact Network, South Africa. I think the issue, and mine is a comment, not necessarily a question. The issue of risk, the previous gentleman talked about weather-related risks, changes and risk. And I think the one that is really coming through since morning is the trust deficit as a risk to business right now. And I think it's something that we are going to have to do together. And we have the SDGs as sort of the common language that is currently being used by both business and government to try and collaborate for positive things in society. So I just wanted to say that we have an opportunity similar to what we have seen come through the Jobs Summit, come through the Investment Summit, that next year South Africa as a country will report on the country's performance on the SDGs. So the presidency has volunteered that we report as a country next year. What they've asked us as the Global Compact Network South Africa is to consolidate private sector voices and good practices, including, of course, the challenges that we are still experiencing when it comes to ESG issues. So I just want to make a request that let's work together on this and try and elevate the good practices that we are doing as individual companies, as industry, across industry sectors, and as business in South Africa and as South Africa Inc. So this report happens in New York in July next year. So we're gonna be running a very intensive process to try and reach out to you to pick on your performance and your data on what we are doing jointly as a country. So I think it's an opportunity for us to use to try and up, even at a global level, try to prop up what our reputation is as companies, as a country, and to also begin to showcase that there is collaboration between business and government in the way we communicate our ESG performance. Thank you.
Hi, just a similar question to the one posed to Mr. Dilototle. Are you a UNPRI signatory? And if so, what is your UNPRI rating? And just could you please elaborate further on any challenges that you have experienced with regards to ESG integration into Anglo's business model?
So yes, we support the principles. I don't know what the rating is. I can find out for you. And yeah, there have been plenty of challenges in the ESG space. I think that it's taken a bit of time for the whole business to gain an appreciation of the business risks and opportunities attached to environmental, social, and governance issues. I think the investment community has done a really good job lately at making sure that our investor relations guys get it, and they certainly do. We struggle with the extent of the requirements. So I'm going to say the R word, reporting. We find that we are expected to do so much, and that not all of it is particularly material for our business, that it tends to muddy the message a little bit. To really have an impact and to manage our key risks, we need to focus on those key risks and not be diverted by things that have a degree of importance, but really we've got major societal issues to deal with, and they can sometimes distract. Is that all right?
Hi, can you give us some idea how much of your mining spend is actually spent on mine rehabilitation in general? Number two, I think Anglo American committed about 71 billion rand last week to infrastructure spend in South Africa. How much of that pertains to Anglo Plat's Mogalakwena project? And thirdly, can you give us some idea about the challenges involved in incorporating local communities in mining? Because I assume we do use a lot of the local labor force in the mines. Can you give some idea about the challenges involved in doing that, please?
Sure, I'm going to start the one that's easier for me first, and that's about challenges incorporating local communities in mining. And the biggest one is skills. We have a limited number of skills, jobs that don't need higher level skills. And we also have fitness for work examinations. You know, you can't go and work underground or wherever else it is unless you have the physical ability to do so. And that's important from a health and safety point of view. We can't waive that. And some people just don't pass those. And I found it fascinating that there's some communities, actually, there's a high percentage of people who don't pass those exams. So there's those practical aspects of it that are very real. The biggest problem is that we just don't have enough jobs to meet the demand that there is locally. Rehabilitation expenditure is in line with legal requirements. So it's in our sustainability report, I think it's like $365 million. Again, very glad to just get back to you to make sure I've got the right figure. And then when it comes to the investment, I can't give you the breakdown. Again, I'll get back to you on that when I can.
Hi. you painted a picture at the beginning of operations under siege. I'm referring now to these weekly protests. I know you were not exaggerating, that's true. But what I didn't hear was how you are adapting, adjusting, what are you doing to mitigate this? What's the thinking? It's like you go through that and that's how it's going to be.
Yeah.
But I didn't get a sense of, how's the future going to be like? Is this going to obtain forever? Thank you.
Yeah, thanks for that question. No, absolutely, it can't go on that way. It's not just our mining operations we're worried about. That there are underlying issues here that we can simply not ignore because they have the opportunity to ignite. So the first thing that we do is make sure that our operational and security personnel have the skills to deal with conflict situations and that they aren't harmed and that they don't harm anyone else. First thing. The next thing is that we're stepping up engagement and consultation with those community members. We have to be careful because just carrying on having conversations is frustrating when we can't do anything about it. And there's some risk to our employees as well. The biggest thing is working with government to deal with the underlying socioeconomic issues that are resulting in those protests in the first place, and that's going to be a long journey.
I think a sincere thanks for quite an insightful and I think honest and sincere view and account of what you're experiencing in that industry, which I think is always helpful. We appreciate that. Thank you. So we're on track for a tea break. So just before I do that, some housekeeping, which I didn't do at the beginning, which I'm going to be wrapped over the knuckles for. Safety briefing. The emergency exit is through the main entrance, which you would have come in through most likely, straight out the building to the right. And so it's the open area right in front of the main entrance to the JSE if there is an emergency evacuation. Toilets are just behind the main reception area, slightly to the left near the turnstiles if you need to go to the toilets. For everyone that's been asking, the program is in your pocket if you haven't seen it already. I know you're probably wondering, what are they going on about? You have no idea what's happening next, but the program is in your pocket right in front of you. So please have a look at those. Just a quick reminder, there are feedback forms in the folders that are on your chair. If you could please help us with being able to just assess the speakers and sharing and any other comments and insights you might have. They'll literally take you 1 second per speaker to please tick the form if you can. And with that, please, tea served just outside. Help yourselves. To help us please keep on track, we're scheduled to be back and start at 11:25. We'll see you back then. Thank you.
Comment se fait-il que tu sois dressé aussi? Austère. Je ne suis pas austère. If you change your point of view,
Maybe sometimes I will translate it over.
Can they hear me there? Mr. Yusuf? Can they hear us outside? Okay. Could we please ask everybody to please make their way back in? We want to commence the next session. Thank you. Okay. Okay. I'm just going to start. Was it your mere presence? We didn't meet properly. No, Mokeli. Thank you so much for being here. Welcome back, everybody. I hope you enjoyed the tea break. And given your reluctance to come back, I hope that means there's some good networking and great conversations going on. And I'm sure that some of our presenters have spurred great ideas and opportunities for innovation. But part of our audience today also includes many of our JSE listed companies. And as part of the value that we continually strive to add to you as part of our very, very important constituency of the JSE, we have over time developed a number of offerings via our company services team. So it gives me great pleasure today to welcome our effervescent company services manager, Carol Crozier, who will share some of these with you and will emphasize in particular some of those trainings and offerings that we have in relation to ESG and governance. Carol?
Thank you so much. My name is Carol Crozier. I am the manager of company services here at the JSE. So I'm really just going to give you a very brief overview of what we're doing in terms of the JSE stakeholders that we're dealing with. But before we start, this morning I was thinking about ESG and sustainability and long-term investment. So I had a look at my portfolio. I had a look at all the long-term investments that I've made over the years, and sadly realized that those were just the short-term ones that didn't work out. So, which was not a great start to my day. But anyway, so really just to give you a brief overview of what we've been doing. We've got three primary areas that we focused on. We started this 4.5 years ago. We launched the JSE Training Academy, and I'll go into that into a bit of detail. Then we've looked at the venue, the JSE venue, as well as the offerings that we've put together in terms of investor relations and company secretaries. So just to expand a little bit on the JSE Training Academy. Last year, in conjunction with Shamila, we launched training on ESG trends. We've also looked at the FTSE JSE Responsible Index training, focusing on client-specific themes. And recently, we've started focusing a lot more on boards and what we can do in that space. So there's the Social and Ethics Committee training that we provide. Board training focusing on topics such as market abuse and insider trading, obviously very, very hot topics at the moment. Listing and continuing obligations is a prime space that we focus on, and we partnered with a woman named Marion Gaylard, who is an industry expert in the space. We also offer investor relations training, and that's really about how to develop a compelling investment case. Really speaking to your current investors and how to attract new investors. When we launched it, we also looked at how it is that you're communicating with your investors, and one of those spaces is the media. So we've got financial media and presentation skills training, and then over probably about two years ago, we focused on the company secretary space, and we really look at what's very topical and what we can offer from a company secretary perspective. This year, we launched corporate finance training, so looking at mergers and acquisitions, corporate funding strategies. And then about 2 months ago, we were hugely excited. We launched the AGM administration services products. And what we've done there is we've partnered with a company called TMS, and we are able to now run your AGMs from beginning to end. And what's exciting about that is we've obviously got the venues here at the JSE. We've got the space that we're in at the moment. We've got our stunning auditorium on the other side. And then we've got a lot of different types of breakaway rooms throughout the JSE. So don't think that you have to have a huge event to be able to host here. We would love to be able to host any of your events here at the JSE. 2 years ago, we opened up the JSE Cape Town office. So that's based in Claremont. We really did that because we wanted to be close to the asset managers and create a space for you to have those kind of engagements there. One exciting aspect behind the venue here at the JSE is that we offer an opportunity to come through and open the market. It really is a very fun morning. We do a countdown to 9 o'clock, and it's a fantastic opportunity for you to really market your company, celebrate a milestone. So please remember that as an offering. What I will do is put brochures at reception. So as you leave, if you'd like more information on either the training, the venue, the AGM services, please don't hesitate just to grab one and contact myself or one of the team. So excellent. Thank you so much. I hope you have a wonderful rest of the day, and I look forward to engaging with you in the next break. Thanks. Thanks, Shamila.
Thank you. Thank you, Carol. So please forgive me because I need to read the next section because there's just too many accolades here for me to have to remember by myself. So ladies and gentlemen, the time has come to introduce you to our final showcasing company of the day. No doubt you all know the Green Bank and must be aware that they've been pioneers in relation to sustainability in many ways over many, many years. But did you know that at the 16th Annual Oliver Empowerment Awards, they won the 2017 Legend of Empowerment and Transformation Award, which recognized Nedbank as a top empowered company for the 2016 financial year in the financial services sector. This comes after they retained the externally verified level 2 triple BEE rating for the 8th consecutive year. In 2018, at the International Banker Awards, they were rated the best corporate bank in South Africa. And as if excellence in banking was not enough, their sustainability credentials include being Africa's first carbon neutral financial organization and have been carbon neutral since 2010. In the South African Carbon Disclosure Project Index for 2017, they scored an A for performance, one of only 106 companies in the world to be awarded an A for climate change, a score which recognizes their corporate environmental action on climate change and the governance related to this. It's like at school, when you always get that one kid who takes all the awards. It feels like Nedbank might be that for the sector. A consistent top performer in JSE ESG Index series, I'm pleased to welcome Nedbank Limited, represented by their Group Head of Investor Relations, Mr. Alfred Versace.
Thank you, ladies and gentlemen. Thank you very much for inviting us, and thank you for those kind words. I think you've covered a lot of the stuff that I'm actually going to present. But we are very proud of our journey, and we're very grateful to share some of our insights here today. I'm from Investor Relations, so we're at the coalface when we engage with our investors on matters of ESG. So I'm not a technical expert, and my presentation is not intended to cover all the aspects thereof, and therefore I've invited Brigitte Burnett, our Head of Sustainability, to answer all those difficult questions that you guys may have. But just to start off, to say that probably in the last 12 to 18 months, we've seen a significant increase in investors wanting to engage with us on these matters. And I think that will just accelerate over the next few years. So on the agenda today, I'm just going to take you guys a little bit through our ESG journey. And although we've had all these accolades, there's also been some difficult times, and I think learnings that made us what we are today. I will then talk a little bit about the E and the S side and how we actually incorporate that in our business strategy. This is not something that sits outside. We incorporate it in our products, our services, our operations, and in the partnerships that we do have. And then lastly, I'm just going to cover a little bit on governance as well, the G and the ESG, and share with you some learnings and things that have been very valuable to us as an organization. So the Nedbank journey started off over many years. And I think over the last 30 years, we've been known as the Green Bank. It's in our DNA as the green and caring bank, a bank that wants to make a difference to society. But if you look at the graph, the green chart shows the Nedbank share price over time. We went through quite a tough period around 2002 and 3, where we lost our way a little bit. We made the wrong strategic choices. We became too confident. And the rights issue in 2002 and 3 actually shows to you what can happen if you actually get ESG wrong, and particularly on the governance side. We've lost our share price, although a lot of company share prices fell because of the dot-com bubble. A lot of the period there in 2003 and 2 was of our own making. Since then, we learned from that. We changed our strategy. Our board was changed. Our executive was changed. We focus a lot more on stakeholders. Actually, what happened in that period, our CEO, Tom Boardman, actually, as part of his turnaround plan, developed the company's vision. And he said, we want to be most admired, because during that period, we weren't highly admired by our staff. We had to retrench over 2,500 people. We weren't highly admired by our clients. Our regulators were upset, and obviously our shareholders were also upset. So that set the scene for us to focus a lot on the governance side. In 2006, we were included in the Dow Jones Sustainability Index. And in 2014, we started what we called ESG or governance roadshows. And I'll expand a little bit on that a little later. And I think every company should actually do that. We do a lot of roadshows to tell investors about our financial performance, but we don't always talk about ESG matters. In 2015, we launched a program called Fair Share 2030. And through that program, what we were trying to do is to say that how do we play our fair share in society to uplift the economy, to uplift communities in which we operate. And what we were trying to do is embed sustainable practices in our normal day-to-day operations, in the products and services that we provide. This is not, like I said earlier, something that sits outside. This is, as a bank, something that we can do. That then morphed into 2017, where we adopted the Sustainable Development Goals, and I'll expand a little bit on that. So this is our journey, and we've still got a long road ahead. It's by no means the end. The next topic I want to cover is just, how do we embed, particularly the E and the S into our business. I think very importantly as a bank, we create value and we highly integrate it into the economy. We do that through the deposits that we keep, safeguard for all our clients. We have more than 800 billion in deposits. And just think about the recent example, if somebody gets governance wrong. It's a little bank called VBS Bank, 2 billion rand of deposits that are lost if you get it wrong. So what I will talk to you about is a little bit about how we embed this through our businesses, our operation, and partnership. Also as a bank, we do the deposits, we create wealth for our clients, their investments, we protect their assets through insurance, we extend credit sustainably and in a responsible manner. That's all part of the ESG framework. So I'm going to expand a little bit more on that just now. Now, although doing good was always part of the Nedbank DNA for years, in 2016, we realized that we had to mobilize our staff around our purpose. And we explicitly came up with the purpose that we live by day, and that is to use our financial expertise to do good. Now, our financial expertise, we are experts in what we do, whether it's complex transactions, credit, things we do in our corporate bank, all the systems that we implement to facilitate transactions. Those are the things that we as a bank are really good at and we are expert at. But how do we do that to also make a difference in the economy? How do we use it to make a difference to society, to our clients, to all our stakeholders? So our purpose statement actually guides everything we do. And I think over the next 12 months or so, you would see this come more to life through our brand expression, our advertising, but also in the products and services that we provide. So we're on the early stages of our journey, and I think this will just accelerate as we get our staff to embrace this. And what I'm going to show you guys a little later is just how we've already incorporated some of that in some of our businesses. But before I get there, oops, what did I do? Okay. Just one back. One back. Yeah, one forward. Yeah, great. Before I get there, I just want to say a couple of words on the Sustainable Development Goals. You guys would have seen on our journey, we spoke a little bit about how we're adopting that and how that becomes the framework for all our decisions, our business strategies. Essentially, the SDGs provide the unmet client needs out there in the world. It provides opportunities for innovation and it provides opportunities for growth as a bank. But the SDGs also provide the good in our purpose statement. So by focusing on these unmet needs in society, we can as a business benefit, but at the same time, we can make a difference to the communities and the societies in which we operate. We do that through three key levers. The first lever is our businesses. So how do we use the SDGs, or how do we use our business and products to make a difference through the SDGs? How do we do it through our own operations? Because we are a big corporate in South Africa and increasingly on the continent. And then we also do it through our partnerships. So let me quickly give you some examples, starting with our businesses. Nedbank, compared to some of our peers, we are more of a wholesale bank. We have about 60% of our assets comes from our CIB and business banking business, where our peers are a little bit the other way. And therefore, we are slightly nuanced. Now, over the years, we've invested quite significantly in this franchise. About 3 years ago, we integrated the two units, Nedbank Corporate and Capital, so that we can serve our clients and understand exactly what they want a little bit better. We've acquired a lot of skills. As you can see, it is quite a busy slide, so I'm just going to talk in principle, but we've also invested in expertise across certain industries. And I think this is very important when it comes to how we actually approach SDG. You know, we've got experts in telecommunication, we've got experts in renewable energy, we've got experts in mining. In a lot of cases, we actually employ people like geologists or engineers. Not the typical banker. It's always easy to teach people how to draw up a spreadsheet. But we've also invested quite a lot in technology, core banking systems, you know, platforms that we can look at our clients in a lot more detail, actually in real time. And I think these kind of things are the financial expertise in our purpose. Now, how do we actually use that? So a couple of examples. The first one is Nedbank has over time built up a significant amount of skill and expertise in the renewable energy market. We know, because of the expertise we have, what are the technologies, who are the major players in the market, and because of that, we've actually gained a significant market share, more than 30% of the renewable energy market, financing those projects. Up to December 2017, we've extended credit to the extent of 18 billion. And after the round 4 of renewable energy, we've got a further pipeline of 17 billion to take us to 35 billion. Now, for us, that is great, because in the current environment where corporates aren't investing, it is giving us a pipeline of credit, a pipeline of growth. But at the same time, we can make a difference to clean and renewable energy, infrastructure investment, energy security, and job creation. That's the good of the purpose statement. Now, all these good things also come with a bit of a trade-off. Although it's a growth opportunity, we also this year in our integrated report made a commitment not to fund any further coal-fired power stations. Another part of ESG, and we stand by that. From a sustainable development financing perspective, you guys can actually see on the screen, we've invested almost 4 billion in empowerment last year. You're investing in green buildings, student accommodation, and we also have a green savings bond that to date has sourced deposits or savings from clients to the tune of 25 billion. What I've also shown to you on the slides is just a little illustration of which of the SDGs we actually impact. So from this perspective, you can see clean and affordable and clean energy, industry innovation and infrastructure, quality education, and sustainable cities and communities. So we're trying to, through the products and the services we provide, align to that. The second example that I'm going to show you just now, and I can't click through because I've got a video, is what we're doing in our CIB business by leveraging technology, by partnership with fintechs, and how we're working in the agriculture industry, which is a big growth opportunity for South Africa and for us. Have a look at this.
If you change your point of view, the landscape looks very different. From the ground, you couldn't tell one tree from another. With technology and a different perspective, you can tell a sick sapling from a healthy one. Spot fungus on a tree that needs to be cured or cut down. See pest infestation. table destabilization. Because when you look at the world differently, technology can change your business for good.
So we are very proud of that. That initiative is a partnership with a fintech company called Aerobotics. It can change the way we do agriculture. It can change the way we risk score and extend credit. It can help our clients. And I think that's the good part of our purpose statement. If we turn to our retail and business banking business, it's a business that we've invested in significantly. It's a business that's been part of a turnaround. It's a lot more sustainable, and I think you can't look at ESG without looking at a sustainable business model. Now, this business has undergone significant change and will continue to do so, especially in the digital world. The statistics or the graphs that I show on there, whether it's the ROE or the headline earnings growth or the retail client base increasing, it means that somewhere we are doing something right and that we are more relevant, whether it is providing affordable product, convenience to our clients engaging with us on the right channels. Those are all embedded in those numbers. And we've got quite aggressive targets to grow our market share a lot more. But it's also very important when you run a retail bank that you not only focus on the clients and the profitable clients of today. We all know that the middle market, most of the people that sit around this room, you have got complex banking needs. You typically have a card product, you've got a current account, you've got a home loan, you've got a vehicle finance, and you're actually quite profitable clients for a bank. It's not the same in the youth or the student space or in the entry-level space. Banks don't make a lot of money. But those are the feeder segments of your future middle market. Those are the feeder sections of your SME market, of your future profitable clients. And what we're trying to show in this slide is just that how well we've done over the last few years. You can see in the kids and youth market, that's up over the last 4 years by 17%. They have been under immense pressure recently. And therefore, from our definition of main bank clients, you have to do a certain amount of transactions. You can actually see that those clients have actually fallen out of that definition. Entry-level clients up 22. And those are encouraging for us because that means that we are developing the right kind of products and solutions at the right price to actually gain those clients. But I think very importantly, for us, core to our strategy in the retail bank is to deliver great client experiences. I don't know how many of you still go into a branch and how many of you do your banking on the internet or the app. It's a fundamental shift in the way you actually do banking. This slide just shows some of the investments we've done in recent time, and we're actually rolling out some of these initiatives a lot quicker. Every 2 or 3 months, we can roll out new services. How many times have you lost your credit card? You phone up your bank and said, sorry, I lost my credit card. I'm a bit worried. Maybe somebody stole it. And 2 hours later, you found it somewhere in the couch. So we're thinking about these type of things, and we embedded some of those functionality on the app. So you lose your card, you just freeze it. 2 hours later, you find it. We're taking the services and the things that make banking very expensive, and we're digitizing them. We've currently got 61 of these kind of innovative services on the app. By 2020, we will have over 180. And our clients are saying to us, this is what we want to see. And what I've just showed on the graph here is the app ratings. You can do this yourself. Go onto the Apple Store. Our ratings are actually better there. Go on your Android phone and look at the clients, how they vote for these apps. And the statistics are quite remarkable. So it's just showing that we are heading in the right direction. Now, why do I raise this from a digital perspective? I think it's very important. Companies that do not embrace technology and companies that are not aware of the new threats that are out there. We all know Discovery Bank is coming. We all know about Time Digital. We all know about Bank Zero. And then obviously we've got competitors such as the Capitec, and we've got ABSA, who's getting their house in order. The competitive environment is tough, but if you don't embrace these, you won't have a sustainable business. So just a couple of other thoughts on how we take environmental and social matters into account in our products. Here are 3 examples. In last year, we rolled out our first remote solar-powered branch in the Eastern Cape. The problem for these people are that it's very expensive for them to travel to a branch, but they also don't have the digital networks. So we created this, it's called a Solar Turtle. It's all solar powered, Wi-Fi enabled, and in those centers, we can provide these people, these communities, with low cost banking solutions, financial advice, and related services. A second area would be the SME market, and we all know that the future growth of South Africa depends on the success to which and the degree to which we actually stimulate and grow entrepreneurs in the SME market. In this space, we're also doing a lot of innovative things. We've got SimplyBiz, which is a sort of a resources support and networking center to help companies just through those first few years so that they can stand on their own legs. We've also introduced innovative products like Gap Access. Now, why Gap Access is important is traditionally SMEs are very volatile. They don't have strong financial balance sheets. And you wouldn't typically find a bank would go and lend money to these clients. So what we've done is we developed an innovative product that provides working capital as those SMEs get turnover from their point of sale devices. So we use some of that to actually help them with working capital. Again, it's trying to get our businesses to think differently about banking and making a difference. And then the last one is just an example, again, an example of working with a fintech company where we're creating an ecosystem around schools. And what we're trying to do is take cash out of the system. And how do we just imagine, you all give your kids 20 Rand here and 50 Rand there, and sometimes it get lost, or at the school they have to have this whole heap of cash and deal with it. We're trying to, through innovative products, actually address that. Turning to the rest of Africa, another innovation that we're busy launching is a low-cost cross-border transfer solution. We're working with our equity partner EcoBank on it. And if you just look at the statistics on the left-hand side, we've got 2.7 million African migrants working in South Africa, transferring between 14 and 19 billion of money out to Africa. Now, what has that done? That's a big market. It's attracted a lot of players who charge exorbitant fees to transfer money. You can pay up to 15% of the money that you transfer through that. Now, through this solution, it's all digital, it's all instantaneous, it's a lot cheaper. Because of EcoBank's distribution network, it reaches 33 countries. We think this is going to make a big difference. And it helps with reducing inequalities, assist financial flows across the continent. Another example of using our expertise, our partnerships, our digital technology to do good. So ladies and gentlemen, let me move on to the next one, and let's talk a little bit about our operations, of how we're using our purpose and the SDGs in our own operations. I think it's very important for any company in South Africa to remain relevant. If you don't transform, you will be left behind. And I think as an employer of more than 30,000 people and a big procurer of goods and services, we can play a big role in transformation of South Africa. The graphs at the top just shows our profile over the last 10 years. And I must stress, this is not the end game. I think there's still a long road ahead for all of us in this country to transform our workforce. But our AIC, Africa, Indian and Coloured staff, has improved from 62% to 79% of our workforce. And very importantly, black staff from 26 to 47. Nedbank's always had a bit of a softer side to it. 62% of our staff are female. and we've maintained that profile. But again, in that construct, we've actually nearly doubled our black female staff. I think very important for addressing inequalities and gender equality if you look at the SDGs at the top right-hand side. Also very importantly, on the broader transformation aspect, just a graph there showing our progress, being a level 2 contributor over the last 9 years, and as was previously said, our acknowledgement externally on that. But we also look at our own operations and the impact it has on the environment. Now, it was earlier said that Nedbank is carbon neutral, the first African bank to be carbon neutral, and I'm still not sure if there is another bank that have done that. We also, through our donations to the reduction of invasive alien species plants, we have offset our operational water usage. Now, what a lot of you would say is, you're a bank, you know, you're not as carbon and energy intensive as a mine or a manufacturer. And we would agree. And obviously, a lot of the indices, and you guys would look at these statistics. But I think importantly for us is we use our own operations to experiment, to learn, then to lead from the front, and then to be a strong advocate in these areas. We cannot do renewable energy finance and build our expertise and our experience without doing it ourselves. In our Cape Town office during the recent water crisis in Cape Town, we looked at various options. How can we reduce our demand on water sources? And we introduced waterless toilets, for example. And since then, we've just been inundated by people wanting to know, how are you doing that? So that's just a small little example of what we're doing can be of benefit to others as well. And like I said, we've also donated or busy donating to the eradication of alien species, and that will result in us freeing up 1 billion liters of water into the Cape water catchment area and dams. Turning to partnerships, we also do it through partnerships and through CSI. Couple of points there. On partnerships, we don't do these things on our own. Through our foundation, we've invested almost 170 million, or invest almost 170 million a year on SED. The majority of that goes to education. We partner with NGOs. We partner with the WWF, as I mentioned earlier. We partner with our suppliers, both from a transformation perspective, but also trying to make a difference. And our affinity products, which is actually one of the longer standing products in the Nedbank suite. Every time our clients swipe their card, we donate on behalf of them towards foundations such as the Nelson Mandela Children's Fund. Again, using our expertise to do good. But we're also an active corporate citizen. Because we are so dependent on the economy and the society in which we operate, our CEO, Mike Brown, has led one of the key core streams in the CEO's initiative around sovereign credit rating downgrades. And that's corporates working with government and labor. I think the days of just sitting back and saying, well, that's a government problem or a labor problem. We all need to work together. And I think we as Nedbank surely want to play a role there. Some of the examples, other examples there, we've invested into the 1.5 billion SME fund, and we will be a participant in the youth employment service that aims to create 1 million jobs by over the next 3 years. And interesting, just on that fact, the biggest inhibitor to finding a job for any new person entering the workforce is, have you had a job before? By giving these young people a year internship will significantly increase their experience and chances of getting a job. And then we've also been active participants in some of the national dialogue. We did presentations last year on transformation, and more recently, Barca did a presentation on land reform, and our CEO as well, as one of the only banks, did a presentation on our views around land reform in Parliament. So moving a little bit away from the E and the and the S to the G. I'm not going to go into the detailed aspects. I think there's a lot of guidelines out there, the King Codes, the Companies Act, the JSE listings requirements. What I want to share with you just a little bit of how we approach some of these things, and maybe some of you will find it helpful. The graph at the top is, or that I'm showing here, is our board composition post the old mutual unbundling. Very importantly for shareholders is independence. We've got 67% of our board is independent. Importantly, 67% of our board is also representative African male and African female. We've got a good spread of tenure, people with a lot of experience, and then a lot of people coming in with new ideas. And then what we also disclose, board skills and expertise. Now, I think in the old world, people would want to see, what are your absolute numbers? Actually, what investors want to know is they want to debate these numbers. They want to engage you. They want to understand, with the digital world changing, do you have directors that have deep insight in IT and technology? Do you have board members that understand, if you're expanding into Africa, what it takes, and can they keep you honest in that regard? So the point here is, although you can easily tick the box, I think it's very important that the rationale behind it is quite sound. So 2 more areas I want to share with you. The first one is disclosure. A lot of our shareholders rely on our disclosure to vote on resolutions at your AGM, but increasingly, that's why we're here today, take some of those information and incorporate it in the investment case. The information is also very important to the indices, the JSE indices, the MSCI, proxy voting agencies like ISS. They rely heavily on finding that information in your documentation and in your on your website. And therefore, it's very important for companies to spend time and make sure that you actually tell your story, very important, tell your story clearly. Now, Nedbank, we've been very privileged to this year be awarded the #1 company in the JSE Top 100 for our integrated report. Our integrated report is the 100-page story that tells investors how we create value, how we protect value, how we govern the business, what our future targets are. But I think also very importantly are all the supplementary reports that sit around the integrated report. Lee Roberts, from the CEO of the IRC in South Africa, she always talks about the octopus approach. So what I'm showing you guys on the right-hand side is our suite of integrated reporting. It's not just the integrated report. We have a lot of information for our shareholders around our financial performance. Actually, in our results booklets, we go to a lot of length to not just provide the numbers as per IFRS. We also try to explain non-financial key performance indicators, make it easy for people to interpret, understand what are the things that drives the numbers. We've got our annual financial statements. The SARB require us to provide a lot of information around risk and capital management. And then this year, we also introduced what we called some tax disclosure. How do we approach tax? We think it's quite unique in the market. So that's been voluntary disclosure. And then from the governance and environmental and social side, also a lot of disclosure, governance and ethics review, how we approach the King IV principles, the remuneration report, which is incidentally the first report that people go to once the integrated report is released. Because everybody would have seen your numbers about a month or so ago. And then sustainable development reporting, also very important from that perspective. Lastly, one thought around engaging with shareholders. We started our governance roadshows about 5 years ago. And when I started this role, the key issue for me was, when do shareholders engage with the board? If you think about the primary role of the board is to look after the interest of shareholders. And now when do you engage? Usually only at AGMs. And recently everybody puts in proxy voting forms. So, you know, you're lucky if 2 or 3 shareholders arrive at your AGM. The only other time that companies engage with the board is when something goes wrong. So our approach has been, we've got an annual ESG roadshow where we engage, proactively go out to our shareholders. And what do we want to do? We want to build a relationship between the board and the shareholders. We want to tell them, we want to take all that great disclosure and tell them a little bit more about it. We want to give them opportunity to ask questions. We want to give them opportunity to provide feedback. And in the middle, you can see some of the things that we've been talking about. We talk about strategic issues. Is the board happy with where management is taking this company? Does the board endorse it? How does the board get involved in strategic decision making? We talk about shareholder matters and protection of minority shareholder interest. For us this year, very critical was the old mutual managed separation. Shareholders wanted to know, is the board comfortable with how we're implementing it? And are their rights being looked after? We talk a lot about board matters. So although you have all the disclosures, the board wants to know about succession. The board wants to know about areas where you're still looking for board members that will fill a certain gap in the market. The board wants to know that the transactions that you do, are they independent? Remuneration, always a hot topic, and I'll expand on that shortly. And then also another hot topic, mandatory audit firm rotation, given what's been happening in the industry, a lot of focus on that. And lastly, we also talk about environmental and social matters, and in particular, transformation. Now, the reason I say this is very important for us, over the last 5 years, we've been engaging with our shareholders on remuneration. Now, remuneration is quite a hot topic. You know, are your schemes stretched enough? How do you measure yourself, et cetera, et cetera. And over the last few years, we've been engaging with our shareholders and asking them for input. What is it that they want to see? And not all shareholders and all funds have got the same mandates. But what we did is we took that feedback back to our remuneration committee. They thought about it, what can't be done. And this year we implemented 5 key changes to our remuneration scheme. And on the right-hand side, we had 99.4% endorsement of our remuneration policy. And I think those are the type of examples that I think is very important for companies to engage with shareholders on. So I think these will become more important, and I think shareholders should really adopt this. So that concludes my presentation. Just want to say thank you, and I hope it was of any value.
Thank you very, very much, Alfred. I think some of the key issues there for me certainly were about the level of integration and mapping of the SDGs to your business, which I think from the presentation today was a great insight. I think many companies looking at how you want to integrate the SDGs being the next level of what we need to look at would probably have learned a lot from that. Thank you for sharing that. And I think also gave us a good insight into sort of the more integrated thinking. That's the underlying premise of the integrated reporting. And so very nice to see that coming through. Thank you. That's very helpful from a management perspective, but also on how you consider the stakeholders and how you actually report back to them, which I think is very, very valuable. The other thing, of course, from what you're actually doing in practice is that choosing to not invest in any future coal-fired power stations, which is obviously talking directly to the emissions from your portfolio. I think from a banking perspective and just the overall climate change risk perspective, very helpful. So with that, we'll hand over to audience for any questions.
Okay, well done. Your presentation was a very interesting one. What caught my attention was something in the G aspect, and that's the rotation of an audit firm. I'm interested to know how often you do that. Is it random or regularly, 2 years, every 2 years, every year? And how difficult or easy is it to do that? Because I'm looking at institutional memory. If one firm comes for some time, they understand your systems, so then there is a bit of advantage when they come the next year and all that. But now if you are rotating, how easy or difficult is it? Thank you.
So at Nedbank, we've had the same auditors for 42 years. And I think mandatory audit firm rotation, the aim of it is actually to make sure that auditors don't become complacent. What people don't always understand is within an audit firm, you do have partner rotation. So although the firm itself, may stay on for a long time, you do have internal rotation. I think quite unique for banks would be that for large banks in South Africa, we audited by two auditors. It's sort of a SARB requirement. So you always, at any time, have 42 audit partners busy looking at your business, and what they actually do is they divide between the two businesses, and they then rotate and review. For us, we are fully supportive of mandatory audit firm rotation, and it comes into effect, I think, 2023. You would have seen 2 weeks ago, we went through a whole tender process where we actually appointed a new auditor for the 2019 year. Some of the difficulties we have is, like a bank, there's not a lot of these companies that are out there that have got the skills and the expertise. So, you are dependent on quite a few. And secondly, Section 90 of the Companies Act, there's a concept of a cool-off period. So if any of these firms did any consulting work for you, you need to be clear that none of that would jeopardize their independence. So there's a lot of things that are happening. We are fully supportive of it, and we've started this journey. We do think that, it's probably 10 years would be a good rotation period. But luckily, because you've got two audit firms, you can actually stagger these. So you're not, like other companies, once you cut the ties and the next company takes over, that you're fully dependent. We do have that benefit.
Hi. So my question is less about banking and more on the technology that you showcased.
Yes.
So the technology can pick up if a tree has a fungus, and I'm not sure if, well, I'm sure actually everyone's aware that we have a beetle infestation in South Africa at the moment. So how are you using the technology to deal with that problem?
So to be honest, I haven't got a clue. This is a highly specialized area of working. I'm sure somebody is thinking about it. Sorry, I don't have that level of detail, but I'm sure it's a big enough problem for somebody to develop something innovative and a big enough solution. And I'm sure somewhere in our business somebody's thinking about that. So sorry, I can't answer you on that.
Thank you very much for your time. Just on this issue of mandatory audit firm rotation and broader audit independence. Of course, the idea that auditors' independence could become compromised is, one aspect of it is this idea of mandatory audit firm rotation. But another aspect is potentially the historical career links that board members of companies may have with auditors.
Yes.
Whether they be executives and non-executives. And at Nedbank, one of the issues that investors have had is that both the CEO and the chairman have previous career links with Deloitte, who's one of the obviously long-standing auditors.
Yeah.
Is there any, particular insight that you can give us around mechanisms whereby the potential for audit independence compromise may be controlled at governance level because of those issues?
Yeah. I think the committee that decides on this and goes through a thorough process needs to apply themselves, and they need to be independent. While our CEO was an ex-Deloitte auditor, that was probably 20 years ago. Our chairman, Vasi Naidu, probably a little bit more recently. But I think in banking, you're always going to have people that grew up in some of the audit professions. I think firstly being aware of that, then making sure that when you make your decisions, you are not compromised in that. Our current chairman of the audit committee, for example, is PwC, and we just recently appointed E&Y. So I think that's, a good indication that there's a robust process around that. But I think you firstly need to be aware of potential conflict around that. Unfortunately, I don't sit in those meetings, so I'm sure there's a clever answer around how they do it, but that's my understanding.
Hi, Alfred. I'd just like to find out a little bit more about your ESG roadshow.
Yes.
How did you go about identifying which of the committee, which of the board will attend? Was it just a South African roadshow? Did you do a global roadshow? And how long have you been doing that for?
So we've been doing the roadshow for 5 years. We started off small. Initially, to be honest, it was actually quite contentious because you're asking management to say, I'm letting my board engage with shareholders, and what could they potentially say? Now, if you're all singing off the same hymn sheet and you all got integrity and you're all, it's all aligned, you don't have to worry. And I think it was just that initial step we started off with probably 5 big shareholders in South Africa. We have expanded that over time. We probably now see at least 20 shareholders. We probably see outside of, so if you exclude Old Mutual, probably 80% of our shareholders. Some of them are one-on-one meetings. Some of them are for smaller shareholders, more of a group. And the last 2 years, we started expanding that into some of our bigger shareholders, like the GIC, Lizard. They all are shareholders of more than 2%. And I think as this becomes more and more important, we have to apply our minds as to how do we engage with some of the others. One area that we haven't engaged and that we are thinking about are passive funds. And passive funds do have strong views on ESG matters. And how do we build that relationship? Because we don't have a natural relationship with them because they are passive investors. But there's a very important component to it that we need to think about. So on the international side, at this stage, we've only done calls, so we haven't physically flown out to those geographies. But I think over time, and I think post the Old Mutual managed separation, our international shareholding is going to increase quite considerably from about 20% to 30%. And I think that will justify why we'd have to think a little bit differently about that next time. And just a little bit more insight, we open up the meeting to on the buy side to the analysts, the fund managers, and in a lot of cases, some companies do have ESG experts, and I see a couple of faces in the audience with people that we do engage with. And sorry, just another thought on that. Whilst we do have an agenda, it's up to the investors to raise anything that they want to. We don't force people around a certain topic. And as I've been asked to exclude myself at some stage in some conversations as well, which I think is fine.
Hi, my name is Diana. I'm from Aspen Pharmacare. You mentioned that you're not backing any core-powered institutions.
Yes.
Has that resulted in an increase or change in mindset or interest in terms of green energy? Have you seen more investors coming to you wanting to invest more in renewable energy as opposed to core or non-renewable sources?
So we've been on this journey of renewable energy for quite some time. We were participants in the first round, the second round. So it's actually been a parallel process. But increasingly, stakeholders have been saying to us, you can't be the green bank and then support dirty energy. And therefore, we got to a stage where, although a couple of years ago, energy security was very important, and although we do provide funding to, say, for example, Eskom, we don't always know how they apply that money. A lot of companies actually do invest in, renewable energy. But I think renewable energy is the future. So I think we're going to continue to see that growth. And just clarity on our commitment, we do have existing contracts that obviously legally and from a client perspective, we can't stop that. But any new funding, obviously, we won't consider.
Alfred, and maybe also for the other companies today, because I know you're the last company presenting, but again, please ask the other asset managers and portfolio managers their views on this as well. You spoke about your lovely 100-page integrated report and all of the things that you do there, and that's great. And I know a lot of guys spend a lot of time putting all of that together, but the reality is that it's sometimes, if myself, I look at 20 or 30 companies, I can't read every company's 200-page report. I actually physically don't have enough time. Maybe it would be useful, and I think, Admin, you also spoke about the relevance of reporting when you were presenting. Maybe just having a 10-slide, and not in your investor, because I mean the CEOs are speaking and you guys have time constraints. Maybe just publish like a 10-slide presentation on the website for the companies saying these are our biggest risks that we have identified from an ESG perspective as a company that actually affects us. Most of these things eventually become bottom line issues in any way, right? And just briefly, what are we doing about it? And then when I have time, I will read your 100-page thing. But in the absence of time, it will take me 15 minutes to quickly have a read through. And I actually think that that could be useful for management teams as well, because that can clarify their thinking in exactly what is the biggest risks and exactly in simple terms, what am I doing about it? But please feel free to get some of the other asset managers' inputs on that as well.
Thank you, Cornette. And maybe just if you rewind 5 years, these reports were 250 pages. So, I'm not saying we're making your life a lot easier, but I think 100 pages would be slightly easier to read. I think very importantly, what we do at Nedbank is we don't outsource our integrated report. We don't do it in one division. It's a group effort. We've got contributors from our sustainability team, investor relations, group finance, group risk, communications, company secretary in a core team. And I think the importance of including your IR teams in the development of the integrated report is we hear exactly what the issues are, as opposed to just going and developing something that you push out. So we always try to answer the questions that we know are more top of mind. I like your suggestion around something even shorter. But then also what we've done in the last 2 years, if you go to our integrated reporting page, we've got a video, a 12-minute video. And if you watch our video, you'll get a good sense of that as well. It may not cover all your points, but we're also in the digital age trying to get people consume information differently. Not everybody wants to read. Somebody wants to see. Somebody wants to hear exactly how you're thinking about your business from the horse's mouth. You want to hear what your CEO, your CFO, your chairman, everybody says, and that's what we're trying to do through the video.
Perhaps if I could just echo your sentiments on the ESG roadshow. I mean, even us as a company, we have started engaging in those. I think at one point, we, as listed companies, we want to have a choice, but to engage on ESG, but specifically taking, our non-executives to our shareholders. I mean, we know that the chairman of BlackRock, Larry Fink, is very strong on that. He's actually calling on listed companies to put their boards in front of the shareholders. But I think on a different matter, maybe on just from your experience, I mean, ESG, especially internationally, I mean, it's very prominent. I'm not sure from your experience when you engage with offshore investors versus our local investors, if the emphasis is the same. Like, for example, I mean, I know when you go to Edinburgh, for example, I mean, almost you've got an hour with those investors, maybe 40 minutes of that hour literally revolves around ESG. Yeah. I mean, I'm with a mining company. They will ask less on the operational stuff more than ESG. Whereas when we're here at home, I don't find that as much. Or just to share with us what your experience is.
So my experience is exactly what you've described. In 95% of our meetings, we don't talk about that. We don't talk about it enough. I think when you go on road shows, you typically have an hour, and companies, especially offshore investors, would firstly go through, are you in the right market? What's happening in South Africa? Because that's their first screen. Then they'll look at the industry, and then they'll get to the company, and then they try to find out, how are you going to grow? So there's not always enough time for that. But I think there's an increasing trend where people start asking these questions. Edinburgh is quite unique. You have Stewart Investors, State Street, that they do all the work around the financials ahead of time. So they've done all the financial projections. They look at what the analysts say. They looked at consensus. They built their models. But they want to understand, and their philosophy is that a company that's well governed and sustainable will over time outperform. They don't have to ask the questions around the financials and those. You know, I've been in some of those meetings where our CEO and CFO sat and they asked our CFO, so how many times do you fight with your CEO? Or they ask a board member, you know, they would say, one of your board members 20 years ago, they were on that board, what went wrong? It is a different mindset. It's a handful of companies that do that, but hopefully over time, I think it will become more and more important. A lot of the international companies rely on information sources like ISS, like the MSCI, like on those scores. But you're also seeing people like BlackRock actually developing their own teams and having their own views on that.
Thank you very much, Alfred. I think we have to cut it there. We are behind, but I think fascinating and very, very useful insights for us. Thank you. And thank you very much. Okay. So the quick takeaway there, 10 slides, put it on the website. And we hope that short doesn't mean short term. Okay, so we want to change gear a little bit now, and in a precursor for the next session on investor perspectives. So a clear theme that has dominated the market and of course the country as a whole over the last while has been governance. The breaches that we have seen have served to erode the trust that I mentioned earlier and have led to many questions about where responsibility lies and how to improve this critical matter of governance. Today, we have with us the JSE's General Manager for Issuer Regulation, who will share with us some of the highlights of a recent consultation paper that the JSE did as a regulatory review for listed companies, which has, as part of that objective, trying to leverage the regulatory function of the JSE to improve the governance practices. We hope you find this valuable, and a quick overview of what some of those proposals were. I hand over to Andre Visser. Thank you.
Thanks, Shamila. Good afternoon, everyone. Never a good idea to give a regulator a speaking slot just before lunch. We are well known for being exceptionally boring and long-winded, so I'll try not to disappoint. And in the interest of lunch, I won't be taking any questions, or alternatively only easy questions, so please keep it to that. So guys, on a more serious note, about 6 weeks ago, we issued a consultation paper. I think the main question that was asked at the time is why? Why did the JSE decide to go this route? I can say with some certainty that we've never done this before. Normally, as regulators, we decide there's a loophole, we draft a requirement, we consult with the market, and we implement. In this case, we decided to engage with our stakeholders early in the process. We pitched some ideas, but as regulators, we need to be very careful that we don't try and pretend that we know everything, that the regulation doesn't have unintended consequences. And that's basically why we decided to engage in the process the way we have. Some of you will be very aware of what's transpired over the last year in our markets. And I think that has sort of highlighted the need for the JSE as a responsible regulator to consider whether we need to strengthen our regulation specifically on primary and secondary listings. More importantly as well is questions have been raised whether other stakeholders in this ecosystem, whether there's more that they could be doing as well to strengthen the overall governance ecosystem. And I'll chat to that briefly in a second. By the way, I've got no fancy graphs on here, only 6 slides, so hopefully it'll satisfy one of the members of the audience. So the intent was to basically reflect on matters where we have jurisdiction. Obviously, we can only do as far as our powers and our jurisdiction go. So we reflected on those matters in this document. We raised certain possibilities, and I must emphasize once again, these are just suggestions. We haven't drafted requirements to reflect any of those suggestions. We wanted to get your input into these matters. And then obviously to encourage broader stakeholder input, to get input from everybody across the spectrum, investors, asset managers, listed companies. That consultation process completed about 2 weeks ago. We gave certain parties some extension on it. And we've been very encouraged by the amount of engagement we've had from our issuers, from companies, from investors. last count, we had approximately 75 submissions on this consultation document. Many of those are from broader industry bodies, regulators, listed companies, sponsors, investors, asset managers, analysts. So very wide-ranging input from market players. I think the first point, or one of the important points we wanted to emphasize in the document, and it talks to the G in the ESG equation, and that's the guardians of governance. This was not a question of the JSE deflecting attention from our role and responsibility, but we wanted to make the point that in order for this ecosystem to operate properly, there's only so much we can do, but there are certainly other role players that we think should consider whether there's more that they can do in order to contribute to this ecosystem, ultimately with the objective to rebuild stakeholder trust in the ecosystem. And on that, and this is the only graph we've got in the presentation, you'll see we've mentioned a couple of those role players in this slide. And I'll highlight a couple of them. If you look at the one in green there, the Financial Sector Conduct Authority and our own JSE market regulation team, in the document, we state clearly that there are certain initiatives that FSCA is busy with at the moment, specifically on disclosure of short selling. They are busy with that. That falls within their mandate. Our market regulation team, together with FSCA, are looking at ways where we can communicate on a more regular basis to the market about detection of market abuse practices on the JSE, investigations being conducted by FSCA in that regard, so that the perception that nothing ever happens with market abuse can be addressed. So stakeholders see there is actually something happening in that regard. Companies Act, we all saw recently, there's a document out for proposed changes to the Companies Act. Don't think it was in response to this, but it shows that other authorities are also looking at ways to deal with this. As the Listings Authority, this is our contribution. Auditors, the IRBA, there's a huge lack of trust in the audit industry at the moment, in many cases for very good reason. We know URBA has been in Parliament a couple of times. They've asked for additional resources. They've put out a document, further legislation, where they are asking for more powers to take more enforcement action against the auditors. So all these role players, we believe, needs to play their part in order to create the stakeholder trust that we want in the system. So what are the main issues that we've proposed in this document? We've essentially split it up between primary listings and secondary listings. Just for your benefit, primary listings are listings where the JSE have full jurisdiction over the listing of a particular company, whereas a secondary listing, and this is common in many markets, in most markets across the world, is the regulator takes a back seat, and the regulator in the primary market takes the overall or the primary oversight over a particular company. So many of these things are in response to what has happened in the market. We can probably put a name next to many of these, but I won't be sharing that with you this morning. What I can tell you is that these things are areas where we believe it will contribute to the quality of listings, the quality of governance. The first one is subscribed capital. The objective in this case was simply to say, if companies want to apply for listing on the main board of the JSE, you need to have a track record of 3 years, and you need to have a certain level of profit. But there is a need in the market for very large companies to also list on the main board, despite them not having the required profit levels. So we introduced a requirement many years ago to say, let's create a space where these companies can raise capital on the main board, and we pitched it at a much higher level from a capital perspective. We believe there's scope to say we need to increase that amount, just given the inflection of time, number one. And number two, to say, let's make sure these companies have this capital base in place prior to any capital raising on the JSE. So this is just a question of we want to encourage companies to list on the JSE. We've got a market for SME companies on Altex, but there is a space to make sure that the main board is reserved for very large companies. Public spread. The JSE's got a requirement like many other markets where upon listing, you need to have at least 20% of your shares in the hands of the public. The rules are very clear that certain parties are excluded from that definition. By way of example, directors are obviously excluded from public, and very importantly, their immediate family. So what we have seen in some listings in the past is that you don't place shares with the director's wife, But what they do is they place shares with granny or grandfather or uncles and aunts. So although they comply in full with the requirements, the technicalities, there was a loophole in the requirements. So we're proposing to strengthen that. Market notices. With any new listing, we give the market 5 days notice to absorb the information. I think you'll all agree that the complexity of financial reporting, disclosure, regulation has increased significantly over the years. So we believe it's important to give the market more time to absorb the information when it comes to new listing. Compliance with applicable laws. You may say this is an obvious issue, but we have seen cases where companies who apply for listing whose house is supposed to be in order, we discover afterwards or shortly before a particular listing that that's in fact not the case. So we're proposing certain safeguards around that. Very importantly there is the concept of materiality. We do not want to know if you haven't complied with some minor legislation. We want to know if it's something that's material to your business and your industry. Mandatory training. We believe that there is certain weaknesses from an audit committee member and from a company secretary perspective. The intention here is not to send all audit committee members on training on how to understand financial reporting standards, but with the additional responsibilities we've been placing on audit committee members, we believe there's scope to provide them with appropriate training and tools so they can ask the right questions. The last one on this slide is probably the most controversial one. The non-binding advisory vote on corporate governance. I think Nedbank, our previous presenter, should be commended for the way that they engage with their stakeholders on matters like governance. Some companies, unfortunately, need a bit of a nudge. A non-binding vote will do just that, but it is a controversial issue and we'll see how it goes. I'll wrap up quickly with dealings in securities by directors, additional disclosure. We've seen lots of directors taking positions on geared positions where they provide their shares of security that catches the market off guard. So we believe early disclosure is necessary for that. Board composition, and guys, I'm talking very quickly. I'm being prompted by Shamila. Board composition, the JSE has over the last couple of years introduced policies that companies must disclose on both racial diversity and gender diversity. There's a suggestion that there should be wider diversity considerations when it comes to board level. So we are proposing a similar type of approach on that. Secondary listings, I will just make 1 or 2 points there. The objective of our changes we're proposing on secondary listings is to say we basically want to look at equivalence in regulation. So if we have a market where a company is coming from, we want to make sure at the very least, before we accept that company as a secondary listing, that we've got equivalent type of regulation for those markets. So if this proposal does go ahead, we will see secondary listings only from markets where there are regulations that's more or less on par with the JSE. Not identical, you're always going to have differences, but we've got sufficient protection for shareholders, which is the aim of this exercise. So I think that concludes it from our side. No questions.
Unfortunately, I'm going to have to actually cut it there because we've significantly run over time. But thank you so much for sharing that with us. Of course, the consultation paper is still on our website. Is it? Yes, and you're of course welcome to contact Issue Regulation if you would like to hear more about that. And the slides will be shared with everybody post this. I know that this is a big ask, but our next panel is scheduled, or next speaker is supposed to go on at 1 p.m. and the next panel is supposed to be at 1:30, both of whom have hard deadlines, i.e. it's not negotiable that we start at 1 and 1:30. Can I please ask you to take 10 minutes to get your lunch and come back in so that we can actually get to hear from these great speakers who have to leave at 1:30 and then at 2:30. Thank you.
More and more South Africans are trying Aerial Liquid.
What I pride myself with is being a body positive activist. I've embraced clothes.
Yeah.
The sky is the light dream away in the dark, burn away as you roll this line. Can you see my mind? Moving right, fly higher, not afraid, slide, fire. You're all this time. Can you feel my mind? 2, 3. away. I want you to say let's go. I'm trying to show up my new state that you don't want it too long. You want it to stay a thing. How with me is forever. I wonder how you're not afraid. But now it doesn't matter. You can be my baby, 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 you can be my baby. Would you be my baby? 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 You can be my baby, 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 would you be my baby? You can be my baby. You want to see a thing. I want this forever. I wonder how you're not afraid. Like now it doesn't matter.
I want to start now.
No problem.
You can take that to the stage if you like, John. Back in, everybody. Thank you. You're welcome to bring your food and your drinks and any other friends you have.
Now I'm feeling broken hearted, waiting for my better day. Cause I can't seem to find my feet anymore. I've been waiting for the beat to drop. Oh, I've been waiting in this life for my turn. But it's alright, yeah, it's alright. Cause I'm gonna let it go. No, I never saw it coming. Never listened when it's gone. Now I'm lost in ego's running. Now we're worried till it's gone. Cause I can't seem to find my feet anymore. And I've been waiting for the beat to drop. And I've been waiting in this life for my turn. But it's alright, it's alright.
Welcome back, everybody, and thank you so much for your cooperation. I really am sorry if we're the cause of any indigestion in the audience today, but we really appreciate your cooperation. The next session is a critically important one for us because we're going to hear a lot from the investor community about how they use ESG information, what they're considering the biggest risks and challenges to be. And I think this is critical across the spectrum for us to understand. because integration into investment decision making and investment thinking is really where the rubber hits the road. And I really believe that if money makes the world go round, then this is where the difference is going to come from. So without further ado, I'd like to introduce our next speaker, who really possibly doesn't need any introduction, and that's John Duncan, who's the head of responsible investment at Old Mutual. He has battle scars from the realm of responsible investing that I'm sure he'll tell us a little bit about. But Old Mutual has also been a pioneer in this area, and John is synonymous with this. Today, he will talk about a letter that they sent to all JSE-listed company CEOs, which some of you may be aware of, in a bold move, asking them to begin an open dialogue on matters critical to long-term value creation in South Africa. Are you intrigued? Well, I hope you are, and John will help us to demystify. Ladies and gentlemen, please welcome Mr. John Duncan.
Thanks very much. It's a great pleasure to share with you a little bit of the thinking that went into the CEO's letter. It's a bit of an open secret that we've learned a little bit from what Larry Fink does. I certainly have been hugely impressed with the way he communicates globally with their investor base. So we've learned from what they've been doing. I guess the backstory for us is that we're both a listed entity and we're an investment group inside of a listed entity. So of course, Peter Moyer, my boss, also had to get a copy of that letter. So that was an interesting sort of internal discussion, showed up a lot of really sort of real conflicts that exist right across this investment industry, and they're present right within the walls of our very own company as well. So let me just share with you a little bit of the context to why we sent that letter and how it sort of fits into some of our broader, I guess, responsible investing practices. I think probably with the Old Mutual sort of homecoming story back to South Africa, there's been a real renewed sense around focusing on, what is our purpose and role and function in society as a corporate. And I think what's really important there is that what's at the center of that is our customers. They're the reason we're here. Don't forget that Old Mutual's primary business is selling long-term savings and insurance products to the man on the street. We've got a couple of million customers, both in South Africa and across Africa. And for those customers, we need to make sure that they're getting the right kinds of products that are at the right fee base, that they're getting the right level of education, and that at the end of the day, they're able to productively participate in the economic growth story that is South Africa. So the first part of our kind of broad, I guess, shared value, responsible business, sustainability strategy is really centered around inclusive products and services. Obviously, once somebody buys one of those products, they're paying premiums on a monthly basis, and then that money gets aggregated by the actuaries and then thrown over the wall to us in the investment group. To use the rock crushing analogy from earlier, they throw it across to us in the investment group, and we've got to productively redeploy that back in the economy such that we get this low carbon, resource efficient, socially inclusive growth. And if we do that well, we can make profit for our shareholders and our stakeholders. And if we do all of that well, we can actually then participate in a whole lot of other fun and funky things through our CSI programs and through our foundation work. But what I really want to speak to is our responsible investment program, which is really focused on 4 key areas. One is a commitment organizationally to systematically integrate ESG issues into everything we do across all the asset classes and investment styles. And by integration, I mean both consideration in terms of investment decisions, as well as asset stewardship and ownership decisions. And I think what's really important there, and it's why Mutual has been able to think about this so consistently for the last 8 years, is simply because we're managing against a 30-year liability horizon. 75% of the assets we manage comes from our parent life company. We're not out in the street scrapping for retail assets. Of course, we're interested in the retail assets, but our primary interest is managing against these long liability horizons. So as a consequence of that, we do need to look right out into the future. And so related to that is not just integrating ESG issues into the way we invest and how we show up as a steward of other people's capital, but it's also about intentionally tilting towards low carbon, resource efficient, and socially inclusive growth. So how do we get that? That's green economic growth. The third area of focus is around giving investors choice, and I'll speak to some of the stuff we're doing there. And then ultimately, I guess it's recognizing that we're all in this together. You know, globally, the financial the global financial ecosystem requires participation and action from everyone. And so we're very sort of proud of our thought leadership work. And you can see at the back, there's a Tomorrow's Invested as You Are publication. It's our 4th edition of that publication. It's got a lot of external thought leadership pieces in there. And one piece, which is on page 7, is the letter that we sent out to CEOs earlier this year. And that's kind of primarily what I'm going to talk about. I guess in simple terms, what is ESG integration? It's really about looking at the world through a sustainability lens and pricing risk and opportunity. So we do that research as a fundamental team. We're a team of 5. We work broadly across all of our boutiques. That gets baked into the investment case. It leads us towards a company's engagements. We then lead on to voting activity and ultimately market engagements. But what's really important to understand about the way we invest is that Old Mutual Investment Group has one of the biggest passive investment portfolios in the country. It's over 90 billion rand. And so in many respects, we are a true long-term investor. We always hold the market. As a consequence of being passive in the market, we are always in the market. So there's no buying and selling decisions there. We simply replicate the market over time. So learning from the work that's been done overseas, specifically I'm referring to the work done by Elroy Dimson from the London School of Economics, looking at the role of active stewardship in the market. Really, there's an opportunity through direct engagement with the companies that you're invested in to reduce risk and add returns to clients over time. And if done correctly, you can add value. And so for passive investors, by being an absent landlord, i.e. not engaging or not being focused on the company you're investing in, you're actually kind of leaving alpha on the table, which is not an ideal outcome for your clients. At the same time, we also recognize that the stewardship that we have in the market doesn't just need to be at a company level, it also needs to be broadly across the market, because the health of the financial ecosystem is really critical to us over time. So, you know, the work that the JSE has been doing, work commentary, and I'll flip up here some of we break our engagements into 2 areas. Alpha engagement is the direct company level engagements where we identify specific issues, and I'll get onto that. But then we are also very involved with working with integrated reporting teams, the King Code. We put commentary into GRESB. We put commentary into the Mining Charter, obviously the FSB Directive, the latest JSE commentary, the Companies Act. All of these things are important to us. It takes time, but we're doing them because we believe strengthening the overall ecosystem is good for us and it's good for our clients. And given the 30-year liability horizon, actually, we need the foundations of the market system to be strong. And then on the flip side is the direct engagements with companies. And we have and historically done a lot of engagements across the market, but a lot of the time we got pushback to say, well, what actually does Old Mutual Investment Group stand for? And so the letter we sent out to CEOs earlier this year, to the CEOs of listed companies, was really an opportunity for us to put a line in the sand and to say very clearly what it is we stand for. So, and I'll get into the detail of that now. So Kaya Gaboro, he's the CEO of the Old Mutual Investment Group, along with the Director of Investments, Hal George. We're really the voice behind this particular piece. We sent that letter out to, you know, over 160 odd different companies. And really what the letter said was a couple of things. It said, you know, failings in the broader ecosystem reflect on us all badly. And so we were really calling on 3 things. One is ethical leadership from companies. So to really start being clear at a board level, how ethical leadership shows up, how do companies evidence, what does that actually mean? 2, really pushing companies to be very clear in respect of how they integrate long-term sustainability issues into their stated company strategies, and specifically how that flows into where rewards come. You'll see, I'll show just now some of our vote history. We've been very, I wouldn't say aggressive, but very clear in terms of what our expectations are in terms of long-term reward. And over the last 18 months, we've voted probably over 30% against REM policies and REM reports, simply because we just don't see this integrated thinking. I mean, it's really great to hear Nedbank talking about how the integrated report actually emerges. It emerges out of a system that supports integrated thinking. And so when you see companies appointing external consultants to do their reports from them, you kind of get a sense, well, it's a bit of a wallpapering exercise. You ask the CEO or the CFO at a roadshow, or the head of investor relations, and they say, "Yeah, great question. Here's the card of our sustainability person. You can speak to them afterwards." And actually, what we're really wanting is CEOs to start speaking very coherently about what is their, in simple terms, what's their strategy for making money? How does it impact stakeholders and shareholders in the long term? And specifically, how does that relate to reward over time? And then lastly, the last key issue was specifically on transformation. It's a really critical issue for this country. Codes aside, we need an integrated and an inclusive growth path for this country. And what we see when we analyze the JSE, I mean, this is our own proprietary research. I mean, the JSE took a lead on this last year, where they made it a requirement for listed companies to disclose their BE requirements. We went out, we did the research, we analyzed the full SWICs, and we looked at transformation across the industry. And what's obviously very apparent is for those entities that have a license to operate, banks, people that are accessing cell phone spectrum, mining companies, transformation's there, right? We can see it. But there are a lot of other parts of the economy where the transformation is not really a license to operate issue from government. And so companies just simply sit in their hands and they do nothing. And our view is that there's a great deal that companies can be doing, both in terms of supply chain development, enterprise development, skills training, all of which are clearly available within the codes, but companies simply don't do anything about it. And so, what I'm trying to evidence here is that what supported the drafting of that CEO's letter was a great deal of research around our exact clear position on these particular issues. This is the SWICs in total. We then overlay that on our core holdings, because we roll up all of our holdings on our listed equity side. And we can see exactly where the laggards are in respect of transformation, for example, or on REM, or on ESG integration, or on ethical leadership. And then we now have, as a consequence of the CEO's letter, a nice open runway, when we can go and phone up the CEO of company X and say, recall that letter. One of the issues we mentioned was transformation. We're an active holder of your shares, but we see that you're leaving a whole lot on the table here around supply chain development. So, and as a consequence of that, I'm really pleased to say that the kinds of engagements we're having with CEOs now is a lot more real and robust and honest. And it's the kind of conversation that I think we so desperately need in this broader sort of financial ecosystem. So that's a little bit of the context. And what's important for us is that this is not just a one-off thing. I think the issues we've raised have a lot of legs. I can't think of any other word, but these are going to be persistent issues that we will continually need to engage with over time. So we have a responsible ownership report, which we put out annually, which shows our vote results, etc. But specifically, it looks at engagement, the kinds of progress we're making with companies, the way we track that. And what's really nice is we partnered with Stellenbosch University, and we're trying to replicate the Dimson study from the UK, which was actually done globally, but to replicate that study, to really evidence in real terms that actually proactive stewardship can add value over time. So simply put, don't be an absent landlord when it comes to your investments. So that's the CEO's letter. Some of the other areas that we're involved with, we are very heavily involved in driving green growth in South Africa. We've got the biggest affordable schools fund, affordable housing fund, very focused on retirement housing, agri, renewable energy. It's all summarized in our impact report that we do annually. We're very proud of this work. We've developed our own green economy taxonomy. We tag all of the assets in our holdings database in respect of their participation in the green economy. And we can currently account for over 120 billion rand of our clients' capital at work in the green economy. And what's really exciting is this year we've layered on a geographic tag onto that database, which now allows us to start getting into the granular view Okay, so what does it look? What does our clients' capital? What's the deployment look like in the green economy, say in the Eastern Cape? We can actually start having that kind of conversation. And my hope is that ultimately this information starts to translate into, I guess, big, bold commitments about how much more we want to participate in the green economy. The third area is about giving customers choice. I mean, a lot of what we're speaking about here is institutional scale investment. Currently, we hear a lot of people speaking about retrofitting ESG into vanilla investment products, but there's very few pure products out there that aim to capture the market benefits that come from ESG information and data. And so we have been offering to our institutional clients ESG indices over the last 3 years. We've attracted a lot of assets into those. We've evidenced very clearly that for the same risk and return, you can hold a basket of assets that's measurably better for the planet. So the question is, why wouldn't you choose to invest in a product of that nature? And so as at 31st, we've now launched these products to the retail market. And the next step in this journey is to start ESG tagging of all of the funds on our retail platforms, right? To start giving customers choice. Because actually, at the end of the day, what we really need is a retail revolution. We need people to start asking questions, hey, what's in my fund? What's the carbon footprint? What's the quality of the governance? What's the level of transformation? And the reality is that information is available at the touch of a button. 3 years ago, you couldn't answer that question. I can do that now. Simply, it's easy to do. So making that information available to customers, we think, is key. And then the last issue, which is what I started with, which is around this thought leadership story. And simply put, we recognize that we can't do this alone. We're in this together with all other participants in the market. So, you know, the CEO's letter was put out there as a call to arms for CEOs out in the market. But really what we're trying to say through that letter is simply that we're managing money on behalf of savers on the man on the street. So if we can get alignment between the aspirations of the savers on the the savers, the average person in South Africa, if we can get alignment with their future aspirations for an inclusive growth, low carbon, resource efficient economy, and we can align that with companies that are generating their revenues and profits through the production of goods and services that are aligned with the green economy, our role as intermediaries in the middle is to seek that alignment. And that CEO's letter is an attempt to do that. And our thought leadership publication that we put out speaks to that. And we would really welcome you to give it a read. If you've got any smart ideas, please send them to me. We'd love to publish your thoughts. Thank you.
Okay. Thank you very, very much, John.
Sure.
I'm going to race through that. I can perhaps take one question for John. Okay, that hand went first.
There was another hand there.
Where's another hand? If you can keep it really short, thank you.
I know on driving green growth. Then look about a company like Sasol, for example, the second largest emitter of CO2 in the country.
Sure. So
bear in mind the other side of it about job creation and strategic oil.
It's a fantastic question. So our view on green growth, low carbon, resource efficient and socially inclusive, when we look at the structure of the South African economy and we look towards companies, so when I think about green growth, I think about companies who make their revenue and their profit through the production of a good or a service that's part of the green economy. Sasol's clearly not one of those entities, right? And where are the investment opportunities in the listed environment in respect of green economic growth? Given the structure and the size of our market, we don't see those opportunities in the listed space. The bulk of those opportunities are in the unlisted environment. Hence, what we put up there, all of those are unlisted investments, and they're primarily accessible only to institutional investors. But of course, if your pension fund is invested in any of our products, they will naturally have exposure to that. If you look at the green economy in South Africa, maybe in the listed market, maybe in time, you might get some of the renewable energy companies, the private equity participants might exit, they might end up in listed entities. You could argue that maybe some of Advitech or Curo, they're part of the, possibly, maybe one or two of the agri suppliers. But really, if you had to do a proper portfolio of green economy players in South Africa in the listed markets, you're going to end up with something that's just got too much concentration risk as to be unpalatable. However, if you go into emerging markets and you go into developed markets, it's a very, very different story. And when we look globally, we see a lot of really handsome opportunities in those markets for companies who are growing as a consequence. So I think of, Croton Educational. They're the largest online service education provider in the Southern Hemisphere, or one of the service providers, original equipment manufacturers, got an offtake agreement with Tesla, for example. These are the kinds of companies that I would say are green growth investment opportunities. They're listed and they're liquid. Those opportunities, I don't see them in South Africa, certainly at scale.
So in the case of Sasol, then, you invest in Sasol?
We do invest in Sasol, absolutely. And from the perspective of our clients, to date, we have not had one single client provide us with a mandate that asks us to exclude primary producers of fossil fuels. Okay, so from that perspective, no. On our ESG indices, companies like Sasol will be excluded on the basis of a peer relative best-in-class performance basis.
Okay, very interesting. I think there was one more question, John, on this side. I'm going to have a go at Mahiba. This is what ex-JSE employees do. They go to the PIC and agitate.
Great presentation, John. Obviously, Old Mutual has been at this for quite a while, and you've been doing great work. I just wanted to know, in terms of your CEO letter, wouldn't you consider taking on board other investors, particularly the smaller shareholders who sometimes feel like they don't have much of a voice in the space? Wouldn't you want to have them as co-signatories to your letter?
It's a great idea. It's certainly something we considered. Initially, we wanted to put a line in the sand in terms of what Old Mutual stands for. What I can say is one of the interesting features of the South African investment landscape this year, primarily as a consequence of Steinhoff, that all the investors are speaking to each other now. 2 years ago, it was very difficult for me to have a conversation with my peers in another house to say, hey, listen, what do you think about so-and-so and this governance? We are all acutely aware that fixing this stuff is in all of our interests. And so dealing with governance is almost a pre-competitive issue. I think it took Steinhoff to get that out the way. So great point. We'll definitely take it on board for next year. Thank you.
Thank you very much, John.
Sure.
That was fantastic as always. Thank you very much. Okay.
Is it edible?
It's complete. No, that's not edible. That's actually a reusable notepad that you can store your notes on the cloud. So next time, I hope you'll get more speakers and I'll get more nice gifts. Ladies and gentlemen, without further ado, I'm going to ask our Head of Strategy and Key Clients, Nicola Komninas, to join us on stage. She's going to moderate the next panel that we have, which is an investor panel. It's the first time that we've had a panel like this at a showcase, and I think is really answering to many of the needs we've seen. And to John's point that he finished on, which is a great segue for me, is about the need for investors themselves to get together to consider all these things. And the panel that we have is a very esteemed panel representing some of the most well-known fund managers. I'm going to hand over to Nicola to please introduce her panel and to get going with this and hopefully unearth for us some of the insights as to how investors use information, how they integrate this into their decision making, and will be insightful both for other investors as well as for listed companies and other companies in understanding how information is used and how it's actually perceived by the investment community. Nicola, thank you.
Thanks, Shamila. Okay, so to start off with, 72% of global institutional investors and asset consultants either somewhat or significantly use ESG principles as part of their investment decision-making process. And a third of those have extensively embedded ESG in their decision-making process. So that's from a 2018 survey that was done by RBC Global Asset Management. So it's very key to know that this panel is very relevant. And as we've spoken today, a lot of investors are embedding ESG in their approach, but only a third has significantly embedded that in their approach. So as Shamila mentioned, I'm Nicola Komninas. I look after group strategy and sustainability and a few other things at the JSE. And I'm very privileged to have a very distinguished panel here with me today To my immediate left is Neville Chester, a senior portfolio manager at Coronation Fund Managers. And then to his left is Rain Nudia, an ESG analyst at Allen Gray. And then to my far left is Zaid Paruk, portfolio manager and analyst at Aon Investment Managers. So we are privileged to have a very nice diversified asset management panel, and I'm very excited about all the insights that they'll share with us today. So to kick off the conversation, I thought I'd share with you some stats from CFA Institute. And very interesting, they've done 2 surveys. One was last year in April 2017 around the future state of the investment profession. And that showed that 73% of investment leaders expect that ESG factors will become more influential. And that's definitely been evident today. But I think the stat below is the shocking one. Only 11% of them believe that the investment industry's impact on society is currently very positive. And a lot of that is linked to compensation, being maximizing AUM, maximizing return at possibly all costs. And so we'll discuss some of that today. The last stats is 80%, and this is a survey that was conducted earlier this year by CFA Institute as well for the investment firm of the future. 80% expect increased demand for product that incorporate this notion of personal values. So very interesting concept. And then 72% expect that their firm's future commitment to research of ESG issues will become higher. So on that note, I'd like to ask each one of our panelists to just share their insights in their specific context, linking back to global and local industry trends, and specifically how their firm is responding to these trends, as we can clearly see that others are adopting this globally. And as Donna asked this morning, I'm just going to throw it in there, whether we could ask you to also give us a bit of direction in terms of how the exchange can better support yourselves in terms of our offerings. We have ESG indices, we've launched green bonds, but what are the things that we need to do to respond better to the industry trends globally?
Okay. Look, ESG, I mean, without a doubt, it'd be foolish to think that the pressure is just upping the ante on managers every day. We're seeing it from clients, from the pension funds, from various bodies, as you say, generally. It's always been something that's been very much integral part of our approach. It's embedded ESG inside our investment approach. And that we think is quite important. It's not something that we think should be dealt with separately. There's an approach that ESG is almost like a separate division sometimes. We think it's actually integral to understanding a business. Issues around sustainability are incredibly important when it comes to long-term value of a business, is understanding sustainability. It might be something that's profitable in the short term, but if it's not sustainable, clearly this business won't survive. If you look at the big issues that have affected the JSE and shares in South Africa over the last few years, governance has clearly been one of the key things where obviously, that's an area that needs to be further improved. And it really is, ESG is something which is on a constant step of improvement. It's every year you up the ante, every year you're trying to improve it. But at the same point in time, one also has to, be aware of the unintended consequences. So if, all the listed companies in the world, it suddenly becomes their responsibility to resolve all the world's problems, guess what happens? They stop getting listed companies and you start getting private companies. And then all of a sudden you don't have listed companies to invest in anymore. And potentially you don't have any exposure or any control over what private companies are doing. So it needs to be done in a considered manner. And, that's a careful balance. You don't want, the rise of these massive private equity funds which are taking companies going private because they're trying to avoid onerous, what's viewed as onerous regulations and requirements. So, that is a big issue or something that one has to be, cautious of if you, you can't just expect all the listed companies to somehow solve all the world's problems.
I think that ties in nicely with the presentation that Andre Visser made a bit earlier about the consultation on the JSE's paper and not just setting standards, but consulting.
And then the other thing which, I think, we are, improving a lot is just the reporting and showing that. So, it's not enough now to know that it's been done. You need to be able to show clients, report on it, show the various metrics that you're using. And I mean, we'll get into it, but you know, this is obviously a key issue is comparability across companies as to what is good ESG practice. Some stuff is very obvious and easy around quality of boards and independence. Other issues around the E and the S, very difficult to compare. You know, is a company doing a right job? Is it the appropriate areas that they're focusing on? That is a very, very soft and qualitative part of this. Whereas again, as an industry, we tend to focus on the more quantitative, the governance side.
Thanks, Neville.
Actually, I agree with a lot of what you just said. So I'm not sure how value adding I can be now. But I think I'm not going to spend too long on trends because I actually think they've been highlighted throughout the course of the day. And I think that main one is just increased transparency and accountability. And I think as the investment community, we're feeling that as well as the companies. So how we're responding is, again, trying to improve our disclosure and our reporting. So, you know, we publish our proxy voting quarterly on our website. We, for the last 3 years, now going on to our 4th year, we are publishing an annual stewardship report. And so what that does is it gives more detailed case studies into some of the ESG research that we've done over the course of the year. And that's for clients that really do want to engage. Then they can read that and ask us in much more granular detail on some of the work that we're doing. I think also engagement. We're trying to increase our engagement with clients. Pete is my colleague at the back there. He'll be speaking on governance later. And I focus predominantly on environmental and social research for our team with some governance overlap as well. So what we're trying to do is actually meet with clients much more, and not only institutional clients, but retail clients as well, and give them insight into how we think about responsible investing. So I think picking up on what Neville said, it's quite hard to differentiate between asset managers because all of us now say we're applying ESG integration, but obviously within that, there's quite a broad spectrum of how we're thinking about it and applying it. So what we feel we can do is equip our clients and potential clients with our overview of how we think about it, and people can see if that aligns with their values. I think an important thing is also just being real about it. So if you look at our top 10, we're invested in British American Tobacco, which is tobacco. You know, a lot of people take issue with that ethically. We're invested in gambling companies. We're invested in Sasol's, also in our top 10. People take issue with that environmentally. So we're not trying to pretend to be something that we're not. But what we're saying is what Neville spoke to. We can give a very considered approach. So if our clients contact us and say, why are you investing in Sasol still? And how are you considering the ESG impacts? We can give you a very detailed response as to how we're doing that. So I think that's just an important point to make. It's not about screening out every company that has a bad impact on the world, because I think based on personal values, you could eliminate a lot of the JSE, to be honest. And I don't mean that in a rude way, but I mean that, so if some people take issue with microloans and funeral policies, you know, that would eliminate a lot of banks and insurers. Other people take issue with tobacco or gambling. Some people take issues with retailers in terms of animal welfare practices around meat production. A lot of the big global pharma companies have been fined for paying state doctors to punt their products. So depending on what concerns people, you could really start eliminating a lot of companies on these sort of very broad ethical bases. And I think what we try to do is look at it more deeply and rather hold the companies to account to be better, and to make sure that, as has been mentioned several times today, they're more best in class, sort of comparing them to peers and best practice. I'll leave it at that for now.
Thanks, Rain. That's great insight, and specifically your case studies that you publish on your website, I think can give great insights.
I hope people do find them useful.
Yeah, thanks for pointing us in that direction. Zaid, I'll leave you for last comment.
Absolutely. I think first and foremost, if we want to understand ESG, we need to take a step back. What is ESG? ESG is where society's shared value and behavior is presented in all facets of business. If that were the case, it would create a platform which is business conducive, business friendly, and where workers and companies would work together in terms of providing a good platform. Globally, I think why it's important is, I mean, we've seen studies by Khan, Sirofin, and Kuhn, where they studied 2,000 companies over the last 25 years. And what they found is that those companies that invested materially in ESG issues significantly outperformed those who invested in ESG issues, but perhaps not the material ones. How do we compare, I guess, globally is we probably behind the US and Europe, but perhaps ahead of Asia in that regard. What we have seen in US is that you have ESG focused funds. We've seen something like 220 billion in pure ESG focused funds. And we're seeing continued international pressure, especially on our local side, to increase our ESG response. I think the issues globally and locally differ materially. If we look globally, the issues are the move towards a zero fossil fuel environment, climate change, as well as board diversity. Whereas if we look locally, I think the issues are more racial inequality, BEE, as well as mine workers' rights or workers' rights in general. So I think it differs, and I think it plays to that wider spectrum of the various issues that are at play. As a community, as an investor, as well as companies, I think we lack where the rest of the world is. We see a lot of firms just playing lip service. We see, I mean, you can have full-length pages in the newspaper or fancy PowerPoint slides, but how integrated is that into your investment approach? And that's what we're saying. I mean, if you just have to draw it back or illustrate it by way of example, locally, we look at Discovery. Discovery has been a model where it's helped clients remain healthy, but still remain profitable. I think it talks to the story of having a clear mission for shared societal value, and you deliver value rather than delivering value first and foremost, and then thinking about what your mission is. How as a firm we're responding, we are currently, in our opinion, I think there's 40 or so UNPRI signatories in South Africa. We are the only one that is a AAA plus rated signatory. And it's not something which we say, you know, just to, we are proud of it, yes, but we want to encourage our other firms to be a signatory to it, because it keeps us accountable and it holds firms more and more accountable. So, I mean, there's various issues which I'm sure we'll get into, but broadly, that's
Thanks very much. It's great setting the scene. So let's talk about the investor of the future. So I've included some stats from a survey that was done by Swell Investing earlier this year around money meets morals. So you spoke about, Rain, you spoke about talking to your clients. So this is really about the investors of the future. And it talks about the vast majority of both Gen Z and millennial investors are either currently already invested in socially responsible investments, or they are planning to do so in the future. 84% of Gen Z and 78% of millennials. That really is significant. And if you compare that to the other generations, the Gen X and the baby boomers, it really sets a contrast in terms of the traditional investors and the investors of the future. And we might say, well, the Gen Zs and the millennials are still young. So I've included a bit of stats in terms of the population size and how big they are compared to the rest of the populations. And they really are getting close to about 50% of our investor universe. And all the millennials are in the workforce, and Gen Zs are starting to enter the workforce. So really just bearing in mind this new investor type and their completely different approach and really being ESG focused, I suppose it's a big opportunity for us as well, but we also need to think about how we talk to them. And some of our presenters earlier today spoke about using social media more and using videos more. So I'd like to ask our panelists to share how you are engaging this new type of investor and how your firm is responding to their needs compared to the traditional investor. But then also if you can give some tips to the corporates that are in the audience in terms of how they can respond better when they talk about ESG around their company. So using things like social media, etc., better to service to the needs of this investor base. Rain, shall I start with you and mix it up a bit?
Okay, putting me on the spot there. I was still thinking. I think the concern I have with this is that there's something developing which is like a social media outrage, where we can read headlines and very quickly become outraged by some ethical issue. And so sometimes, actually the wrong narrative can snowball. So an example that I often think of is, Shamila, you spoke to it earlier, this concern around plastic, which is a very valid concern. And I think we should be working towards ending single-use plastics, for example. But now there's sort of very broad campaigns to just ban plastic across the board. But actually, if you look at life cycle assessments, a plastic bag versus a paper bag versus a cotton bag, plastic bag has the lowest environmental impact. And that's because on the manufacturing side, cotton and paper are so much more energy, water intensive, land intensive, and so on. And so the problem's coming in terms of how we're managing the disposal of that plastic, and also because of consumption. So that's something we have to tackle as well. So my point is just, it could be good PR for us to create a product where we say we will only invest in retailers that ban plastic bags. A lot of them actually are committing to phasing them out anyway, but it could be a great PR campaign, but is it meaningful? Because actually we know from our research that it actually has a worse environmental impact over time. And so you need that balance. So I think that's one thing to guard against with social media, is just making sure that we're not just succumbing to whatever the current narrative is and we're really thinking about it. In terms of how we are adapting to their needs, again, I think it's just increasing our transparency, as I've said, and being willing to engage. So we engage on every client query that comes in on an ESG issue, and we try and give a really detailed and considered response that the person on the other end will not always necessarily agree with, but at least they can see that we've really applied our minds to thinking about it. And I think that this generation appreciates that. You know, they want a candid response rather than a response that seems quite wrapped up in corporate bureaucracy.
I saw a survey recently that said they want a response within an hour. Wow,
yeah, we do try
tight timelines. Your thoughts on this, Neville?
Yeah, my chance to say I agree with Rain. Yeah, so yes, Rain is saying it is around communication, I think, is the big issue. So it is around having those channels open and watching what people are thinking and saying on the various social media platforms. And then, but then having very upfront and honest communication. And I think that's been something we've been strong at, is immediately where there are issues, acknowledging them, explaining, you know, why either it is an issue, or on these certain cases, exactly to a point, it might not be an issue and considered. I think one has to, be very careful guarding against, you know, the second round effect or the unintended consequences of this behavior. But without a doubt, you know, you've seen this, the generation X, the millennials and Zs, you know, it's changing all kinds of behavior, whether it's consumption trends, this whole issue around more experiential and requiring different. So, you know, without a doubt, every industry that services the coming generations needs to change. At the same point in time, you know, you need to understand what capital markets exist for, which is, you know, the provision of capital for entrepreneurs or for development. And sometimes some of those, again, they're different needs for different individuals. South Africa, being a developing country, has very different needs to a mature country. You know, Norway, after, you know, pumping out all its oil and burning as much carbon as it is now the biggest, you know, investor out there saying, you know, no carbon, no investing in carbon, after all their wealth comes from pumping oil. So, you know, that's a great position to be in as a wealthy European country. If you're in a developing, emerging market country, you know, those are lofty ideals, but, you know, that's not going to impact on our young generation. They want work, they want power, you know, so one has to, again, you know, be very cautious around taking a global survey and dropping it into an emerging market like our own.
Yeah, I mean, sustainability is also the society, and in terms of employment, etc. Your thoughts, Sage?
If you look at the younger generations, you ask millennials, what do they want? I mean, they want to make an impact, and they want to make a difference in terms of what they want to do. How that flows through in terms of us as custodians of capital is, how do we manage the expectations of what millennials or the younger generation want, and include that in terms of investment thesis. We are not there to impose ideals or behaviors on societies, or we're not there to impede on any of societal norms. What we are is to take those societal norms and use them for the best behavior possible. If I illustrate it by way of example, I think let's look in terms of, you spoke about the digital space. If you look at Facebook, I think the younger generation is open in terms of accepting that they are the product, and they're open to an open and transparent world. So it's not to govern in terms of being open and transparent, but rather it's the right use of that data for the right purposes. yeah, that's what I mean.
Great.
You asked, I mean, about what companies, I guess, can do. I mean, the big issue there, I guess, is again around disclosure and consistent disclosure. I mean, this is as true to accounting data as it is to ESG data, is comparability. You know, every year you get a financial report and the numbers are changed and the numbers are different, and it's very difficult following, you know, have they improved, haven't they improved, where it is. So, you know, I think that's, you know, from a corporate reporting point of view is the transparency, and then comparability is incredibly important. So you can see, because now everyone is on a journey, whether it's ourselves, whether it's the companies we're investing in. And at the end of the day, if you can show improvement, you can show that there's meaningful change. That's the positive.
Yeah. No, and I think the example of Netbank was a very good one earlier today. One last slide to share before we go open the questions up to the audience. In terms of this old paradigm to new paradigm, so in terms of the investment industry really being challenged to be starting to play a much more significant role in terms of the impact in society. So this is a study that was done by Focus Consulting Group earlier this year. And they talk about the old paradigm really about AUM and maximizing returns, but this new paradigm is all about the investments not just having an economic value, but also the social value. So we've spoken about employment, etc. And then the other thing in terms of transformative change within the company as well as the community. So on this note, I'd like to please get into a bit of the meat of the discussion. So how ESG is being factored specifically by your firm in the investment decision-making process, so that the corporates in the audience can really get an understanding of how they best position themselves for you to get that insights from them and how you use that information. And then possibly some insights as well. There are some asset owners in the audience as well. So on the pension fund side, should they be involved in defining some of this criteria, and how are they involved if they are? So Zaid, can we start with you?
It's me on the spot this time. Yeah, look, in terms of integrating ESG in terms of our approach, I think we believe firmly that ESG should not be something which is thought of as perhaps an afterthought or segregated in terms of a department. It should be inculcated in terms of every single person that's going about it. And that's been since our inception. We haven't had a separated ESG team or ESG department, but rather we all try to think in terms of ESG approach when we're looking at it. It's often helped. We've avoided some of the pitfalls, such as, you know, Steinhoff, EOH, Resilient, just to name a few. And how we go about it is, I think, in three different respects. One is a company which we are not invested in and we have no intention of investing in. There we don't really engage because we don't have the capacity perhaps to go and engage in terms of all the information. Second is a company which we are thinking about investing in, and perhaps the third point is a company we already invested in and a material issue has come to light. In that scenario, we find that accountability, transparency, and disclosure, and I think combined with governance, is fundamentally key. So we engage a lot with management. We speak to them. And we try and engage in terms of, can this material issue be resolved? First and foremost, I think we engage with companies before an issue comes to the fold. You know, we try and engage with management and find that, look, if you can solve this issue before, it wouldn't be a material issue at a later point. It wouldn't affect the bottom line. So openness with management and governance for us is key. And just to illustrate by way of example, we asked a CEO at an event, CEO of a listed company, what PRI rating was for the underlying asset managers, and she didn't have a clue. And I mean, this was something which I think talks back to the fact that a lot of firms out there are just having lip service and saying we're doing this, but not actually doing it. Another example was the Woolies AGM, where we were the only institutional asset manager to attend. And you wonder out there, look, you know, we can engage in so many ways, but if we're not engaging with management, what are we really doing? I think that's key. So, I mean, just to go back in terms of the approach, we use negative screening in terms of companies which we already know an ESG issue exists or could exist. And secondly, we use a factor premium. So we use a hurdle rate in terms of those organizations which we believe to have higher ESG issues, and we incorporate that in terms of our discount rate.
Very useful, very insightful. Ryan, would you like to add to that?
So maybe I think what could be worthwhile is just quickly running through the 5 approaches to responsible investing, which are all encompassed within this SRI. So it's screening, which David's just spoken about, so either negative or positive screening from your investment portfolio. ESG integration, which is what we use at Allen Gray, and I think a lot of the asset managers are using. Shareholder engagement, which a lot of people see as shareholder activism in the news, so proxy voting, engaging with companies in private and public. Then there's sustainability themed investing, which is sort of much more narrowly defined, and I think, as John mentioned earlier, would present concentration risk in terms of us investing in JSE listed companies only. And then lastly, there's impact investing, which is where there are actually very clear social objectives and targets alongside financial return targets, and the company is required to report on both. So at Allen Gray, we use ESG integration, and we supplement and think it's very important to use shareholder engagement as well. Something that we often get criticized on as an asset management industry is that we're quite opaque in the way we engage. We don't give people enough insight into the engagements that we have with companies. So how can they be sure that we actually are holding them to account and applying pressure? We don't do it to be opaque, but we've found that it's much more constructive, and it's actually had a lot more success over time when we engage in private. I think when you start calling companies out in public before you even give them an opportunity to respond, it doesn't create a good and constructive relationship between you. I think it puts everyone on the defensive, and also it turns into a big publicity thing, which is actually distracting from our focus, which is to generate good returns for our clients and manage their money responsibly. And you end up spending a lot of time doing interviews and engaging in the public when you could be applying your mind to investment research. So there's a clear reason why we do it, and that's why we've tried to implement additional measures now, like our stewardship report, to at least update people when we can on what's taking place in some of those conversations during the year. Yeah, I'll leave it at that for now.
Okay, very useful.
Yeah.
Neville.
So not wanting to repeat anything that's been said, I think one of the big issues, again, in the popular press now is this point of they're judging managers by how many times they stand up and shout at an AGM and vote no, which, I think if you're standing up and shouting at an AGM, you're losing. It means that you actually haven't actually managed to change behavior, because if you had constructive engagement, as my peers here said, is the principled way to do it. You don't ambush a company at an AGM. You engage early when you realize the moment the companies, and nowadays we have a lot of engagement, companies are recognizing of this, they engage early, they'll submit their remuneration plans that they're proposing early. You go through it, and if there's stuff you don't like in it, you engage with the company in order to get it changed to a manner which is, far better suited to fit to purpose. And if you take an example, take it to absurd levels, if every single company on the JSE was applying ESG absolutely 100%, then every single asset manager would be voting in favor. And then we'd be accused of not doing our job. But actually, we have done our job, because every company is behaving well. I mean, that's nirvana. So it's wrong to, measure about how many no votes you've had or how many times you've had a stand-up fight at an AGM. Unfortunately, at the end of the day, some cases do. We fortunately weren't invested in the big fight in Athlone that happened a couple of days ago. But I mean, these things can get very, non-constructive. Let's put it that way. That doesn't serve any purpose. So a lot of engagement generally with the boards of companies. Nowadays, 5, 6, 7 years ago, the chairman never used to see you. Now virtually every company you invest in once a year, separate from management, the chairman will come and see, and you can raise issues like this. And if there are other issues, you can then, through that, they will send the relative appropriate person around. And then the trick is just how you communicate this, because often as well, you're dealing with sensitive issues. Sometimes you're dealing with inside information. So you can't just go and, stick this out on, these are very sensitive issues. So, it is a careful balance to be saying, listen, this is being done, and how we do it going forward. Another point, which I think, just to broach it in the subject now is, we all active managers, but obviously there's a growing trend around the world towards passive. Now, the issue with passive is that this integrated ESG approach, is not part of the, the beauty of passive is it's low cost. You've got a spreadsheet running in the corner and no one's actually watching what's going on at the companies. So there's a heavy reliance actually on active managers to do the work. In fact, even locally here, one of the heads of one of the more passive managers was complaining that the active managers hadn't pointed stuff out that, were going wrong, as if it's our job to do that. And that is what's happening. So the risk is if the world's going more and more passive, who actually is holding boards and management to account? If there's this rising tide of, don't call it dumb money, it's what we call it, but not smart money, that's going into all these passive indices, the kind of pressure on companies then to comply is actually less and less. And that's something that one needs to think about as well as one of the challenges for ESG generally as an industry.
Interesting point, because there was a JSE roadshow earlier this year in the US, and a lot of those investors actually spoke about ESG. I think Donna mentioned it earlier this morning. And it was interesting how they spoke about, I think we had a discussion earlier with also one of the corporates saying, well, their integrated annual report was 250 pages, now 100, so at least it's improved, and it was difficult for the analysts to work through that. But the institutional investors that we engaged with there really said that they don't even look at the report. It completely goes into a machine, robotics, artificial intelligence. It gets analyzed by a computer. So very interesting to see how our market will catch up with those trends. But I'm sure the corporates in the audience would be happy to hear that your preference is the more constructive engagement. I'm not sure whether all buy side have the same view based on our experience. And then the independence of the chairman, those conversations, I think, is a very good idea for corporates to consider in terms of not just having executive management, but independent engagement with your leaders. I think I'll just ask one more question before we open up to the audience so that we can give the corporates in the audience a bit more of takeaways and insights from yourselves as investment professionals. If you can give them an idea of what you consider good ESG performance, and specifically maybe share some experiences of engagement with management at companies, if you do want to share that, but good ESG performance and what corporates can focus on in that from that perspective. And you can start.
Yeah, that's incredibly difficult because, everything is different, whether you're in the extractive industry, what's important there versus retail versus industrial. So, I think the key thing was as I mentioned earlier, is each company almost needing to define, or in discussions with their shareholders, what is important to shareholders in relation to that company. So, again, if it's in the extractive industry, it's around rehabilitation, treatment of staff, CO2 profile, etc. If it's in retail, it might be more issues around making sure staff are being paid living wages, etc. These are the kind of issues on the E and the S side. Governance, again, that is, one where I think it's probably got the most focus, and that's where our experience is most corporates are doing, a lot of effort. The issues that I've said around making sure that you've got independent board members coming around talking to shareholders, making sure that, there is scope for proper engagement prior to AGMs with the shareholders, so that where there are contentious issues being proposed, there's sufficient time to actually discuss them and then change them if they need to be. This is one of the big issues often with, voting at AGMs is something gets raised, you raise an issue with it, the guys say, listen, that's very good, actually we agree with you, but we've got 3 days before our AGM and now we can't change it. And then you start, having to do deals or agreements that they're going to change it afterwards or something. So around perhaps the timing of engagements. I know ourselves as a company, our corporate, we now go, well ahead of the AGM to engage with our shareholders to see if there's any issues, so we can deal with it before we put out an annual report, not once the annual report has come out. The point I raised earlier about comparability, in any way, I mean, we all know Enron had like wonderful annual reports when, before they blew up, never mind the ones closer to home. The reality is words in a document mean nothing. So for us, again, it's around what was said and then what was done. So if we can see what, targets, goals set, versus what's achieved. That's how you measure how successful companies and corporates are being in relation to these issues. Then I guess the side thing is it goes back to this issue around our clients ultimately, and that is, we need more engagement from our investors, from the pension funds. What matters to them? We've kind of touched on it already, but applying my sense of morals, to investments, that's not appropriate. With some of the clients that I'm dealing with, I want to know what is it, that's important for you. You are the ultimate asset owner, and you need to give us much more clearer direction as to what's important, to make sure that we actually are making meaningful differences for clients. Because at the end of the day, we might think we're doing a terrific job, and then they tell us actually no, that wasn't important for us.
Yeah. No, so the directive recently issued by the Financial Sector Conduct Authority around the sustainability reporting and disclosure requirements, I think is going to become more and more topical. I know at our pension fund trustee board, we discussed that heavily, and with asset consultants, etc. So we will get direction from the asset owners, I think, in the near future. But I have to admit, though, that it's quite difficult to define that criteria. As you've mentioned, it's all about personal beliefs. Zay, do you want to give your input?
Yeah, I think the FSA directive is quite good. I think it'll create a lot more robustness and engagement, and create dialogue, I think, between organizations and asset owners. Yeah, I think we touched on earlier, I think the role in terms of shareholder activism becoming a lot more prevalent. I think a different way to think about it is perhaps shareholder consciousness. If shareholders are more engaged and companies are more conscious about what the material issues that are out there, I think it would solve a lot of the issues, prior to AGMs or engagement. I think also the reason why you have to create some issues in terms of perhaps a public forum or at AGMs is a lot of guys privately perhaps could be hoodwinked. Management, we know, generally can be charming, they can be there, and we've seen it in the past. I mean,
seen a very good example recently.
So it's perhaps a good way in terms of raising certain points in a public forum to be able to engage and to create that robustness, especially with regards to minority shareholders. Yeah, I agree again with a lot of the points raised. And I feel that the industry is going in a sense where it's more transparent, it's more accountable, and disclosure is increased. And I think companies are more and more aware. Globally, companies are a lot more receptive to engagement. And locally, I think organizations are now alert in terms of the issues. So I think the best in terms of companies is to create dialogue with your asset owners, discuss material issues, and spend money on material issues. I mean, we spoke about the 200-page or 250-page integrated reports. Spend money where it matters. And that would be it.
Yeah. Thank you. Anything that you'd like to add?
I think the difficulty with integrated reporting is that there's so many reporting frameworks which people have touched on today. So I think it's hard for the companies to actually reduce in a lot of ways. So I like that suggestion earlier of the slideshow with the most relevant points for investors. I also enjoyed when people put, I'm just going to touch on specifics now because I agree with the points that have been made, but when people put ESG presentations that they've made to other companies or the government or the public on their websites, I think that's a nice way to be more transparent. Yeah. And then I think Alfred from Nedbank mentioned that they do their ESG roadshow, and a couple of the JSE listed companies are doing that, and I find that really useful because, as most people say, you don't have time to go through the whole sustainability report. So it's a really nice way to engage, and then also ask the questions that are most relevant to you as an investment company. So it makes it much more tailored.
Okay, great. So we can open it up for questions from the audience if there's anyone that would like to ask our panelists. There's one on the far left there.
Thanks. Is this on? Hi, Nicole Martins from UNPRI. I just feel the need to make a few clarifying points on the PRI score because it's come up a couple of times today, and it's very important that we understand three things. So I'm going to touch on how it works, what its intended use is, and what its intended use is not. And I promise I won't take up too much time, but it's very important because there are a lot of PRI signatories in this room, and all three of the panelists actually are PRI signatories. The first thing is that the PRI score is not an overall score on how amazing you are at ESG, right? It's a score that's broken up into various sections and actually by asset class. So you get a score for strategy and governance, and then it's by asset class. The fewer asset classes in which you invest, the easier it is to say that, you know, out of the blanket of scores, the better you've performed. So there's no overall score. How it works is that you get a ranking from an E, which means you're doing nothing, to an A+, which means that according to PRI's understanding of international best practice for ESG integration in that particular asset class, you have nailed it. So that's just very important to understand. The second thing is that the reason that PRI has these scores is an accountability measure for our signatories, and it's a learning mechanism for PRI and for our signatories. The idea is not to be perfect from the gate, as you exit the gate. The idea is that you should use that internally to improve year on year. And as our knowledge increases about applying ESG into different asset classes, so for example, as we get more experience in the passive side, or we're recently doing a lot of work in fixed income, it becomes easier to have an international best practice. So it's more demanded of our signatories to try and meet that. So it's really for an internal learning. What it is not is something that should be weaponized to use against other signatories. And what it is definitely not is something that should be used out of context. So I just encourage our signatories, you're all doing a great job. There's not only one signatory in Africa or South Africa with an A+ at least one of those asset class or strategy and governance levels. In fact, our panelists on there are all A and A+. So just something that I felt was very important to make sure we understand is that the idea of these scores is that they are transient. It's to be measuring progress. The idea is that it fluctuates over time. It's not something that we can take as a be-all and end-all of performance in ESG overall. So it's just something very important to note. Thanks.
Thanks for that. And we do have a PRI joint conference that's coming up soon where we'll 21 November. It's a governance conference, by the way. If the audience members are interested in attending, you can ask Shamila how you get an invite as a PRI signatory ourselves as well from the JSE side. Yeah. Service providers are not scored. Okay, good. Anyone else would like to ask a question or make a statement? John.
I just wanted to comment on this idea around sort of, you know, we mustn't look to Europe to understand, you know, what we should and shouldn't be investing in, etc. I kind of fully support that. But I will just say that, you know, we shouldn't get caught up in sort of thinking about ESG as some kind of side addition to their market. It is at its heart fundamentally about transforming the market, right? And what sits at the heart of that is an economic principle. The economic principle is that businesses that address sustainability early relative to their peers who don't will show low cost of capital, better resource efficiency, stronger access to market, lower staff turnover, better innovation, stronger, longer. And so, you know, I just want to sort of land that point so we don't get caught up in thinking, oh, well, it's about exclusions and it's about not doing this, not doing that. Really, this is about driving the markets to support a growth model that is going to address inequality issues and societal issues. And to sit and think that, you know, as participants in the market, we must go at this, you know, half-heartedly, I think is to miss the point. This is something that is fundamental around, you know, long-term stable economic growth. And it requires heavy lifting from everyone here.
No, couldn't agree with you more. We have to have all industries. The exclusionary approach is something that we feel quite strongly about. But any responses to that?
Just that I agree wholeheartedly. I think that's why we've always integrated ESG. It can be material to investment case. And I think it is important to think of it that way rather than as a compliance or more of a box ticking function. I'm not criticizing people that do separate them, but I think we found that works quite well for us to keep the research within the investment team because it should be integrated, as John says.
Okay. If there aren't any more questions, sorry, there's one more.
I just wanted to get a sense of how you find chief executives respond when you engage with them, just as a general observation. Do they have a sensitivity to ESG? Are they aware of the issues? How do they try and engage or respond to you? I just have a feeling as an outside person that when you're going there, you've got 3%. This one has got 2%. This one has got 8%. They deal with each one individually and they say, well, why must I actually really bother about you? There isn't a really strong collective. And apropos Neville's comment that the heroes are presented as the people who make the most noise. I mean, Theo Botha does make a lot of noise, but I always have the impression that a no vote at an AGM actually has come after a lot of engagement, which in fact has been frustrated. And a very good example of that, of course, is Naspers. You're all in Naspers, and yet they just ignore your vote. So really, what I'm trying to get is a sense of how constructively chief executives are when you do try to engage. Do they have a sensitivity to ESG? Do they care about it?
Neville, you seem ready to respond.
Yeah, I mean, look, you raised Naspers. I mean, it's a valid point. We, have voted no. Obviously, they have a control structure in place, so they can afford to do that. But they've still engaged. So we've had 3 meetings in the past 18 months with their head of remuneration around changing the structure. They took a lot of what we said on board at the first meeting, and we think there was significant changes in the CEO's remuneration package to be more aligned with what shareholders wanted, which was, less tied to Tencent, more focus on the operating business, on the discount. But then actually there was another issue which came out of his most recent remuneration, which again we didn't like, around the time of the option package. And again we voted no, but then again we had an engagement, and the head of remuneration came around again last week to see us to discuss. So they are listening, they are hearing, and it is a constant engagement and a constant refinement process that's going on. But then you get, to your point, you'll get CEOs who will be far less engaging and far less. I mean, that's the reality. You'll have some people who, they're just focusing on running their business in the way that they believe is appropriate. And obviously some of this is around how incentive structures ultimately are replaced. And, if you are not getting joy from the management, that's when it goes to then the board level and engagement with the board. And then again, if you don't get satisfaction from the board level, then, it ends up directors are there at your behest. And if they aren't holding management accountable in the way that you think is appropriate, then it's our responsibility to replace those directors. Yeah. Really, honestly, there's some that do and some that don't. It's a broad church. You have some, directors who, say, listen, this is a bunch of box ticking bloody nonsense, and I'm dealing with the toughest economy in the last 20 years, and I'll deal with that when I have a chance to save my business or whatever. And then you get other people who, understand this is part and parcel of being a listed company. It does bring all the things John raised around lower cost of capital, more sustainable business, happier staff, so without going naming and shaming, it's really is a mixed bag.
I would agree, a mixed bag.
Yeah. But the more it gets raised, the more it becomes an issue. Then the more other execs see it, and I mean, no one wants to be the guy who has a bunch of rabid shareholders, at their AGM, shouting them down. And that will happen if they don't start, putting through the necessary changes.
Yeah, perhaps I can touch on. I think you raised a really good point in the sense that if you don't have this engagement, how are minority shareholders going to know about what the pertinent issues are? What we found useful is the UN PRI exchange, where we raise issues and we look for collaborative efforts in terms of finding other minorities who can engage on similar issues. We were one of the first in terms of raising the use of unauthorized debits and garnishee orders. And we found that to be quite useful, especially in the case of Net1. So if you look at it in terms of industry, specifics, we see certain industries perhaps better and perhaps some which aren't. What we found is telecoms and healthcare respond better in terms of the environment, whereas what we found is the property guys don't really respond that well. So I think it's also industry things. I'm not sure in terms of how you guys feel.
I think we get through that panel without net one coming out.
Yeah. So yeah, I think it's a judgmental thing, and it comes down to person. But if the board is engaged, generally what we find is that the CEO then is forced to be engaged. So again, it comes down to governance and good ethics at a governance level.
Alan, maybe actually thinking about that, just to add to your question, I think what we've learned is that sometimes you have to look more deeply into what the CEOs and management are saying. So they might be saying the right things, but it's the execution. So are they actually doing what they say they're doing? I think that's the learning from Net One, for example. So I think that, earlier we spoke about what makes good ESG performance. I think it's not only good disclosure, good engagement, but it's how do their actions actually correspond to their words? And I think what Neville said about it being a mixed bag is true, but I think as there's more peer pressure and investor pressure, that is changing.
And then maybe just to quickly add to your property sector concern, actually interesting, Shamila and I recently presented to a GSEC of one of the property companies, so more and more focus in that space as well on ESG.
Just maybe building on what Alan was saying, and maybe one of the issues that I have found my years in the pension fund industry is that the three of you, different asset managers, will engage on your own, but you will never put your ego aside and actually go as a collective on, say, for example, remuneration, and say, we three together are going to vote, and put your egos aside and say, actually, we're going to collaborate and we're going to vote a thing here. And I just don't see enough collaboration on very key issues that do come up for voting. And because invariably, to my opinion, there's a lot of ego issues in the asset management arena where you will not you will actually go as far as possible not to collaborate when you should, because very often a single pension fund will have the same counter in each one of your asset portfolio, your segregated portfolios that you have, but you will all vote differently, and you don't actually check with the actual fund, the actual owner of the asset, how you should be voting. And I think you need to listen to the actual owner of the asset, especially in the segregated section, where you should be voting as a collective on the behalf of the asset owner.
Can we maybe use that as the last question, and then I can give each panelist just a chance to wrap up in terms of your approach generally and answering the question specifically on ESG.
So factually, I don't think that's actually correct. I know we've worked together on a number of matters together. You may be aware recently that the entire industry wrote a letter to virtually the entire industry, the boards of the resilient group companies, requiring an investigation, and that was done by, I think, 11 of the top asset managers. And it's not, it's not an issue of ego. There are issues of a very strong competition commission in this country who has attacked a number of asset managers occasionally when they've worked together to try and change boards. I mean, Alan Gray had the experience as well. So one has to be very careful around how one acts together, that it's not seen as acting in concert. Secondly, I agree wholeheartedly. I mean, if our clients would tell us how they'd like to vote on it, is absolutely, that's first prize. Because, we do a whole lot of work, and as I said earlier, what the way that we might want to vote on a matter is not necessarily how a client will want to vote on it. And again, we might see things differently to some of our competitors. And I'd hasten to say that's not an ego issue, it's just that we would view a certain resolution perhaps differently or in a different light, or have had a different engagement with the company. But, there is certainly on contentious issues, there is a lot of engagement, but we have to be just very careful with the way, competition law and actually is today, that you are not seen to be broaching or breaching that. Yeah, I think, so just to your point to wrapping up, it's, it's without a doubt, probably the biggest focus area for the investment team now, but I think it's something that's very important is we do follow the integrated approach. I think that's very important for us is, if the separation, we feel that's a big risk, because if, the ESG issues are further away from the actual investment decision, it can end up becoming more of a box ticking approach as opposed to an integrated approach as to actually these people are doing something different. Let's first understand why it's different before we just categorically deny it. And I think that is very important for us, is understanding the context of each company, how it's applying it, rather than just taking a very hard rules-based, which can go, I think, if you separate the two.
So I agree with Neville. I think the key concern there is the acting in concert piece. But maybe also just to add that I think a lot of people could also use ESG factors in their research into ESG factors as a potential driver of alpha. So you're looking at companies that are managing ESG risks well because they could generate sustainable free cash flows over the long term. And so it's also part of your proprietary research when you do that research into their ESG factors and how they're managing it. So I think there's also a piece to that with sharing that information too widely, because it's part of your investment research as well. And so it could also be used to create an opportunity for you that maybe one of your competitors hasn't picked up if the company's managing it well, or if they're not. So that could also be another reason why there's not complete engagement on that. But I would agree that we actually do engage quite a lot, because I think, as John said earlier, we acknowledge that a stronger industry overall is better for all of us. So there are a lot of emails going back and forth between the asset managers and a lot of communication. And then I don't have much to add in terms of wrapping up, other than to say that we believe it's material. All these statistics that we're seeing, we can recognize that it's becoming important to people, but I think it's also just about being realistic in how we can manage it and provide these opportunities for people to invest in.
Yeah, I'm not going to touch on the collaboration. I think we do collaborate quite a bit where we can. I think the PRI exchange is a good tool, again, to use. And perhaps just to collaborate, or to wrap up rather, we can complain about the low growth, we can complain about high employment, we can complain about dismal outlook. But I think as an industry, as a collective society, we need to have a lot of introspection. We need to look at ourselves and realize, are we just playing lip service, or are we actually meaningfully doing things to effect change in society, and not just in a narrow way, but in a broad, in a broad sense. So we need to really have these moments. We need to have these discussions. We need to have these engagements, and these are all really great platforms and great tools in terms of having these discussions, and really effecting change, especially with regard to material issues.
Thank you very much. I think just to wrap up with a last stat, there's 43% of US investors, institutional investors, have incorporated ESG factors into their investment decision-making process. So this is according to a survey done by Callan, an institutional investment firm in the US, and that has actually doubled in the last 5 years. And I'd hazard a guess that in South Africa, we hopefully even better at ESG, and it's more than 43%. But I really think that we've had a very interesting and very insightful panel, and I'd like to thank our panelists, and please continue with the work. We should probably in the future invite one of the buy side that don't believe ESG adds value, so we can have more of a debate in terms of that. But if you can continue doing your work, I think we're on the right path for the local industry. So thank you very much. Very insightful. Thank you.
Yeah. Thank you. Thank you, Dave, very much. Okay, that's a lot. Here we go. Okay. We don't have anything for the baby. I'm sorry. Thank you for being here. Thank you. Okay. Thank you to our panel, and I think it's quite interesting that the whole after lunch crowd is from out of town. All the panelists are from Cape Town. John's coming from Cape Town, and then of course later on we have on our program Gary Raynaud, who's come all the way from London from FTSE Russell. Thank you very much. I think it was very insightful. I hope that you've taken away from it as much as I have, and that it's really going to be useful for our issuers to be able to take back these messages to your CFOs, to the companies, and hope to understand and entrench why it's important and why it actually is directly impacting on investment decision making. So continuing on a bit of the theme of governance, which has been touched on a few times already, it's my pleasure to welcome Peter Korenhoff from Allan Gray, who will give us an investor perspective on governance and what they've been seeing and how this has actually permeated in the market. Peter, thank you.
Good afternoon, ladies and gentlemen. Thank you very much for giving me the chance to talk with you today. So I'm going to be giving you an overview of how at Allan Gray we approach the governance of companies that we invest our clients' funds in. Now, I think a good point to start is to ask, why governance? And the answer really lies in the history of how companies work. So if you go back in time a couple of centuries, the owner of a business was also the same person that managed that business on a day-to-day basis, right? Today, you get a situation where shareholders are typically, so shareholders are the actual owners of the businesses, right? They're usually workers who belong to pension funds. Those pension funds appoint trustees to oversee the fund. The trustees appoint consultants. The consultants tell the trustees which asset managers to appoint. The asset managers buy and sell shares on behalf of the pension fund, and also recommend how the pension fund should vote their shares on who gets elected to the board of directors. The board of directors then appoints executives, and those executives actually manage the company on a day-to-day basis, right? Now, you don't have to be a rocket scientist to work out that along that very, very long value chain, there are a lot of conflicts of interest and there are a lot of principal agent problems, right? So the shareholders, the owners of businesses, the owners of companies are very far removed from the executives who manage on a day-to-day basis, and the executives might not be acting in the best interests of shareholders. Okay, so where do asset managers come in? It's not the job of asset managers to run the companies, and frankly, we'd probably be very bad at doing it, right? In addition, we often don't have operational level insight into what's actually happening at the company. So the two levers we can pull, the best bet we have is firstly ensuring that there are good people on the board, and that they're thinking long term. And then secondly, that executives are incentivized to think long term and to create value for shareholders over the long term, right? And governance is really the solution that's arisen for solving these conflicts of interest. Okay, how does this fit into Allan Gray's investment philosophy? Our investment philosophy is actually quite simple. So what we try and do is we say the share price of companies go up and down over time, so the red line, and we try and buy companies if the share price, so the red line, is below the black line. The black line is the intrinsic value of a business. So that's what we think the company or the business is really worth. Okay, and we do a lot of fundamental analysis to try and work out that intrinsic value. Okay, so governance analysis plays into this in three different ways. The first way is by doing governance analysis, we can better calculate or determine the intrinsic value of a company, right? So we can better know where that black line is. A second way it plays into it is it's a risk management tool. So say there's a company and it's on 3 times earnings and it's very cheap and it looks attractive, but there are major governance issues, right? We wouldn't buy a very big position in that company, right? Because of the governance concerns, even though it might be an attractive investment. So it's a risk management tool. The third thing is that governance can have a material impact on the intrinsic value over time. So that can be for better or for worse. If you think it's for better, what can happen is you get better directors on the board, and they should make better decisions, which should make the company more profitable over the long term, right? Which should create shareholder value. But as you've seen, sometimes governance has a very big impact on shareholder value, but it goes the other way. I guess the fall in the resilient group of companies' share prices in Steinhoff are good examples where government blowups resulted in massive shareholder value destruction. But it's not always that obvious. Okay, so governance can have an impact on shareholder value in other ways. Capitec is a very good example of this. So this is simply the Capitec share price chart over the last, let's call it 18 months. So our clients didn't have a position in Capitec during 2017. Not because we thought it was a bad company, we just thought it was expensive. However, as part of our fundamental investment research, we did a lot of work on Capitec's governance. So for example, are they complying with the National Credit Act? Are their business practices above board? Are their accounts conservatively stated, right? So what happened then was the Viceroy report came out and Capitec's share price fell by 30% in the space of a day. So we looked at it, and because we'd done this governance analysis previously, we could look at the Viceroy report and immediately say, we don't think there's much substance to this. And when the share price fell, we said, that's great, because now there's a great company which we can buy at a 30% discount. So when the share price fell after the Vice report came out, we bought quite a significant position for our clients. As you can see from the chart, there's actually been a very good share to own since then. Okay, so the way that governance factors into it isn't necessarily always obvious. Okay, so how does this actually get integrated into Alan Gray's investment approach, right? And the way we think about governance and responsible investing is we really see it as part of our DNA. So we're long-term investors, and we invest based on what we think is the sustainable earnings power of a company. And it's very clear that if a company isn't managing its ESG risks appropriately, that those earnings are not going to be sustainable over the long term, right? So we spend a lot of time looking at ESG risks because we think that has a direct impact on the earnings power of companies. And we don't think about ESG in a silo. So for example, if carbon taxes come to South Africa, that could make Secunda unprofitable for Sasol. And if that's the case, and Secunda has to close down, Sasol would be a terrible share to own, right? So that's maybe an environmental consideration, but we really see it as one of the core risks of the investment case. So we have investment professionals, not some ESG compliance department. We have investment professionals in the investment team looking at it, right? So it's very much embedded in the investment team. It's not outsourced. What we found, however, is that often there's a need to do more in-depth research and to do more systemic research. So we have a dedicated environmental and social analyst and a dedicated governance analyst to provide additional support to the investment analysts who are, the primary ones responsible for looking at the ESG risks. What we also do is, our guiding principle is always thinking about shareholders' long-term best interests. And the key focus really here is long-term. But we do it in a risk-based and pragmatic way. So, for example, we think it would be a waste of time spending a lot of resources looking at Capitec's environmental policy. It simply isn't material to the investment case. So we'd much rather allocate those resources and look at their micro-lending practices, because that is material. I guess the other thing we try and do is we try and be pragmatic, right? So each company is different, so we don't have a fixed set of rules, we don't have a fixed set of boxes we need to tick. We think that leads to lazy thinking, we think it leads to arbitrary outcomes, right? So we'd rather have in-depth qualitative analysis where someone then makes a judgment call rather than having some arbitrary score and making investment decisions based on that. And I guess the other thing, the last point is, we do tend to do most of our research in-house, but we also do collaborate with a lot of third parties and industry experts to get a better understanding of some of the ESG issues. Okay, let's make it a bit more practical. So how at Allan Gray do we think about executive remuneration? And it really revolves around three key principles that we think about. So the first one is, do executives have skin in the game, right? And that goes back to the first slide I had, showing you that very long value chain. So we want to make sure that executives think about the long term, that they're incentivized to create value for shareholders over the long term. So the simplest way to achieve skin in the game is if executives actually have big shareholdings in the company they manage, right? That solves a lot of the conflicts of interest. The second way of doing it is we look whether a large part of the executive's remuneration is based on long-term performance. So if you're sinking a new mining shaft, which takes 10 years to do, but you're sailing off into the sunset after 2 years because you get your bonus after 2 years, that's a material misalignment, right? So we have a very strong preference for most of the remuneration for executives to be based on long-term performance. But by long-term, and this is maybe the third point on skin in the game, we don't mean 2 or 3 years. We mean 5 years or longer, right? Because it takes a long time before it shows up if executives have been making, short-term decisions that put the long-term business at risk. So the second key principle we think about is performance factors and targets. And here there are kind of 5 considerations we think about. So the first one is, are those performance factors actually aligned with shareholders' interests? So the factors that determines the executive's bonus, is it actually aligned with shareholders? The second one is then, are these factors easy to gain? And I can give you a couple of examples like that. So a lot of companies have their remuneration is based on an earnings growth, but the earnings growth is continuing fundamental earnings from, adjusted earnings number. So what in fact happens is the executives make the adjustments to the earnings that are then used to determine their bonuses, right? So that's obviously a conflict of interest, and it's very easy to game. So we generally be opposed to something like that. The other thing we often see is that there are these, arbitrary measures that are impossible to quantify. And that's not always a bad thing. There is room for discretion in remuneration. But if, a CEO gets full marks for leadership every year, that's a bit meaningless, I think. Because if you think there's good leadership over time, that should translate into a higher return on equity, improved earnings growth, or higher share price performance. The other thing we think about there is there should be a balance between growth metrics and and metrics that think about return on capital or capital allocation. Because often when companies grow very, very aggressively, but they don't generate, adequate returns on that, it blows up. Maybe something like Famous Brands is a good example with the acquisition of Gourmet Burger. So we really want that balance between growing the business, but also, generating a sufficient return on capital. And the other thing is then, it's obviously quite tricky to know whether the performance targets are set, whether they're sufficiently stretching. And that's another reason why we think it should be embedded in the investment team at Allan Gray. Because the investment analysts know the companies best, so they can best say whether those performance targets are actually stretching enough or whether they're being lowballed and are very easy to achieve. So once you've got skin in the game and once you've got the performance factors and targets, you've kind of got the building blocks of the remuneration policy, and that translates into the quantum that gets paid to the CEO and the CFO. And there we look at firstly the base pay that's paid to them, but also the total quantum that's paid to them. And that often involves quite tricky, a lot of numerical legwork because companies sometimes hide what's actually coming through in the options, and you have to do a lot of analysis to get the real numbers. So we do that analysis. So we look at the total quantum and we look at it over a number of years. And we then compare it to, companies in the same industry and other companies with similar market caps. But what we also then do is we do a sense check and we say, is this quantum reasonable considering how the company's performed, both in absolute terms and versus peers? So you can see it's very much a principled approach we follow. So we look at those three key principles and try and work out whether a remuneration policy achieves those or not. There are a lot of technical things that you actually have to do in order to make an assessment on those three principles. Okay, the other lever I said we can pull, right, is firstly executive remuneration and then secondly the board of directors. So here for us the key question is, does the board hold executives accountable? And that works in a couple of different ways. So firstly, is the board looking at whether executives are acting in shareholders' best interests and their long-term best interests, right? And secondly, are executives, are the board challenging executives if they want to do big acquisitions? Is this acquisition actually going to create shareholder value or not? Because executives often like building empires, right? So the board kind of has to put a check on it. So we employ various tools to do this. As you can imagine, it's quite tricky to evaluate from the outside whether a board's actually functioning or not. And we do a lot of qualitative research, and one of the tools we use to assist with this is a directors database. So basically what happens is if you're the chairman of the remuneration committee and you give a big golden handshake to an outgoing CEO who's performed poorly, that Remco chair gets put into the directors database. And if that person comes up for re-election at a different company, there's a red flag that goes up, and we can say, oh, this person has made bad judgment calls in the past. And though it isn't a hard and fast rule, we'd probably vote against that director's re-election at the new company. Okay, so we have various tools like that that we use in conjunction with qualitative analysis to try and assess whether boards are working well. Just one point on that. So I think King 4 hit it on the head when it's, in King 4 it says, for a board of directors to work effectively, it needs to have 5 things. It needs to have knowledge, skills, experience, diversity, and independence. So we really spend a lot of time looking at each board member, looking at their background, previous companies they worked at, to try and figure out whether the board as a whole has those 5 factors. But there's something else that plays into it. So in South Africa, unfortunately, or for some reason, independence seems to have been at a premium to the other factors. And we don't think that's right necessarily, because there's no point having independent directors, but they don't actually have the knowledge, the skills, and the experience to challenge executives. Well, there's no point in having independent directors if they don't bring diverse views to the board, right? So we really think having all 5 of those factors is crucial. But the other thing is we're very skeptical of many companies who say directors are independent, right? So just because a company says a director is independent, we don't necessarily take it. So we, as I said, we do our own research, and then we see whether independent in substance or not. And just because someone's not independent doesn't mean we'll vote against them. And just because someone is independent doesn't mean we'll support them. But as I said earlier, it plays into those 5 factors, and we look at the board holistically. Okay, so how do we actually influence executive remuneration? How do we actually influence governance? So the obvious one is proxy voting. And I mean, we've talked about that earlier today, but I do want to spend a bit more time looking at engagements, and that's come up earlier. So this is our data for 2017. As you can see, we had 617 engagements with companies during 2017. That's a lot. So most of those engagements were about the business case for a company. So it's us meeting with the CEO and the CFO and asking what's happening to revenue growth, what's happening to margins, what's happening with this acquisition you're doing, what's happening with this project. But what you'd see is we discuss governance on, quite a large number of occasions. And that comes back to the earlier points I made, right? Where, governance really is the tool we have for ensuring that executives are acting in shareholders' long-term best interests. I guess the other reason for that is that, governance is pervasive to all companies, where environmental and social issues aren't necessarily, not all companies have material environmental and social risks. Because we follow a risk-based approach, we often tend to focus on governance. But I mean, you can see we had a lot of other engagements on environmental and social issues too. And maybe just touching on the issue of engaging in private versus engaging in public, our experience as practitioners is that we have a much higher probability of success if we engage in private. And the reason for that is when you start engaging in public, firstly, everyone gets defensive, right? Secondly, the media starts reporting on it and you lose control of the narrative, right? And then it becomes a mess. And so it's very difficult to build a constructive dialogue. The other thing is the company then maybe cuts you off and you lose all influence you have over that company. So we believe if you engage in private, you have a better chance of, building a constructive relationship with the company and getting them to change, trying to influence them to incorporate your views. Having said that, sometimes that doesn't work, and then we take a more forceful approach, and then we'd start engaging in public. But that really is a last resort. Our preference is quite strongly for engaging in private. So then lastly, what we've realized over the years is that, especially as the Generation X and the Generation Z, the millennials come through, there's a real need from our clients to better understand what we do on responsible investing, right? So we've been trying to up our game in what we do on it. And so, as Rand mentioned earlier, we do have an annual stewardship report, which is on our website. And it has very detailed case studies on how we actually do responsible investing. And we name specific companies we've had issues with and how we try to address those issues. So we really try and make it as practical as possible. We also then publish our proxy voting recommendations. So companies can, our clients can see every quarter how we recommended that they vote their shares with motivations for that, right? So we do try and make it as accessible and transparent as possible. And then lastly, we also give high-level policies on how we think about these issues. So I hope that's given you a good insight into, how we think of governance at Allen Gray. Thank you very much.
Peter, I think that's definitely given us a lot of insight and a lot of food for thought. Thank you. And good learnings. Thank you very much. So our next speaker is from FTSE Russell. He's the head of Middle East and Africa. And I think we would have seen today some of the importance of data, of underlying information in relation to ESG, that investors need to use this in a manner that is understandable, that is comparable, and that is decision useful for them. And there are a number of tools out there that can assist with this. And the JSE, of course, also has a data offering, which we're just launching now. And it's my pleasure to invite Gary Reinhardt from FTSE Russell to please introduce to you the data offering that we have, and hopefully you'll find this useful. Thank you, Gary.
Good afternoon, everybody. It was mentioned I came over from London, but what a pleasure it is to come from London to come to South Africa and meet audiences such as yourselves and to get to talk about something which is obviously very important to this audience specifically. I'm going to take a little step back and just look at FTSE Russell and how we've grown as a business over the last number of years. So FTSE Russell provides a broad range of indices which our clients use to help them make better informed investment decisions. And when you say our clients, that's a global client base. To put a number behind it, we have assets benchmarked against our indices, $16.2 trillion US. These clients look at us for the data that we have, the information that we provide to them, which they integrate into their decision-making process. I'm going to touch on some of the data we provide around ESG. It's obviously the relevant topic. Sustainable investment data model that we offer. It's a subscription-based model where clients would ultimately have a username and a password. They can log on, and everything I'm going to go through today, they can view that data. ESG is not something new for FTSE. We've provided ESG indices for over 15 years. We have and the data that supports those indices. One of the flagship indices is our FTSE for Good index. And that's one of the practical implementations of ESG data into the indices, but that does result in certain companies being excluded from the index. We are seeing a number of other clients looking at practical implementations. We worked with the Japanese government very recently, GPIF, whereby what they wanted to do is they wanted to continue to encourage the Japanese companies to improve their ESG standards. And what they did is they worked together with us. We created a multi-factor ESG index, so multi-factor, so factor attribution, factor tilting, as well as tilting towards ESG. And what the government did is they put $5 billion into this fund. So every Japanese company that was in the index benefited very much from the flow of assets. Our international clients look at each country. They take a global view of the markets. When we introduce a new country into our indices, one of the first questions they ask us is, what are the ESG scores? Some of them are mandated to make allocations based on ESG. Some of them aren't. There's very many different uses, and you've had some very interesting discussions today as to how it adds value. We aren't here to say you must do it. We're here to provide the data to help people make decisions, to raise the transparency and help raise the standards. So at FTSE, within our sustainable investment data platform, we have two parts to that. We have effectively the ESG and green revenues. And I'll touch on each of those very separately. As I said, both of these are on the platform where you just log on onto the internet. You can then dig down into these various offerings. So the ESG, we haven't tried to be super controversial with regards to it. We have a lot of experience gathering data. We have over 200 people gathering data at the FTSE, within FTSE. We look at the underlying companies. We understand the companies. We do provide a scoring methodology. So what we have is we have 300 underlying measures. That's kind of behind the scenes. That rolls up into 14 themes, and each one of these themes receives a score. It also receives a score based on the relevance of that theme for that market, for that company, for that sector. So it is adjusted. It's a very independent model. It's an evolving model, but it's very robust as to how we gather the data. There's not a lot of guessing that goes on. There are other approaches where people use slightly different approaches. This is the approach that that FTSE uses. So ultimately what you get is you get an ESG score for every company, and 98% of the global market cap is covered in our database, and over 100 South African companies is covered in this database. So companies will receive an aggregate score, their ESG score, between 0 and 5. You receive a governance score, an environmental score, and a social score. We make this data available to most of the underlying corporates in the different markets we look at. They can run a peer analysis that's done privately with the companies. They can look at how do they rank versus their peers in the industry or in various markets in the E, the S, the G, and we get the kind of the aggregated scores. Green revenues is slightly different, whereby what we look at there is what does a company produce. So we've identified 60 subsectors of green revenues. These are companies are preparing themselves for the future. Companies are looking to diversify away from their current business model or enhance their business model. We record all of those 60 subsectors of green revenue. Our classification system may classify a company as a mining company or an industrial company or whatever it is. The green revenues, you can have more than one sources of revenue. And many companies do have, and what this does is you can see the history of which companies are diversifying, how much of their revenue comes from different sources, sustainable sources of revenue. So as I mentioned, 300 indicators, 14 themes, 3 pillars, the environmental, social, and governance, and then 1 score. That's what it comes out at. And the data model, so the score, if you have a score of above 3.5, you get into our FTSE for Good index. Companies or countries such as South Africa may decide that they want to have a different view of that. This is why this platform makes the data available for you, which then you can interpret in your way. And we've got the transparency down to the level, so you could see where your priorities are. It isn't one size fits all, but we're giving you the data to help you make the decisions. And the green revenues, as I said, identifies 60 subsectors of green revenues for every single company. And there's about 120 South African companies. These are the green revenue sectors that we've identified. And this is changing because there's new technologies, new ideas, new initiatives coming into the market. So this is what the platform actually looks like, quite small here. So when you log on to, so we've actually taken the company name out of this. So these are all South African companies. This would show that this company, which is a bank, how much of their revenue comes is green revenue, and what is their ESG score, what is their the S and the G score. So that data is available. The filters at the top can allow you to filter per sector, per market. You can search for companies only above a certain score, etc., etc. The data is there. You can then manipulate this platform. And the green revenues, so you can see that this company is a chemical company, and 55.73% of there comes from a green revenue source, which is defined as E1 and EQ, and those go back to the definitions of the green revenues. But as you dig down, you can see everything. And then one level down from this, the 14 themes, we provide the scores, which aggregate up to then the E, the S, the G scores. And again, this is transparent. Clients can see this, or anyone can see this. The corporate can see it, asset managers can see it, asset owners can see it, consultants can see it. Anyone can see this information who is a subscriber. And there's quite a complex way as to how you define the scores, and we don't have enough time to go into detail on that. And then it goes down into the 300 underlying indicators, which we identify for every single company and where we got that data from. Bottom line is we do a lot of the heavy lifting. We've got very robust ways of doing the heavy lifting, of capturing data on a global level to put into your hands to help you make decisions ultimately, however you choose to make decisions based on this data. And then that's even harder to read, but that's the green revenues data, and you can dig down further down in these modules to see where the revenue comes from, how it's changed over time. We generally have a 5-year history where it is available. Some of this is very new. Some of these technologies have only come out in the last couple of years. But it's all about being transparent, providing information, providing you with reliable, transparent information to help you make investment decisions. And what we're going to be doing together with the JSE is making the South African module available as a standalone. So either someone can come today and have the full global module for ESG or for the green, or together with the JSE, you can get just the South African version of both of those. And that really then can be incorporated either into your research as you decide how relevant is ESG for your research, for your allocation purposes, or it can be incorporated into your investment decisions. Or we can create indices, or we can create tilts, or we could create an index which is only governance related. The combinations are infinite really, and so What I would say is you engage with the JSE team to see how you can use this data, and then should you want to come up with to implement a solution, they would work together with us, FTSE, to come up with an implementation strategy, which could then either be a fund, implement an ETF, or whatever it is. There we go, short and sweet. That's it from me. Thank you very much.
Thank you very much, Gary. And I think we can, Vyasan is at the back. Put your hand up, please, Vyasan. And he's from our information services team. So if you have any questions and would like to find out more about the data and about getting access to that, please contact Vyasan. Or alternatively, you have my cards in your folders. Please let me know and we're happy to put you in touch with the right people. Very useful information. So without further ado, ladies and gentlemen, I'd like to welcome our CEO, Nikki Newton-King, who is taking time out of her birthday today to do closing remarks for us. Nikki has, we didn't say how old you are, Nikki. Nikki has really championed sustainability and incorporating this into our markets for close on 15 years now, Nikki. So if there's a clue to her age, that might help. But has really had the stamina to keep us going and to entrench us in our markets, but I'm sure she's going to share some of that with you. Thank you, Nikki.
Thanks, Shamila, and thank you to all of you who've had the stamina of staying today. My mother always said you should never stand between guests and their drinks, so I won't be very long. But I did want to thank you for asking the softer side of the JSE to close this session, Alfred. And also to thank all of you who participated either on panels or presenting. I know from some of the companies, those of you from the audience, it really actually indicates the amount of interest in an area which, when we started this, we really were considered to be somewhat on the loony left fringe about even wanting to have a conversation in this space. And I do think that it's worth reflecting that when we started this journey, the conversation was quite a simple one. It's green, it's about green, or it was about ethical. It wasn't really about the ESG that we're talking about today. But I think the truth of the matter is that today it's still an alphabet soup, where I think that one man's CSR is another woman's SRI. I think it's wonderful, really, to see the discussion on ESG becoming something of a more mainstream. By far, internationally, the topic that people want to talk about, the big money wants to talk about, is ESG. And so I no longer feel very lonely when I go onto international panels and this is the topic that they want us to talk about. It used to be about king governance and governance regimes and maybe some listings requirements and what were emerging markets like. But the thing that we get asked to speak about most is in this space. I do think that it's really therefore quite exciting that we're a first mover in South Africa. And it's not surprising at all, and I'm sure you would know this because you're here. It's not surprising at all because if you think about the nature of the things that we've had to confront in this country, the responsibility of corporates and investors to the country, I think, is something that we own quite centrally, many of us. And when we started this conversation, international exchanges sort of said, why on earth would you be even thinking about a bigger license to operate than your commercial license to operate as a corporate? So I think we should actually think as South Africans that it's actually a time that we were celebrated for being first movers in this space. But I do think that for our part as the JSE, there's still a lot more that exchanges like us can do to help progress the SDGs. I think the things that we're talking about today in ESG is the beginning. In fact, it feels like we're just beginning to get a bit of momentum on one track, but there is a big track ahead of us and there's a lot of work for us to do. If you think about it, there's 17 SDGs. You take the SDG on quality education. You could sort of think, well, what, unless you're Kiro, do any of us have to do with quality education? But if you think about actually, if you're a bank or you're an exchange, one of the foundations of education is actually about financial demystification and enabling people to understand how they interact in society and the rights and responsibilities they have. All of us as companies, whether you're in financial services or not, we have roles to play there. But as an exchange, I think specifically in relation to financial education, there are things for us to do. Take gender equality. You might sort of say, what on earth an exchange has got to do with gender equality? But the fact that we put listings requirements in that actually asked companies to, not asked, required companies to have a board policy on gender diversity. Not saying there's a target, or a quota, but saying you must have a policy has already started to turn the dial on the discussions in companies. And I know that those of you that are having, from the investor side, having conversations with companies are starting to sort of say, well, hold on, how come it's good enough for you to only have 10% of your board are women, or for that matter, 10% of your staff, or it starts a broader discussion on diversity. You look about the SDG on affordable and clean energy, where we've recently gone live with our green bonds, the Cape Town City Green Bond being oversubscribed. We're very, in fact, it's one of the areas I wish we had been faster movers in. The Luxembourg Exchange is by far the fastest mover in the green bond space. There's a lot for us to do. Think about the infrastructure coming down the line now if we want to get growth going in this country. The opportunity for us to actually create products, create sectors in our market that actually will drive that type of investment in a particular way, rather than just ordinary type of infrastructure investment. Drive it towards clean energy, drive it towards impact investing. And you think about the SDG on decent work and reduced inequalities, where I really do think the next frontier is going to be further disclosure on REM disparities, and double clicking on the internal Gini coefficient. We do some in this country. I think there's going to be far more discussion about that. So let me just end by giving you a thought about where I think the 5 things I expect to see coming in this space in the short and medium term. I think we're going to see greater alignment internationally on the terminology we use, so that we avoid alphabet soups and people talking knowledgeably about an area but quite past each other on completely different topics. So I think there's going to be something there. I don't necessarily think that is in the form of a standard or anything like that, but I do think there's going to be, we're going to start to coalesce around what we mean by for instance, SRI, what we mean by sustainability, what we mean by CSI, so that people are actually talking about discrete different things. I think, secondly, we will see more drive for disclosure of ESG information, investable data points, so that John and his colleagues actually have things that are comparable across companies. And our colleagues from FTSE are indicating that there are already tools out there to give investors databases that you don't have to go and trawl it yourself. The point of this is not to make disclosure more tough for companies. The point of this is to enable a more robust engagement by investors. So I think we're going to see far more requirements on disclosure in that regard, and I think you're going to see listings requirements around the world start to evolve in that space. I think we're going to see that focus on transparent disclosure rather than transparent marketing. Somebody today I know made this point about if you do certain things just before results, it attracts attention, which are more of sort of green fluff than real substance. I think one's got to be really sensible about this, because we'll start to see through this. The more we get competent in this space, the more we will demand that there is a consistent way companies behave. I think we're going to see a much more acceptance on focus on business for the long term. Now, in this country, where we don't have quarterly reporting as a norm, we sort of don't realize how serious this is. Actually, about the only thing Trump has done of any good is to actually say that he thinks that we should do away with quarterly reporting in the US. And I was at the Merrill Lynch one-on-one conference this year, where there was quite an interesting debate between 2 shareholders of ours, one of whom was American and one of whom was South African. And the American saying, well, why don't you get to quarterly reporting? South African, why would we want them to be driven to short-termism? The American saying, well, because it helps my model. Now I think that's a serious problem. We've got to, as issuers, get information out there that is relevant for investors as regularly as we can. But we can't be driven to a situation where the exact thing we should be doing, which is to invest for things that will enable us to thrive over 16 years, is not enabled because we're forced to report results that trend in only one direction quarterly. So for those of you who ever get pushed in that regard, I would urge a pushback. And finally, I do think we're going to see more ESG products, indices, like Gary talked about. I think impact and green bonds. I think we're going to see SDG ETFs, essentially products which make which allow companies that meet certain sustainability thresholds to be identified, and that makes sustainability an asset class. And I think we're going to get there pretty quickly. I don't think we're going to be in a situation, certainly in this country, I don't think we're going to be in a situation where the only way to be listed is if you meet certain ESG minimum criteria. They did that in Brazil for certain of their companies, but that's because they were all down there as opposed to where we were. I don't think we're going to do that, but I do see that there are going to become more and more products, and instead of us celebrating the one SDG ETF, we're going to be talking about, you know, how the difference in the different ETF performances because of the sustainability factor weightings in these index structured products. So I'm going to end just by congratulating you all for staying, congratulating you all for being early movers. You know, they say that good test of a leader is how many followers and how they manage to get, how many followers they manage to get. So I hope that we'll look back in a couple of years, all of us, and we'll see this horde of people following us. So thank you very much for being here. Thank you to my team for setting this up, and for you all for making the time. Shamila.
I don't want to put a damper on that. There's nothing that can follow that except to say, please, there's food outside for all of you. I've deprived of lunch. I am so sorry. Could you please also remember to fill out your feedback forms? They're really important to us. Leave them on your chairs and also your lanyards, because we do recycle them. We're trying to be green. Thank you once more for attending, everybody, and we hope to see you back next year. Thank you.
Change your heart, look around you. Change your heart, it will astound you.